Good morning. It is November 11th, Veterans Day here in the United States, and we thank all for their service. It's 9 a.m. in New York City and in New York State as well, where I am. This is Yahoo Finance Live. I'm Julie Hyman, along with Miles Udlin and Brian Sazi. Let's take a look at futures right now as we get underway this morning. We've got Dow futures trading higher by more than 0.5%. We've got S&P futures also indicating a higher open, and Nasdaq futures leading the pack. They're indicating a higher open by about 1% here this morning. Alibaba shatters its Singles Day sales record, but the shares are taking a sharp hit. That's on new regulations out of China. We will explain them going forward. And later in the show, Beyond Meat CEO and founder Ethan Brown will join us to talk about his new partnership with Pizza Hut. So be sure to stay tuned for that. But let's get right to that Alibaba story, because it's a very interesting one and perhaps a surprising one as well. New antitrust and anti-competition regulations out of China affecting Alibaba and a number of other Chinese e-commerce companies. Akiko Fujita is here to explain it to us. What exactly do these rules entail, Akiko?
Yeah, Julie, there's a number of issues that these draft rules hit on. It really does offer a guide of how Chinese regulators view anti-competitive behavior. One of the issues they're talking about, exclusivity clauses. This is a cracking down on platforms that force business into exclusive arrangements, something that Alibaba is accused of doing. Unfair pricing, this practice of these platforms using user data to determine how much a single product should be priced at depending on the consumer. Also, stopping companies from sharing sensitive consumer data, as well as preventing companies from selling at a loss to eliminate competitors. And in putting out this announcement, we did hear from Chinese regulators saying that this, in their words, quote, promotes the sustainable and healthy development of the online economy. This draft, according to the regulators, now being put forward for public comment until November 30th. So this is not official yet, but it's already hit those major Chinese tech companies in a big way, as you point out, Julie. When you look at this chart here, the major companies losing nearly $254 billion in market value over the last 2 days. We're talking about names like Alibaba, Tencent, Xiaomi, and Meituan. The timing of all of this is certainly worth noting. This came out on Tuesday, one day before the biggest shopping day in China, Singles Day. Also, just a week after regulators stepped in to halt what was expected to be the world's largest IPO, that dual $34 billion listing for Ant Group. And this is really the government in China making it very clear who is in charge at a time when there are real concerns about the scale and influence these tech companies are increasingly having in China. And just a few numbers to leave you with here. When you look at the scale of just how influential these companies are, Alibaba, 881 million mobile monthly active users. Singles Day, of course, generating $38.3 billion in sales last year. You just pointed to the numbers today. And then when you look at Alibaba and JD.com, combined, they account for nearly 3/4 of retail in China. So you look at those numbers, the Chinese government has certainly signaled that they are increasingly uncomfortable with the influence and scale they have. And what you're seeing today are regulators stepping in to say, we are the ones in charge here and we're going to crack down.
Well, and Kiko, as you're outlining some of the discussions that Chinese regulators are having, it sounds almost like they're trying to troll U.S. regulators by here are all the things that U.S. regulators won't do to these tech platforms. But I'm also wondering, did Jack Ma just ruin the party for everybody by coming out and being too forthright? And now this is essentially, the government trying to remind Jack Ma that you might be richer than everybody on paper, but we are still in charge. And it's a warning shot, I guess, to any other major Chinese entrepreneur, business owner, CEO, and so on that, check with us first before you go out and say anything that we might not like.
Yeah, so the answer to that is a yes and a no. And I think you're alluding to these comments that Jack Ma made a few weeks ago, talking about how Chinese financial sector is run, sort of rattling the cage, if you will, because the regulators were really concerned about the influence Ant Group was having, particularly with micro lending. And then you saw just a day before that IPO was set to take effect last week, Chinese regulators coming out and setting standards for micro lending that goes to the heart of Ant Group's business model. I mean, yes, you could argue that Jack Ma has kind of rattled the cage, but regulators in China have been sort of signaling at this for a few years now. If you go back to 2018, we saw regulators step in to crack down on gaming sector and Tencent at a time when they were expanding massively globally, and they did halt the approval of games. So, you know, we have seen this playbook before from regulators, and sure, you could argue that this comes at a time when the US regulators, European regulators are also trying to crack down on these Chinese tech companies. So it's probably a little of both. The reality is the government is increasingly going to keep a close watch on these companies as they grow more and more in scale.
Thank you so much, Akiko. Appreciate it. And to Miles's point, certainly the U.S. Tech companies are not trading today as though they are fearing that the U.S. government is going to take a cue from the Chinese government. Let's talk more about the effect on Alibaba specifically, as well as those singles day numbers. Let's bring in John Freeman. He is an analyst at CFRA who tracks the company. John, I do want to get to singles day, but I do have to ask you about these new regulations first. And the market reaction is pretty dramatic. Is it justified? Is this going to be a big curb on the company's growth?
I absolutely think so. So I think that, I mean, it's clear to me that Alibaba and Baidu both have, they trade at a substantial discount for a similar business that would be in the United States. And that's primarily because of the, let's call it the rule by fiat rather than rule by law principle upon which the Chinese Communist Party follows. I mean, that's been well understood and was kind of, forgotten and so forth when Deng Xiaoping's reforms came in and laid a foundation for, more of a rule of law, how to resolve contract disputes, all of that stuff. I think Xi Jinping has really look to backtrack on that and to reassert control. And I think that's not good news, right? For innovation, that's not good news for what we normally think of as free market operation. And frankly, we had a little bit of that here in the United States as well. Although we have a process by which all of these changes can be made, whereas the Chinese Communist Party, I mean, the day before Singles Day, they throw down this proposed changes and monopolistic practices. That's a pretty clear shot over the bow, and maybe even clip the side of the ship a little bit.
John, isn't the other problem here too that Alibaba, JD.com, I walk down pretty much any street here in the U.S., Alibaba who? JD.com who? These companies have not been able to diversify their businesses outside of China.
That's right. However, it does matter for, teachers unions and, all of the different public monies that go, that now invest in the stock market, right? And that, California Teachers Union, CalPERS, I'm sure has some significant position in Alibaba or other Chinese companies. So it, with the shares down, it also it will upset U.S. investors. But in terms of expanding into the U.S., there's not that. I look at Alibaba and I focus on the Chinese market and I focus on the cloud computing opportunity, which was outstanding this quarter. But I still have to keep a hold, and I reduced our target price from 305 to 280 just because a lot of it had to do with a lot of this increasing I don't know how to put it, aggressive anti-internet policies by the CCP.
Well, and I guess thinking about your price target and your rating, John, as an analyst, how are you even able, I guess, to really trust the numbers that you are going to get out of a company like this and trust the model overall, right? I mean, it seems like things could change at the whim of the government.
That's right. And people may have forgotten, there are some, if you just look at Alibaba's balance sheet or cash flow statement over, let's say, the last 5 years, there are all kinds of numbers moving all over the place. It is a really complicated, overly complex sort of capital structure. And I don't know if there are any financial shenanigans, but it certainly raises a lot of questions, and has always led me to, whatever trailing average multiple I use for the stock, I cut it by 15%, but just to build in all of that, to have all of that risk built in. I think Alibaba it's a fantastic company, very innovative, but it's speculative. The stock is speculative. If you're putting, if you're investing in Alibaba, you're really, I think, taking a greater chance than your average investor would be tolerant of.
I do want to ask about Singles Day, and I have to admit, John, I'm having a little trouble with the Singles Day numbers because they began at the beginning of November. So
Yeah.
how do we do sort of like for like here, and how is Singles Day going versus prior years?
Yeah, I think that it used to be more of a marketing event, where the hype itself would then sort of have an afterglow for weeks or months or whatever, and get more people interested in Alibaba, and more people sort of habitually spending on it, equivalent to an Amazon Prime kind of situation. But now it's just, I think they're just either pulling in or pulling forward sales that may have already, would probably already occur on the Alibaba platform, given that it has such a huge market share, right? And that COVID-19 is really the catalyst that has accelerated e-commerce relative to overall retail, right? In China, which is now, I think, something like last number, I think pre-COVID, was it like 38% of Chinese retail is e-commerce, compared to something like 15, 16, 17% for the US. So it does matter, but Singles Day, I think, is more of that kind of, I think it's less meaningful now.
Right. All right. Well, we'll keep watching it and see what effect all this regulation and proposed regulation has. Thanks for your perspective, John. John Freeman is an analyst at CFRA. Got to talk about some other movers as well this morning. A couple of companies out with earnings. Let's start with Lyft, the rideshare company, coming out with numbers after the close of trading yesterday. And the overall theme, Brian Sozzi, seems to be things are still very bad year over year, but getting better quarter over quarter as this year has gone on.
You nailed that one, Julie, and that was the theme on the phone when I talked to Lyft co-founder John Zimmer. In fact, he actually took me by surprise by saying Lyft is one of the best recovery stocks around. So it was interesting to me to hear him say that. But importantly here, the growth rates quarter over quarter in terms of rides up 44%. That is very important. Looks like they are still maybe running a little bit worse this quarter because of the rise in infections. But importantly here, and what I see a lot of people on the street focusing on right now, they pushed up some of their profit goals. They still expect to be profitable in the fourth quarter of 2021, but they plan to get there in large part, Zimmer tells me, by cutting $300 million in expenses by the fourth quarter. It's a lot of expenses to come out of this model, and has a lot of people on the street very optimistic. Also, they teased a delivery business. I don't think they'll be getting into a delivery business like Uber, but they teased it. So be curious to see how that unfolds.
Well, Saz, I wanted to ask about the delivery business because, the Uber story has become very strange to me. The Eats business is growing quite a bit, but it has horrific margins. I wouldn't call them horrendous. They're worse than that. The rides business for Uber is actually profitable, and I think Lyft can maybe benefit from being more of a pure play ride sharing type business. I understand it's kind of the flavor of the year here or whatever, but it's interesting to see Lyft talk so much about that on the call the way they did, essentially teasing that they might do an acquisition, because I know everyone and their mother has a fantasy football acquisition for them.
Yeah, well, Lyft essentially gets high marks on the street for its focus and discipline. That really reflects their DNA, a scrappy startup really competing against Uber. But it will be a focused delivery business. Again, details are scarce, but more local business-to-business transactions. They don't want to create a marketplace like Uber's done.
Yeah, it has been very interesting, to your point, Miles, to see sentiment shift on Uber's business model. It's good to be diversified. It's not good to be diversified. It's good to be international. It's not. So we'll see where that ends up. I want to check on Lemonade as well, the mobile insurance company that just came public earlier this year. It had a loss that was smaller than what analysts had been predicting. The shares are trading higher, less than 1% in pre-market trading now, and revenue was better than forecast. It also gave a forecast for the current quarter that was better than estimated. Now, remember, the company's IPO price was $29, and it's trading right now right around $65 or so. So it's still up considerably from that IPO price. But the insurance business, it's been an interesting one in terms of it falling into fintech. I don't know how much you guys have been following the whole evolution, if you will.
Well, Julie, you have to watch now, I think, Snowflake and Lemonade went public pretty much at the same times. The responses were meteoric. And I think this puts pressure on Snowflake to deliver something good. It will probably still be a loss for their first earnings report, but pressure on them now.
I think what's interesting about Lemonade, in addition to the IPO, as you mentioned, Julie, is like this, insurance would seem like a logical place for fintech disruption to come in. But if you kind of think about Lemonade's model of starting with renter's insurance, pet insurance, they're essentially targeting people like me who don't yet own a home. I will have much higher insurance needs in the future. They would like me to come in the door now, keep me for quite a long time. That's going to take some time to bear out. They had a line in the shareholder letter about how many of their customers are concentrated in California. Obviously, no insurer wants to have a lot of regional risk unless you're doing flood insurance, which is government guaranteed. They also had an emoji on the first page of their shareholder letter. Just a nice little millennial touch there.
Nice. Emojis and investor letters. I like it. All right, guys. When we come back, we're going to talk more about the trajectory for futures here. And also, we're in this period now between the election and inauguration day. What does that mean historically for investors? We'll talk about that next.
All right, welcome back to Yahoo Finance Live. Miles Sullivan with you in New York on this Wednesday morning. Let's take a look at where futures are right now, about 12 minutes away from the opening bell. We're looking at a higher open across the board. We've seen the Nasdaq under pressure a bit this week, but it does look like the tech index is set to open just about 1% higher. Let's talk a bit more about how to think about the markets now that we are, I think we can fairly say, in the interim period between presidential terms, though I'm sure the president would have something to say about that. Let's talk about what this means for investors. We're joined now by Jeffrey Kleintop. He is the Chief Global Investment Strategist over at Charles Schwab. Jeff, it's great to talk with you. Let's think about that transition period that you wrote about in a recent note, how markets tend to perform in this 70, 80 days between administrations. Are there any lessons to take away from history, and how are you kind of talking through this with clients?
There are a couple of lessons. I think the most important one to take away is that this period from election day to inauguration day almost always includes some type of major geopolitical development, meaning some country around the world, when they believe the U.S. is distracted, maybe internally focused, takes some action in conflict with US interests. We've seen this again and again and again going back over 50, 60 years during these periods of transition. And the markets freak out around them really depends on the economic backdrop. That's the second half of this. And usually when we're seeing the global economy in a long expansion, or even in the early stages of a recovery, as it was in 1980 and 1992, we see markets do okay, fairly well. They recover quickly from about a 5% drop tied to one of those events. Only when we're in the midst of a recession, as we were looking back in 2000 and 2008, do the markets fall on that geopolitical news and continue to fall over the period. So the two messages are: expect some type of development. I don't know where it could come from. China, something with Russia and Iran. In Syria, there could be something from Venezuela, North Korea rattling the saber again. All those issues are ripe for an event in the coming weeks, but the recovery is usually fairly swift after an initial sell-off when the global economy is in recovery.
Yeah, lots of contenders to create geopolitical tension. But I do want to pick up on the recovery or recession theme that you mentioned. It seems like the drumbeat is rising for a double dip, a W, whatever you want to call it, recession here, especially if we don't see some kind of stimulus from Congress. Where do you put those prospects, and then how are you factoring that into strategy?
So, looking at the overall economy, there's still a lot of weakness, and it's increasing in countries like France, which is now in what I call lockdown light compared to what they did back in the spring. Ireland's in the midst of a lockdown. Other countries in Europe are seeing this as well. There are states in the US that are imposing new restrictions. So we are seeing a renewed trend towards slowness in the economy, and I think that may show up in job growth as well. But what we're not seeing is that same thing reflected in the stock market. And there's a key reason for that. Manufacturing is booming right now, right? The service sector is the one that's still locked down: restaurants and travel and leisure activities. And they're going to remain locked down. But we're seeing manufacturing just booming as people are spending on goods rather than experiences. Manufacturing only makes up 17% of the world economy, only 11% of the US economy, but it's 50% of the market cap of the stock market. So earnings and stocks are tracking that booming manufacturing activity. One of the reasons why we're seeing more performance out of value shares lately. But that's not enough to stabilize the overall economic picture. So we need more stimulus from the government. We need more stimulus from the Fed to stabilize jobs in the economy. But the stock market is actually in a bit of a sweet spot and may continue to perform well despite this slowdown in economic activity in this race between the COVID infections and a vaccine.
Jeff, a COVID vaccine, should that start to be distributed within the coming weeks? Really, really big question mark here. Does that keep the U.S. out of recession?
It's hard to say. I don't think it's like flipping a switch. I think it can return some confidence. But remember, we've got to make billions of doses of this stuff. Everybody's got to take it 3 to 4 weeks apart. It's got to be held at negative 112 degrees Fahrenheit because it's a messenger RNA. And then you've got the fact that only 20% of people in surveys are saying they're even willing to take it. So it could take a long time before we get enough immunity that we don't need to engage in these physical distancing or mask wearing protocols or continue to see these types of effects in travel, entertainment, and airlines. So I think it could be until the latter part of next year, maybe the second half of next year, that would really begin to unlock the economy, even if we were to get a vaccine approved in the near term.
All right, Jeff Kleintop with Charles Schwab. You're going to stay with us through the break. Coming up on the other side of a short commercial, we're going to have the opening bell here on Wall Street on this Wednesday morning. We're back with that in just 2 minutes.
We are setting up for a higher open here at Yahoo Finance Live, even despite some headlines this morning that don't necessarily seem like they would be supportive for stocks. Among things that we are watching, COVID hospitalizations in the United States are now at a record high. Nearly 62,000 patients hospitalized yesterday, nearly 140,000 new cases. Indeed, if you look over the past week, the average number of cases per day was up 69% from 2 weeks earlier, still seeing a significant increase in cases and peak in cases in the upper Midwest. So to the point of what we were just talking about a few moments ago, yes, there's some vaccine progress, but it's going to take quite a while to roll it out. So something we'll continue to watch, and something we're continuing to watch as well, Miles, is the election.
Yeah, and Julie, just quickly on the vaccine and the COVID front, I think there was a headline yesterday about United adding additional capacity ahead of Thanksgiving holidays, and I know we talked about it very briefly in a Slack message this morning. I'm not really sure that Thanksgiving and Christmas should be the way that they traditionally are this year, but that news certainly makes it sound like it will be for a lot of folks, and certainly something we've heard health experts warn about quite a bit. But you mentioned the election, and we continue to see essentially the same grouping of headlines. Trump administration, says it's not over yet. Vice President-elect Joe Biden, or President-elect Joe Biden, former Vice President, he had a press conference yesterday outlining how they can't get access to some of the security materials you would traditionally see in a transition. Biden was asked if they're going to run out of money because the funding has not yet been released for the official transition group. And Biden's not really worried about all of that yet. And I suspect, Brian Sazi, as we get some of these states affirming the election results, of course, it is on a state-by-state basis. We expect that by mid-December, this will all be kind of wrapped up. Maybe we can move on. And I do wonder, too, if we were just so conditioned to talk about the election over the last couple of years that even though it is over, we in the media can't really let it go, because it's the story that we all came to know, love, and hate at the same time.
What are we going to write about, Miles? We're going to find something else. Maybe focus more on corporate earnings. And to that point, I'm watching the sell-off in Chinese stock this morning. Alibaba is the top trending ticker on the Yahoo Finance platform right now, with good reason. Again, like Akiko broke down at the top of the show, these new potential curbs on how these big giant companies, Alibaba, JD.com, operate is disturbing. And I'll tell you why it's disturbing. You go into Alibaba's annual report, they note risk from the Chinese government as a material adverse risk. If anything changes, Julie, in terms of policy direction, how they view their economy, they put any of this into play, it could really hammer a company like this.
Yeah, it's very interesting because the large cap U.S. tech stocks are not seeing any kind of spillover whatsoever. So there doesn't seem to be this concern that these regulations will either A, affect their operations in China, or B, kind of spread to the United States government, even though we've had a lot of talk and a lot of rhetoric about regulation here in the United States. The large cap U.S. tech stocks are not pricing in a regulatory scenario, at least not in the short or even medium term. So it's interesting, that dichotomy. Of course, over Alibaba still hangs the specter now of Ant Group, right? And that delayed IPO, and what is seen by many analysts as really a botched situation there with the delay of that IPO and Chinese regulators stepping in. So all of that in the mix here as we look to the opening bell here this morning, with futures still indicating here a higher open, and this real strength that we have seen in U.S. stocks that has continued ever since election day. We have had something of a rotation starting more into value and growth. So we'll see how much that trend can continue. And there, of course, is the opening bell here this morning. As I mentioned, we are seeing some strength in U.S. large cap tech stocks, the weakness in Alibaba et al. Notwithstanding. Jared Blickery is watching all the initial action here for us this morning. Jared.
All right, well, let's take a look at the Nasdaq 100, because it's a much different picture than we've seen over the last 2 days. In fact, you can see all the green populating right now. Apple's up over 1%, and the other FANG stocks, Alphabet, Facebook, Amazon, those are all up less than 1% right now. Netflix up about 0.5%. Looking at some of the biggest winners here, guess what? Zoom, Mercado Libre, Qualcomm, haven't seen those guys at the top of the leaderboard in days, but they are back. Zoom's up 5% here. To the downside, seeing some weakness in these Chinese stocks that we've been talking about. Trip.com down 2%. Pinduoduo down 1%, over 1%, and Expedia's down there too. Ulta Beauty, which has been on quite the tear, over the last few days. That's off about 1% right now. Looking at the Dow, now the Dow is underperforming just a little bit today, but we see lots of green here, and the industrials looking strong. We got Honeywell up about 2.5%. You can see it's really lifted off in the latter part of this chart, which goes back 2 months here. To the downside, some of the staples in the red. Coca-Cola's just barely off. JP Morgan just barely off. Let's take a look at the banking sector, because that had been on fire over the last 2 days, and we're seeing some strength in the overseas banks like HSBC. That's up 3%, but not a lot of movement here in the US. And now we'll look at the travel sector. So this is a reversal too. A lot of red here, but not too bad. We're looking at Delta down 1%, although American Airline and Norwegian Cruise Lines, they are in the green. Guys?
Thanks, Jared. Appreciate it. And to Jared's point, he was talking about the strength in industrials, which harkens back to what Jeff Kleintop was saying just a few moments ago about strength in manufacturing. Let's bring Jeff back in now. Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. And Jeff, I wanted to get your take, if I could, on big cap technology, right? And the sort of rotation that we started to see a little bit over the past couple of days that seems to be reversing to some extent. What do you think is the sustainability of the patterns that we have seen this year thus far, with large cap tech really carrying the rest of the market?
I think that is an outlier, actually. I mean, I know it seems consistent with the last decade, but that's why it's an outlier. We've started a new global economic cycle. New cycles and new market cycles always mean new market leadership. We never see the same group of stocks that led the last economic cycle, last market cycle, be the leaders in the next one. And of course, it was all about US tech stocks in the last cycle. I think what extended that through the early stages of this economic cycle, the early months, is COVID and the fact that we're all working from home. And so, these were COVID winner stocks, right? The ability to work and shop and all those things from home. That I think is shifting now to more of a broad economic recovery as we look out to next year and see, with the vaccine, this broadening recovery, lifting more value-oriented stocks, areas like financials, benefiting from a steeper yield curve, maybe less loan loss provisions, a lot of different parts of the market set up to lead going forward. And I think if you look at equal weighted portions of the stock market, equal weighted sector performance, equal weighted country performance, you can start to see those trends emerge. In fact, on an equal weighted basis, international stocks are outperforming US stocks this year, despite that US tech stock leadership. So I think investors would be wise to look at that in their portfolios and consider their exposure to those tech leaders, given that they may not be the leaders of this cycle.
Jeff, the positive news out of Pfizer this week on the vaccine, do you think that is the type of development that we will look back on and say, you know what, that was the start of a new bull market?
Yes, I do actually. I think when we look back to those types of events where you could actually see the sort of bright light on the horizon. I mean, look at what the airline stocks did, what energy did on these prospects for demand returning to the still shut down parts of the global economy. That's what we still need. Yes, we had a low point in terms of economic activity in April, but there's still these major parts of the global economy that remain shut down, and it's key developments like that vaccine announcement that you just pointed out. I think we'll look back and say that was a key element that started this rotation to the new cycle.
And Jeff, just finally, maybe like a more theoretical question here, but you mentioned the equal weight indexes. And so I think it's something worth bringing up. We go back to the last decade, so much discussion about flows into passive vehicles, essentially lower cost index type, situations. Are these the kinds of things that you're talking about with clients where, there are equal weighted factor tilts, these kinds of things that can be done very cheaply that are really those conversations in terms of portfolio construction? Is that where those things are headed these days?
That makes a lot of sense to me. I think looking to diversify your portfolio away from just these stocks that could have become a major dominant portions and now may underperform. One thing related to flows I think that's interesting is elections have often marked the turning point from outflows to inflows into equities. And as we see that in more, a rising tide lifts more boats than just the FANG stocks, I think broader participation in portfolios is important right here. So looking at those other types of vehicles and solutions that participate more broadly in the markets could make a lot of sense going forward.
Jeff, thanks so much. It's great to see you. Jeffrey Kleintop is
Thanks, Jeff.
Charles Schwab Chief Global Investment Strategist. And we should mention, as we talk about the broadening of participation, our Jared Blickery has been listening to the conversation and chiming in. We saw the S&P Global Weight Index reach records Monday and Tuesday. The Russell 2000 is taking its turn today, so small caps at a record as measured by the Russell. When we come back, we've talked a lot about a K-shaped recovery, bifurcation in the economy. We're going to talk about that specifically with regards to the restaurant industry when we come back.
All right, welcome back to Yahoo Finance Live. Miles Lee here in New York. We're about 8 minutes into the trading day. Let's take a look at where the market stands right now. We are seeing stocks higher across the board. As Julie just mentioned before we went to break, the Russell 2000 is at a record high. But among the three majors, as we see here on the screen, the Nasdaq is leading the way. We've seen the tech index underperform notably, really, over the last couple of sessions. And we'll certainly keep our eye on that as the day evolves. Let's turn our attention to what happened or is happening over in European markets today. Oscar Williams Group joins us now live from the UK for more on that. Oscar.
Miles, we're having yet another strong day here in Europe. Most major indices are in the green. We are seeing some tail off of momentum, however. The FTSE 100 here in London is the best performer, but it's up just 1%. Most other major indexes across Europe seeing gains of more of around 0.5%, which is notably lower than we've seen over the past two sessions. However, the sector rotation that has marked a lot of the last 2 days continues. For example, here in London, British Airways owner IAG is top of the FTSE as traders bet that this vaccine will herald a return to international travel. On the subject of the Pfizer-BioNTech vaccine, we've had news today that the EU has signed a deal to buy up to 300 million doses of the vaccine candidate. Pfizer CEO saying this is the largest order to date. I should also mention as well that we've got Goldman Sachs turning very bullish on European equities today. Their analyst said in a note that they think earnings per share for the Euro Stoxx 600 could rise by 50% next year and another 12% the year after that. However, that would still only just take us to pre-pandemic levels. Still a good sign nonetheless.
Yes, bullishness indeed. And by the way, that golden view extends to the United States as well, which we're going to talk about in just a moment. Oscar, thanks so much. Let's turn back here to the US and what we have seen in the restaurant industry, which is something that Miles wrote about in this morning's Yahoo Finance morning brief. And as I mentioned in the tease, Miles, it's really fascinating because there has been so much attention given to the closure of so many thousands of restaurants that look like they're going to be permanent on the local level, right? Mom and pops, whereas, fast food seems to be thriving.
Yeah, I mean, you look at the stock performance of a company like a Chipotle. You look at the major pizza chains, Domino's, Papa John's among them. McDonald's has had a great run. QSR, parent of Burger King, Popeyes, they've had a nice run here in the pandemic because they have the resources to give their staff PPE. They can keep the restaurants open. They have the capital to get through this time. But, a chart that we just were showing there, that's restaurant employment, full service restaurant employment here in New York City. It's 47% of what it was back in February. The restaurant industry here in the city has been decimated. And if you look at the results, kind of one of my favorite tricks here in business media, I think we all do it. You take company level micro news and you bring it out to a macro theme. And what we saw Monday of this week is we saw McDonald's with their best comp sales number in a decade in September, their best monthly comps that they've seen in a couple generations of management over there. Meanwhile, Beyond Meat, which we're going to talk to the CEO, Ethan Brown, later in the show, they had a tough quarter, and they particularly had a tough quarter in the food services part of their business. Revenue there was down 11% in the US. It was down over 60% internationally because a lot of Beyond's distribution to this point has been to independent restaurants, more forward thinking, more creative chefs who are willing to do different things with the menu, and Beyond and some other companies like Impossible. That's a big part of that strategy, but they're closing. We've had over 15,000 restaurants close since March permanently, notwithstanding the ones that remain closed in the interim. And so that really shows how if you're a big multinational, this has been great for you. Not only can you get through it because you have the resources, you're actually gaining share because some of your smaller competitors that I think we'd all prefer to go to one of those restaurants, they're closed and they're not going to be able to make it through the next 4 or 5 months with COVID cases with 25% capacity and without additional PPP loans, things like that to get them through this time because you just do not have the resources. If you're a restaurant that's doing maybe $1 million or $2 million in revenue a year.
Yeah, unfortunately not. And that all has implications for the jobs picture as well, which we will get into at another time. Thanks, Miles. When we come back, we'll be talking about the case that the Supreme Court is now hearing about the Affordable Care Act and the implications that has for the insurance industry. We'll be right back. You're watching Yahoo Finance Live. I'm Julie Hyman. Well, the Supreme Court is now hearing a case that involves the Affordable Care Act. Specifically, they're looking at the legality of the mandate that is in that act. And it looks like in arguments that what the various justices are asking the participants seems to indicate they are not willing to strike down the whole ACA, perhaps just the mandate. At least that seems to be the early read. But what is the read through for health insurance companies and the healthcare industry overall? Let's bring in David Tong now to talk about that. He's Argus Research healthcare analyst. So David, first of all, are you surprised by that sort of early read that we're getting on the case? And is this something that the healthcare industry was sort of prepared for?
Sure, Julie. Frankly, I wasn't surprised at the tone of the commentary from Chief Justice Roberts. I mean, after all, he led the court when it upheld the ACA earlier. And, he, in oral arguments, he said that, it's not really the role of the court to strike down the law. What is interesting is what Justice Kavanaugh said, that he would be able to find the individual mandate severable from the rest of the law, so that even though the taking the tax away, there really is no individual mandate, the rest of the law can stand. And it sounds like, here you have two votes from the conservative wing of the Supreme Court who would uphold the law, and that I think, at least maybe a 5-4 upholding of the ACA. And what are the implications for the insurance market, for insurance stocks? I think that it's a positive to have stability in the insurance market. More importantly, this will give the opportunity for the Biden administration to strengthen the law. There are things that they can do legislatively to improve affordability, to improve financial incentives for the state to expand Medicaid, and to improve affordability and tighten up, several provisions. So I think overall it's a positive, both for people who could benefit from insurance coverage, and also for the stability of the insurance market overall. And given the impact of the COVID-19 global pandemic, you can clearly see how important it is to have insurance coverage.
David, this is going to be the ACA debate. It's still going to remain very much top of mind next year. Is there one health insurer that stands to do better in this type of environment?
Well, one stock that we cover is Humana, and they are a leader in Medicare Advantage, and they also offer Medicaid plans where they're working with the states. So clearly, Humana is a stock that would benefit from a stability in the ACA.
And David, I guess thinking about the overall situation right now, and you kind of outlined it at the beginning, where we've got the pandemic going on. We have what's likely to be a contentious political period as it relates to the ACA going forward. How are you thinking about the broad universe of healthcare stocks right now? I know Brian just asked about, is there a specific name? But just with all these moving parts, how are you within your coverage area, just trying to pin down, which models may do better, which ones may be under pressure, and what the needs for, citizens as it relates to health insurance could be over the next decade or so?
Well, one area that I focus on is medical devices. And that sector saw, quite a pullback, back in March and April, because elective surgeries were down as hospitals focused their care on treating COVID-19 patients. The procedural volume has come back, hasn't all the way come back. There's some question as to whether the second or third wave, how that would impact hospitals. But it looks like the procedural volume continues to improve. And, we are seeing the, advent of robotics in surgery. That's something that will improve the technology and make these devices more attractive to hospitals. We're seeing the news that Stryker is completed the acquisition of Wright Medical. That strengthens Stryker's offerings in extremities, upper and lower. So that's certainly bullish. And give another question on the sector.
No, that was I think he was just asking you for thinking through these various sectors. So that's a good one to think about. We're going to leave it there. David, thank you so much. David Tong is Argus Research Healthcare Analyst. We'll get you back soon to talk about the implications for all these various subsectors within healthcare. And when we come back, we'll have more on that bullish call on stocks from Goldman Sachs.
All right, welcome back to Yahoo Finance Live. Let's go over to Yahoo Finance's Inez Ferre now for a look at how the market is trading here about 25 minutes into today's trading session. Inez.
And Miles, we're seeing a reversal with the Nasdaq from the last couple of days. Just take a look right now. You're looking at a lot of green on the screen. Those big cap names today are in the green. You've got Apple up more than 1.5%. Amazon, which was under pressure over the last couple of days, today up more than 2%. Microsoft also higher. When we look at the sector action, you're looking at technology and communication services, which are leading the gains. I do want to mention some trending tickers on Yahoo Finance. One of those being Alibaba. This is after China issued some draft antitrust rules, which you spoke about earlier in the show. Also, Singles Day, the biggest shopping day of the year, in which Alibaba started 10 years ago. Some preliminary numbers coming in for Singles Day, with orders for its e-commerce platform reaching $70 billion. Last year, it had $38.4 billion in sales. But remember that Singles Day this year included November 1st through the 3rd also. And then taking a look at Datadog after its quarterly results, Rocket Companies down more than 3% after its results. And then I just want you to look at Revlon, because Revlon today is soaring again, up 15%. Yesterday, we saw that it was up 45% after news that it may be cutting its debt load substantially. It just came out with a release. Additional bondholders are supporting its debt restructuring offer.
All right, and that's Ferre with the latest going on in the markets here in the early going. And that Alibaba Singles Day split period, still quite a few questions about that. We'll see where the numbers shake out as they come in through the day. All right, early this morning, headlines on the macro side grabbed by David Kostin over at Goldman Sachs. Brian Sazi, Kostin coming out, and if you want to say stocks usually go up, it looks like Goldman Sachs is your firm right now.
Yeah, how would they write this, Miles? 10 reasons why stocks could skyrocket. I pretty much have that story right now in Yahoo Finance, breaking this call down by Costin. I'll hit the finer points. Costin looking for S&P 500, 3,700 by the end of this year. That's up from an estimate of 3,600 previously. And for next year, ding, 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 here's the call from Costin, 4,300 year-end target now on the S&P 500. And here are a couple of his reasons behind this. He expects at least one vaccine to be approved by year end. Divided government, really just less policy uncertainty, a V-shaped recovery. Miles, I'm sure you could appreciate this one. He expects the Federal Reserve to stay on hold despite what looks to be a reinflating economy.
And Brian, it's interesting because he's not the only one, certainly. We've heard a number of more bullish sentiments sort of coming out from the street here. You always got to wonder with these things, are they leading or chasing, right? Because we've already seen this lift in stocks. We see people buying. And so, is it really stepping out in front of the train, so to speak, or taking a risk to say stocks are going to continue to go up?
Julie, they all want to be heroes. They all want to ride the momentum. So I'm not surprised amid the post-election rally, they come out and make these calls. But Miles, I think this underscores the point, how important the Fed remains to all this bullishness on Wall Street and really getting more gains in this market.
Yeah, and look, the call is fairly simple, right? The earnings outlook for 2021 and 2022 is constructive. And so all else equal, when corporate earnings go up over time, stock prices tend to go up. But there was a piece of research from Bank of America back in 2018 that I have referenced a million times in various morning briefs, various other pieces in Yahoo Finance, on the shows that I will bring up forever, which is that when earnings are up 10% or more in a year, 70% of the time the S&P is flat or down because stocks anticipate earnings growth. They don't react to it. We look at the performance the S&P has had off the lows this year. It's up 60%. No one's going to be impressed or surprised by 30% earnings growth, the S&P, next year. Everyone knows that is coming. And so we need to count on this multiple of the market being satisfactory because you're still essentially calling for more multiple expansion. Well, that's what the entire rally has been so far. So will be very interesting to see if that does indeed come to fruition. Just something I think for folks to keep in mind about how the market interprets information, so on and so forth. We'll talk about it in the year ahead. All right, coming up, we're going to have more here on Yahoo Finance Live on the other side of this break. The Dow moving into red figures here as we get settled into the trading day. We'll keep our eye on that. And we'll have more in just 2 minutes. All right, welcome back to Yahoo Finance Live. Miles Sutherland here in New York. 10 o'clock on the East Coast. Stock market's been open for about 30 minutes, just over 30 minutes here. And let's take a look at where things stand on this Wednesday morning. It is Veterans Day here in the U.S., so we do have bond markets closed. A little bit lower volume bank holiday in the U.S. The Dow right now is in red figures, off just 6 points, not a whole lot going on. Big story right now is the Nasdaq up over 1%. We have seen the tech index under some pressure here as the market settles in to this post-election trading rhythm. We've seen so much action out of the bank stocks, out of the industrials. Energy has been a huge winner here. And, we've seen that rotation again back towards some of those value areas of the market. Maybe we can call it the New York style investing winning again after West Coast really had the win for the last decade or so. We'll see how long that sticks around, but a trend that we have been watching very closely here at Yahoo Finance. Something else we are watching in less constructive news is what is happening with COVID-19 here in the U.S. Record number of infections, hospitalizations now at a record, and deaths, unfortunately, starting to rise in kind with those two, as many healthcare experts warned citizens over the last month or so. Anjali Kemlani joins us now for the latest on that. And Anjali, Monday, obviously a very constructive day for investors. I think it's a constructive day for everyone who wants the pandemic to be over. There's no doubting that. But the facts on the ground right now and what the data are telling us about the next couple months in the US, in Europe right now are quite troubling, perhaps the most troubling they've been since the beginning of the pandemic.
That's right. So unfortunately, we're seeing those numbers rise. We're seeing those restrictions in Europe and some being weighed here in the U.S. We know that in some states there have been reductions of hours, curfews implemented, et cetera, to go in hand with the rises that we're seeing in hopes that people will, in fact, revert to some of the social distancing and other practices that were implemented at the start of the pandemic. And all of this really in line to wait for the vaccine, to wait for treatments. We know we heard some really positive news on that this week, especially when coming from Pfizer with their 90% efficacy data, but really waiting to hear more about that likely in the coming weeks. But meanwhile, overseas, that's something that has been paid less attention to and really is important when it comes to this sort of global vaccine race. We know that nationalism is playing a huge role in the efforts, and that includes Russia and China. So today, Russia out with, just after Pfizer saying it's 90% effectiveness, Russia saying that theirs is at 92, but also some conflicting reports saying that some of those who did receive the vaccine did end up getting sick. And this, of course, is a vaccine, Sputnik 5, that we know is the Russian vaccine that is already being used, has been approved to be used, despite the fact that trials are ongoing, and really seeing sort of this push from countries like Russia and China into the global space where trials are taking place in other countries as well. Just this week as well, China reporting that its vaccine from Sinovac resulted in some adverse event in Brazil. And so that trial was paused in Brazil, though authorities have said that the adverse event is unrelated to the vaccine. And of course, we remember that adverse events have happened even with AstraZeneca and Johnson & Johnson, and those trials were paused for quite some time. So waiting to see how this all pans out. But as it stands, it opens the door, especially with nationalism at play and sort of countries, richer countries, Western countries, looking at keeping the vaccine a priority to themselves. Some of the middle and lower income countries are probably going to be looking at countries like Russia and China for vaccines. So very concerning, with some health officials saying that the data is not yet known on a lot of this, and it really remains to be seen just how effective they can be, considering the standards that they're following are different from what we're used to here.
All right, Anjali Kemlani with the latest on the coronavirus. Anjali, we'll talk to you later on this week.
Okay, let's get back on the markets here and bring in Stifel CEO Ron Kruszewski. Ron, always good to speak with you. I know you are very plugged into the markets. You enjoy talking about the markets. What do you make of this post-election rally? Do you think it's justified?
Well, I think it is. When you take the combination of the election and divided a government, just from the market's perspective, that takes off potentially takes off the table a tax increase, which would obviously impact earnings. And so I don't think that people are now thinking there'll be a tax increase. So that's a positive for the market. Obviously, the vaccine announcement on Monday was a huge boost, really to the credit markets. All the banks rallied significantly. So you're seeing a lot of ingredients that are bullish for the market. And one of the things you need to watch here, that this sounds technical, and I don't want to be too technical, but it's driving the market a little bit, is the real yield. And what that is, just think of it as the 10-year, which is about 95 basis points, less inflation expectations for 10 years, which is about 175 basis points. That means we got negative real yields, and that means that supports, PEs, and that supports the market. So you've got to watch that. If real yields come up, that'll take a little air out of this market, in my opinion.
Rod, are you concerned that the incoming administration won't be as friendly to the financial services sector as I would say the Trump administration has been as friendly the past 4 years?
Look, administrations have different views. For the most part, it's going to be in regulation. And so, of course, there will be changes in regulation. As I've been CEO for 25 years, have been through both Democratic and Republican administrations, and have been able to operate our business just fine. So while there'll be changes, I don't see anything really dramatic for our firm or for the financial services in general.
It's Julie here. It's great to have you on, Ron. I want to ask about how all of this feeds into your business, because as a financial institution, unlike, say, the big consumer-facing banks, you guys rely a lot less on net interest income. And so you haven't perhaps been hurt as much as we have seen rates where they are, at least not in that part of the business. But if you're right, and we're going to see real yields start to pick up, how is that going to feed through to your various lines of business?
Well, in general, I would take a step back. I think the real yield is I was trying to point to the market and how it impacts PEs, especially for growth stocks. As it relates to our business, what I really want you to think about is the amount of sort of reshuffling of the deck that we've done in the economy, and how much stimulus has been put into the economy, and how much has to be done to recapitalize industries that have been hurt, to restructure debt. We're talking about an infrastructure bill. There's a tremendous amount to do in the United States infrastructure. And when you put all that together and look at the amount of things that need to be done, as a financial institution, we're at the fulcrum between savers and people who need capital. And so we're busy, and we're going to be busy into the foreseeable future. So I think that outside of our NII, as an investment bank and a wealth management firm, there's a lot to do, a lot of uncertainty, yet a lot to do. So I plan on working pretty hard for the next few years, for sure.
Hey, Ron, it's Miles here, and I wanted to ask another question about a part of your business that really jumped out to me, which is what you've seen on the commission side with the brokerage business, the volumes that you and so many other of your peers have seen. Huge surge, obviously, through all the volatility, but there's been this sense that maybe folks are getting more excited about being involved in the markets, individual investors, things like that. Are those kinds of trends that you think might stick around longer term?
Well, a lot of that you're seeing on what you're calling the brokerage business is driven by the institutions that are repositioning their portfolio. So our institutional equity business and our institutional fixed income business has been elevated as again, you're seeing repositioning across the board from equities to fixed income. On the individual investor front, we're seeing the same thing. I think one of the controversies that's always in front of our industry is the difference between brokerage accounts and fee-based accounts. And in fact, that may be something that the new administration will look at again. It seems like we've been talking about this for a decade. But one of the things I want to point out that we're working on, and I would hope the industry would work on, is what I like to refer to as the democratization of private markets. I believe that individual investors should have an opportunity to invest in these companies that are pre-IPO, where there are a lot of gains being made prior to the public markets. And I think if we're going to talk about fair market opportunities for individual investors, we as an industry and regulators need to create an environment where the average investor can allocate a portion of their investable funds to private markets. That's something that I hope we really tackle so that everyone can share in these growing companies that are creating a lot of value and disrupting economies.
And I would make the argument, one of the reasons why your stock is at a record high, you've had a lot of success recruiting and getting a lot of really good talent into the organization. How is that going to change? Really one of the gorillas now in the room here is Morgan Stanley nearing a purchase of Eaton Vance. How is that war for talent going to pick up?
Well, I think that first of all, we've been growing for over 2 decades. We're one of the few firms that can say this. I'll probably jinx myself by saying this, but we anticipate this year being our 24th consecutive year of record revenue. There's not a lot of firms that can say that, and that is driven by our growth in people that have gone from 800 people to almost 8,500, and that's recruiting. And when I look at recruiting, our strength is that we combine great technology on one side, and we have to be that. Those are table stakes. But what advisors that are joining us like is that we believe in the entrepreneurial nature of an advisor. And so we let people do what they think is best. We don't have a corporate of course we have compliance, but we're not telling people what to do. We're allowing them to choose products. Firms like Morgan Stanley, obviously a great firm, and the purchase of Eaton Vance is a great move. I have a lot of respect for the firm, but advisors are increasingly, and have been for years, choosing Stifel because of our advisor-first model coupled with just simply great technology.
All right, let's leave it there. Stifel CEO Ron Kruszewski, always good to see you. It's been too long. Don't be a stranger. We'll talk to you soon.
I know. Have me back. I like talking to you guys. I love your interviews. You're very, very good interviews. So thank you.
We really appreciate it. It's too kind. Well, we already got you on the calendar. Okay. Thanks so much, Ron.
All right.
All right. Yesterday, while we were watching the markets kind of do their thing, Apple came out with their one more thing final event of the year 2020. Yahoo Finance's Dan Howley joins us now to tell us all about the latest MacBooks and really, Howley, what has been the year of the Mac for Apple, and a shift I don't think the company probably foresaw when we began the year. But I know the changes that the company announced yesterday are something that you see as a significant turning point here, a significant event for the business going forward.
Yeah, this is really a major deal. We talk about how 2020 is supposed to see this iPhone sales super cycle because of the 5G iPhone, the iPhone 12. There's 4 iPhone 12, so obviously that can help drive sales more. But the most dramatic product that they've announced is clearly this new piece of silicon. It's called the M1 chip. It's a system on a chip, and basically all that means is the central processing unit, the CPU or the processor that everyone normally talks about, and the graphics processing unit, which is basically a graphics chip, are on one piece of silicon. And they have their neural engine in there for machine learning. This is the same thing that they've been doing in the iPhone and the iPad for years now. But what's big here is Apple is making a hugely massive bet that they can turn those chips in a similar style to power the devices that require heavy-duty processing. We're talking about the MacBook Pro, the MacBook Air, the Mac Mini. Those are the devices that are getting this M1 chip. And why that matters is because they're ditching Intel entirely by 2022. And we've seen other companies try to work with ARM-based processors to power laptops, And yes, they've gotten great battery life, and Apple's already touting that, saying you can get as much as 18 hours or 20 hours out of the Air and the Pro. But what they haven't been able to do, these other manufacturers, HP, Microsoft, is make those ARM-based processors powerful enough to take advantage of what high-end users may need. And when we look at something like a MacBook Pro, a lot of people use them for things like video editing or heavy graphics applications. That's not something we've traditionally seen with these ARM-based processors. So Apple is really taking a big bet here. They say that these chips blow out current Intel chips by a country mile. We're talking about things like CPU performance, GPU performance, the aforementioned battery. Your MacBook Air won't have a fan in it now, so you won't hear that annoying wheezing whenever you're trying to watch Netflix for 5 hours while running one tab in Chrome, because Chrome is terrible like that. But the big to-do here is that Apple is making a huge bet on these chips. And I think if it pays off, obviously they eliminate that payment they have to make to the likes of Intel, $2.9 billion in 2019. But it also allows them to further customize macOS throughout the line, just because they're going to have the hardware and software. And then, that also means that all of the apps from iOS and iPadOS can translate directly to macOS. And that would mean millions upon millions of apps entering into that ecosystem and giving people an even greater reason to buy these devices. So I think the M1 is just a massive opportunity for them, but also a huge risk.
All right, Dan Howley, one word answer. Buyer's guide question here, holiday shopping. Is this MacBook worth getting?
I would say probably, yeah.
All right, probably, yeah, the 2-word answer from Dan Howley. All right, Howley, thanks for joining. We'll talk to you later on as we go into that holiday shopping season. All right, we're going to have more here on Yahoo Finance Live, and we're back with that in just 2 minutes.
This is Yahoo Finance Live. I'm Julie Hyman. We've got a mixed picture continuing for stocks, with the Dow trending slightly lower, the S&P and the Nasdaq higher. And we talked about earlier the Russell 2000 hitting a record high. It didn't stay there, by the way. It is now lower. Let's talk about what this post-election period now means for your portfolio, how you should be thinking about your personal investments. We're joined by Chris Mansky. He's a certified financial planner and author of the book, The Prepared Investor. And this discussion is part of our Financial Advisors Corner presented by PIMCO. So Chris, has anything changed substantially for individual investors after this election? Is there anything they need to be keeping in mind in terms of either the markets or perhaps the tax picture, given that it looks like we've got a President-elect Joe Biden, and as we try to sort of game out what his administration could do?
Well, I think in the big picture, there is very little change. As administrations come and go, a well-diversified portfolio is going to do what the owner wants it to. But in the tactical picture, there's definitely specific things that investors right now want to be thinking about. And I'd say the two biggest are, one, do your homework first. Things have changed a bit. I mean, right off the top of my tongue is the possibility of a new tax bracket. That's something that everybody is talking about. So make sure you've done your homework before you make purchases or sales. This December, probably there won't be anything changed before the end of the year, but by next December, there could be some changes. And then the second would be know the difference between what's happened and what still is to come. It gets really exciting to talk about getting a company like Pfizer in your portfolio after it has already jumped and everybody was excited about it. So be aware of what has already occurred and what is still to come.
And, Chris, you talked about doing your homework there, and maybe it's just that we're all too steeped in the world of business media where it seems like there's an endless amount of financial content out there. But I guess with clients you talk to, does it seem like folks are more informed in general these days, that the information that's out there is allowing the current or new generation of investors to have an understanding of kind of the basics here before they even come to a meeting with you?
Well, I think it's a two-edged sword. There's the joy of all the information at your fingertips. You can do a quick Google search. There's even people getting financial advice from TikTok these days. And this sounds a little bit odd, but it's also useful. At the same time that there's a lot of information, it can be overwhelming. There is those specific questions with specific answers that they're right at people's fingertips. And what's nice is the internet really is a leveling tool that you can use to your advantage. But if you end up spending 3 hours going into a rabbit hole, unable to tell the difference between fake news and what has already occurred and what hasn't, that's when it's probably good to bring in a third party and chat with them. And it doesn't have to be a financial advisor. It could just be someone you trust. Just get a friend or someone that you respect, that their opinion means something to you. And having that second voice makes a lot of difference.
Chris, there's been a lot of bullishness emerge on Wall Street after the election. How should an investor protect their portfolio that a lot of these strategists on Wall Street could be completely wrong?
Well, that's a good point. The idea that the market is not for certain going up or not for certain going down is not a new one. So that preparation that people need to make, it's not specific to this moment. It's just be prepared. In fact, I think that this is a lot like somebody who puts a spare tire on their car and they practice changing their tire. They're not doing that just because of that one day they're going to drive somewhere. They're doing it because they want it to always be in place. And it's the same with portfolio preparation. There are specific steps that really every investor can easily take to make sure that they're ready for the fact. It's not a question, the fact that Wall Street could be wrong. There could be bullish moments and there could be bearish moments, and it could go the other way. We need to be ready for it.
I don't know. We've been covering Wall Street for a long time. They're never wrong, Chris.
Never wrong.
Never wrong. Chris Mansky, thank you so much for your time. You're a certified financial planner and author of the book, The Prepared Investor, as we can see right there behind you. Appreciate it. Well, coming up next, Sazi's ready. He's pumped. That's because there's a new fake meat pizza out there from Beyond Meat and Pizza Hut. And we're going to talk to folks from both of those companies next. Let's get a quick market check of what is going on here. We are seeing stocks mixed right now. The Dow's off just over 0.1%. The S&P higher by 0.5%. And the Nasdaq up by 1.4%. Of course, we have been watching these stocks that are linked to what's going on in China. Interestingly, Alibaba shares are now higher in U.S. trading. This after are holding their Singles Day event, but also after we got a proposal from the Chinese government, new rules for antitrust regulations that will affect the likes of Alibaba and some of their competitors like JD. So it's interesting. Baba was sharply lower earlier and now has turned a bit higher. It's up right now by about 1%. In terms of some of the other trending tickers on yahoofinance.com, we're also watching Fubo TV. That company came out with earnings that beat estimates. Those shares are up by 21% right now. Lyft shares up 4.6%. That company too came out with earnings after the close of trading last night. As we talked about earlier, floated the idea potentially of getting into the delivery business like its competitor Uber, although it did not give any kind of detail around what that would look like. And Lemonade, the mobile phone-based insurance company, those shares are down 6% after that company came out with earnings. It just had its IPO several months ago. So those are just some of the trending tickers on yahoofinance.com. We're going to come back with one of the other perennial trending tickers on the site. That's Beyond Meat. Stay with us.
Hey, welcome back to Yahoo Finance Live. At long last, you can now get a pizza with plant-based meat on it. Pizza Hut and Beyond Meat are making this one come to life. Let's bring in Beyond Meat founder Ethan Brown and Pizza Hut interim president Kevin Hochman to discuss. Good morning to you both. Ethan, let me start with you. So when I saw this news, I see it's a national type of deal. It's limited time, but it is national. How does this move the needle business-wise for Beyond Meat?
Yeah, and first and foremost, I really want to comment on this incredible leadership we've seen out of Pizza Hut and the Yum Brands in the vision they had for this. They gave us the opportunity to work months after month on making the product as good as it possibly can be. So this is all natural inputs. It's all from plants. It's absolutely delicious, indistinguishable in my view from the pork sausage. And so it's something that I think demonstrates the ability for us to partner with a major brand on a national level and be very successful. The results so far have been amazing to see just the incredible interest among consumers. So I think it's a win-win for both brands and something you're going to see a lot more of.
So Kevin, this product has been out. It's two pizzas. It's been in the market for a little bit. What have you seen? What's been the customer response?
Well, yesterday was the launch of the Beyond Pizza. So we have a Great Beyond specialty pizza with Roma tomatoes and zesty banana peppers, crisp red onion, and then we have and obviously the Beyond Pizza Hut Italian sausage, and then we have just a one topping Beyond Italian sausage. The first day was great. We had unbelievable response all across the country. People really just wondering, is this really not real meat? And Ethan and his team have worked really closely with our chefs to really replicate that Pizza Hut Italian sausage flavor, whether it's fennel or garlic. And I got to tell you, it's hard to tell the difference. I was having my wife Ann taste it yesterday, and she literally said, "I think this is real." I said, "No, this is definitely Beyond." So we couldn't be more excited about what our customers are going to say and are saying about this pizza.
Kevin, I'm curious, we've seen certainly the Beyond products offered at other fast food chains. What kind of traffic are you expecting from it? Because we have seen that in some cases, right? When plant-based offerings come to, mass chains across the United States, it does create some buzz. How much actual traffic bump are you expecting? And do you think it'll be sustained?
Yeah, well, there's three things that we're going for when we launch, the Great Beyond Pizza and the one topping Beyond Sausage Pizza. The first one is obviously traffic, what you said, right? Now, I can't comment on exactly what our expectations are, but obviously we expect to get more foot traffic, more clicks, more orders online from this pizza. The second big thing is just check. I mean, obviously, this is innovation that customers are willing to pay a little bit more for, and that's what we're seeing with check with these pizzas. And then the third thing is really just about modernizing the Pizza Hut brand. We're on a turnaround right now to become America's favorite pizza again. And that includes, modernizing our digital estate, making it more frictionless to order a pizza, and then bringing back iconic pizzas that you can only get from Pizza Hut, where customers are going to come with more foot traffic as well as pay a little bit more for those pizzas. So this is very much another big milestone on the turnaround of Pizza Hut and getting back to being America's favorite pizza brand.
And then, Kevin, I guess just to follow up quickly on just broad trends that you guys have seen during the COVID period. A number of the national pizza chains have had great results, and I think customers have obviously been at home for obvious reasons. We'd all like to be at home less, but certainly the trends we're seeing in society that none of us want to continue have seemed to have been a net positive for a brand like yours.
Yeah, obviously, we're having a very solid year right now with more off-premise, more people eating at home in groups, which obviously lends itself really great to pizza. One of the things I'm most proud of is, customers are strapped right now, and we have to have great value every day. And whether you want to, come and pick up your pizza or get it delivered, you're always going to get an amazing value from Pizza Hut. So right now we're running our 3-topping Tastemaker pizza, which regardless of whether you carry it out or you get it delivered, it's still $10. And, that's not something some of our competitors can say. So I'm exceptionally proud of the great everyday value that we're bringing, as well as bringing new exciting pizzas like the Great Beyond Pizza.
Ethan, this one for you. How important is it that your name is on the Pizza Hut box? That in all these restaurants in the U.S., your name is there?
No, it's great, and I think it's an example of how we're leaning in together to do something transformative here. The resonance that our brand has with younger folks is so strong that I think this will really help as we begin to go out into the market with Pizza Hut and compete and become the #1 pizza chain in the country. And that's really the goal here. And we want to lend our brand to that effort so they can utilize it in a way that's beneficial to them. So I think it's a really important piece.
Ethan, certainly have to touch a bit on the quarter. It was a tough market reaction to the quarter. And we've talked in the past, I've come to only know Beyond Meat for triple-digit sales growth, that march to profitability, which you have hit this year. It's been a tremendous story, but something happened in the third quarter. And does it reflect more COVID-19? And once this goes away, Beyond Meat next year is back to growing triple digits?
It's absolutely COVID related. I mean, that's what people, I think, need to understand is there was an enormous amount of stockpiling in the second quarter among consumers in the grocery stores. And there was a long tail of that as that burned off into the third quarter. If you look at the fundamentals of our business, household penetration continued to increase, purchase frequency continues to increase, the buyer rate. So each household is now buying more. So in June, they're buying about $32. Now they're buying $36. So all of the trends, if you want to see, are increasing. My favorite is the repeat rate. Consumers are now, the repeat rate is about 52% for our products. That is extremely strong in grocery. And so all the right metrics are occurring. We grew 63% in retail. It's our second largest quarter ever in retail. So what we need to do is see the lift occur around the stay-at-home orders that have been burning off, and the ability for us in the QSR space to get back to where we were. Once you see that, you'll see that growth resume. So I'm very, very positive about what the brand is. And even though the quarter was a little bit difficult, you still see all those strong underlying metrics of growth.
Ethan, as you look at that balance between grocery and restaurant and food service, as we were talking about today, there's something like 19,000 restaurants in the United States that are not coming back, small restaurants. Pizza Hut strength notwithstanding, its comps up 6% last quarter in the US. Do you make up for those losses? I mean, those might be COVID-related losses, but if those restaurants aren't coming back, then some of that business, one can assume, is just not coming back. So can you make up for that with some of the national chains that are doing better?
Yeah, so first and foremost, I really feel for those small businesses, and that's the backbone of America, and it's tough to see. And 2/3 of our food service business is exposed to those smaller restaurants, as well as institutions like colleges and universities that are obviously not in full swing right now. But what's also happening is that brands that very intelligently and appropriately decided to streamline their menu or keep operations very simple during the height of COVID and the stay-at-home orders, are now beginning to do menu and product introduction. So this pizza launch we're doing right now is an amazing example of that, right? So we expect the strategic QSRs, such as Pizza Hut, to get much, much stronger as we move forward quarter after quarter. And I think it will take care of the issue you just mentioned.
Kevin, real quickly before I let you guys both go to eat these pizzas, why did you choose Beyond Meat?
Yeah, for us, it's kind of a no-brainer. There's three big reasons. The first one is that they're leaders in the plant-based space. So, we're not known to have credibility in plant-based foods, right? So the first thing you do is you go to the guys that are known for being leaders, and they're known for being leaders because their technology is the best. There's no GMOs. And then they're also willing to work with us on our proprietary recipes for Italian sausage, right? So we don't want to create just a sausage that you can get at the grocery store or any other outlet. We need to have something that's specific to Pizza Hut. The second thing is they're an unbelievably strong brand, instantly recognized, incredibly strong visual identity, and most important, they're trusted in the space. So you think about like the food industry where you're putting it in your mouth, you're putting it in your body, and it's a new trend. The only way that new trend really explodes is with companies like Beyond that have unbelievable amounts of trust. And the last thing I'd tell you is millions of Americans already eat Beyond. And so they're obviously going to look for things like on their pizza and be able to come to Pizza Hut. So they already have a built-in following, and they also have a ton of celebrity following that are making it more permissible to eat plant-based meat. So it honestly was a no-brainer. And of course, we want to have it large and proud on our boxes. That's a part of the proposition of partnering with Ethan and his team and Beyond.
Well, it's good to see one big national fast food chain. They clearly get it. All right, we'll leave it there. Beyond Meat founder Ethan Brown, always good to see you. And Pizza Hut interim president Kevin Hochman, good to see you as well.
Thanks, Brian.
Thanks, guys.
Thanks, Julie.
Thank you both. And as we leave you, just wanted to bring you a little bit of breaking news here. The Washington Post is reporting that the Secretary of State of Georgia is about to announce that the state is going to conduct a hand recount of the presidential race. A hand recount in the state of Georgia. I'll have to look up quickly what the margin was between the two candidates in the state of Georgia. Don't know how much time that hand recount is then going to take before the election results can be certified, but that was something that the Trump campaign had requested in the state of Georgia. Don't know if it was automatically triggered by the margin between the two candidates. So lots of questions that I'll get answered for you in the break, and we'll be right back.
Don't even know anymore, Tom.
All right, welcome back to Yahoo Finance Live. Miles Udland here in New York on this Wednesday morning. Well, Advance Auto Parts out with their latest quarterly results yesterday. The company reporting comp sales growth over 10%. Joining us now to discuss the quarter is Advance Auto Parts CEO Tom Greco. Tom, great to have you on the program. On the call, you called it the company's best quarter in 15 years. So maybe you could start by just outlining some of the dynamics that you guys have seen in your business through the third quarter that put you in the position to say that kind of thing to investors.
Yeah, well, thank you, Miles, for having me. And I couldn't be prouder of our team members and independent partners that put up the numbers. Obviously, they've navigated through this pandemic brilliantly. We put the health, safety, and well-being of our people first. And we've really seen strength on both sides of our business. We have obviously two businesses. We have a DIY business where you're seeing strength with people basically having time on their hands, repairing their own vehicles, washing their own vehicles. You hear that in the home improvement sector. And our professional business bounced back nicely too. We grew mid-single digits, which we're very proud of. So obviously a lot of dynamics going on in the marketplace overall, but a strong quarter for us.
Yeah, Tom, really strong quarter. But there was a little concern on the street on same-store sales coming out of the quarter. A lot of focus on what people are buying for the winter. What does the business look like right now?
Yeah, we still feel very strong, Brian. We've had obviously we reported mid-single digits quarter to date sales, which is still very good. You know, for us, we're very happy with that. I mean, our long-term plan is to perform at or above the market, which we think is about 3 to 4% growth over the long term. So we're still very much gaining share, which is important for us. And we're excited about the winter selling season. We've obviously acquired Die Hard, which is a great brand, and it's one that we're lifting back up. We had some advertising that broke 2 weeks ago on that. And when the winter comes, which it will, we'll see some real strength in our battery business as a result of that.
Tom, you guys withdrew guidance or stopped giving guidance earlier in the year because of the coronavirus pandemic. You're still not giving guidance. What would give you enough certainty around the outlook to be able to give those forecasts once again?
Yeah, I think, Julie, once we get clarity on a vaccine and what's going to happen in the work environment, work remote is obviously what's happening now around the country. And when people are working remote, that takes miles driven out of the system for our sector. And when we get a vaccine and people start to return to work and return to school and do all the things that we love to do, go to restaurants, you'll see that miles driven bounce back, and that will give us a lot more certainty in how to look forward. So it's really around that piece of it.
And then, Tom, thinking about that eventual rebound in miles driven, obviously a lot of folks have purchased cars often for the first time during this period. What's the expectation, I suppose, from your side of that exchange on how long it is before that person is, a customer of yours, not just one time, but hopefully, at least as you see it, on a recurring basis?
Well, we're very excited about that. I mean, clearly, as you said, some people have made the choice to get a used vehicle during the pandemic. We've seen a real surge in used vehicle sales, and that's right away beneficial for us because typically those used vehicles are off warranty, and that means they go to an independent garage or they're going to be repaired by an individual DIYer. And when that happens, we'll see a surge in our business. Typically, we call the sweet spot 6 to 12 years old. You know, that's when you see the peak of maintenance and repairs on a vehicle. And so as the vehicle fleet ages, that's generally very good for the automotive aftermarket. So obviously, we don't like new vehicles slowing in the short term, over the long term. But in the short term, it's actually very good for our business to see an aging fleet, and that means more repairs.
Tom, I can't figure out your stock price. We talked to you 3 months ago for second quarter earnings, blowout quarter. This quarter, 10.2% comp increase, highest in 15 years, operating profits up close to 35%. Why hasn't the stock responded to this? What are you hearing from the street? What does the street want from you? Are there places to cut costs?
Well, that's a good question, Brian. I mean, we're executing our plan. I mean, as exactly as it's been designed. Our goal is to rapidly expand margins, which we did, drive our comp sales at or above the market, which we did in the quarter. And we also generated a tremendous amount of cash as a company. I mean, our AP ratio was at an all-time high. and we will return that excess cash to shareholders. So we're going to just keep executing our plan, and over time, I'm sure the stock price will respond accordingly. But we're very pleased with our performance, and it's very much in line with what we're sharing with investors.
Tom Greco, CEO of Advanced Autoports. Tom, thanks for joining the program, and we'll be in touch next quarter.
Thanks very much. Thanks for having me.
All right. Well, the auto industry has had a very nice pandemic here. The movie business, of course, under a tremendous amount of pressure. Now, certainly folks do not want to go to the movies because of the pandemic. But Dan Roberts joins us now for the latest Yahoo Finance Harris poll, which suggests, Dan, there are some other issues facing the movie theater business that are beyond the pandemic, and I think quite troubling here, at least as I kind of scan the survey.
Yeah, it is troubling, Miles. And you know, I'm a movie theater guy, so I'm rooting for the future of this industry. But boy, it's largely COVID, and yet there are other issues. One of them, we know, streaming has exploded in popularity during the pandemic. That was already happening. But like many other things, and you know this is one of my favorite business stories during the pandemic, which things that have accelerated during the pandemic will stick around even once the pandemic is gone? And I think streaming is one of those. So in this Harris Poll survey, people were asked, if you haven't gone to an indoor movie theater since the start of the pandemic, and movie theaters have reopened in your area, why? You've got 56% of people saying concerned about COVID-19, fine. But this was multiple choice. You've also got 22% of people saying there was no movie I wanted to see in theaters. Well, that's probably pandemic related too, since so many big blockbuster movies were delayed. But then you've got a fair number of people, 20% saying, I would rather just stream movies online. And I think that is a concern for this industry. That is a secular concern. That is not just pandemic related. People saying, well, wait a minute, why do I need to shell out the money to go to a theater when I can just watch it in the comfort of my own home? Now, of course, I believe there's a lot of nice things about seeing in the theater. You know, you see a Marvel movie in the theater. There's a lot about the crowd experience, sharing it with other Marvel fans, but whatever. And then a third of people also saying that they plan, regardless of the pandemic, to go to movie theaters in 2021 less often than they did in 2019. So I think there's a few things this industry should be concerned about. Now, look, if you get a vaccine sooner or later, I think that helps a lot. But look no further than the recent headlines about AMC to see how concerned this industry is. AMC now offering 20 million shares, just filed to offer a new 20 million shares, looking to really rapidly raise cash because the situation is dire for these companies. Even this week with the encouraging news about Pfizer and a vaccine, well, it doesn't mean the pandemic is going to end next week. So it's going to take a while for things to bounce back. It's going to take a long time for people to feel comfortable going to a theater. And then obviously based on this survey, even once people do feel comfortable COVID-wise, they might just shrug and say, I don't need to go to a theater.
Yeah. And Dan, you mentioned AMC, which is obviously fighting for its life here and having a big cash burn. And it's interesting, you know, it's sort of happy with what it can get. It announced it is now expanding that pilot program where you can rent the whole theater for what, starting at $99, I think, depending on the movie that you're going to see. Because I guess $99 is better than $0.
Well, right, Julie, I love to say, do you want some money or do you want no money? But that said, the $99 headline is a little misleading. You pay another $250 fee if you want to bring in your own food. And you got to bring in your own food. You're not going to rent out the theater with a bunch of friends and not want to bring in food. So it ends up not being $99. Now, still pretty cheap when you consider the size of these rooms and that you're able to rent it out. And then, of course, depending on how many people you bring along, divide it up, probably not too expensive. But yeah, the company needs cash. And by the way, we should say this isn't just an AMC thing. Some of the other theater chains, including Aramark, and then also you've got Alamo Drafthouse, have tried similar things. You know, rent out a theater, $99. Get the cash wherever you can, because the situation for movie theater chains is dire. And one more point I'd like to say, I think a lot of them, just like brick and mortar retail, probably just overbuilt in the boom times. You know, I don't think theaters are going to go away forever, but you're going to see a lot of locations close.
All right, Dan Roberts, thank you very much. Appreciate it. We'll continue to watch those movie chains. I haven't been to the movies. I know you have. All right, I just wanted to update you on the breaking news that we told you about a few moments ago having to do with the state of Georgia. The Secretary of State there, Brad Raffensperger, said there is going to be a hand recount of the ballots there. The vote margin there is around 14,000, with Joe Biden having the advantage over Donald Trump. That's a margin of about a little more than 0.25%. The recount there then would be automatically triggered in many states. If there's a margin of either 0.5% or 1% or less, it triggers an automatic recount. The issue here is how long this recount will take. It would be unusual with a margin of 14,000, even though it sounds small, it is large enough. It would be unusual for the vote to go in the other direction once the recount is completed. Still, we'll keep an eye on it, and we'll be right back.
Welcome back to Yahoo Finance Live. Miles Upton here in New York, 1 hour, 25 minutes into today's trading session. Let's take a quick look at where the market is right now. Mixed day, the Dow in red figures, though just barely. The Nasdaq is the outperformer here. But Brian Sozzi, as we've tracked the rotation in the market over really the last couple of weeks, and particularly what happened in the last couple of days, energy has just been on an absolute tear. Now, granted, that's only 2%, I think, of the S&P 500's weighting. Granted, energy stocks have gotten killed for years, but I guess a nice consolation prize for everybody who comes on our shows and pitches energy because they're so cheap.
Right, Miles. I will say not a lot of folks right now on Wall Street are talking about energy. I think a lot of them can't probably read their financial statements of the energy companies. So why even bother mentioning them? But we have seen a pretty strong move in oil since the election. Before the election, it was about $38 a barrel, hit $45 a barrel today. We've also seen some big moves in the oil stocks. Look at ExxonMobil up 13% in the past 5 days. Schlumberger up 17%. Halliburton up 15%. We've seen some big, massive moves. And the reality is here, if you're bullish that a vaccine will help lift the economy, Julie, why not be bullish on oil stocks too?
I guess the question is, when will the economy be lifted? When will the vaccine be distributed? We are seeing rising chatter of maybe a double dip recession or a W, depending on who you ask for their description. The Goldman Sachs bullishness on stocks notwithstanding, stocks don't seem to have gotten the memo, or maybe they have and they've just shrugged it off. But there was a new Bloomberg analysis where they did news keyword density searches and found global mentions of the words double dip, as in double dip recession, went much, much higher. Torsten Slok, who we just had on the show last week, chief economist of Apollo Global Management, was out with a note this morning, also talking about a potential W here. So it's just something to watch. Obviously, we don't know if there would be a double dip recession, but certainly you have to track the economic data to see if there are any hints of that emerging.
and I can't remember who it was, guys. Maybe you guys will remember. Someone was on our program, it was yesterday, the day before, saying there's never been a double dip recession in the history of U.S. economic recoveries. And so it's interesting to see that come up. And I know, Julie, from your time at Bloomberg, those density stories, those density charts are always interesting. I love when uncertainty becomes one that flares up. Something related to Sazi's talking point on the energy stocks, they just wanted to call out is the banks. Obviously, today they're getting killed because I'm supposed to come on here and talk about how well banks have been doing. But through yesterday's close, the regional banks were up about 20% over the last 5 trading days. And if you look at, we have some of the majors up on the screen here, but you look what's happened to the KBW Bank Index, the regional bank index. Obviously, steepening yield curve is going to be a part of that. But if we can get an economy that gets back to trend faster than expected, most people, again, banks levered play on the economy. There's sort of your simple case for that there. All right, that's going to do it for us here on Yahoo Finance Live on this Wednesday morning. For Julie Hyman and Brian Sazi, I'm Miles Zudlin. Kiko Fujita and Zach Guzman will have you for the next couple of hours. They're coming up here right after this quick break.
Welcome into Yahoo Finance Live. Happy everybody. I'm Zach Guzman alongside Kiko Fujita. Today is the Nasdaq. It's in on the rally, up by about 1.3%. Today's biggest index gainer. The S&P up by about 0.5% today after Goldman Sachs boosts its year-end call and calls for 2021 a full-year return of 16% next year. But is that looking past some serious short-term chop as coronavirus cases continue to surge to new daily records? We'll dig into that question later on in the show with the top Biden coronavirus task force doctor who says America could be in for COVID hell this holiday season. But first, a record shopping surge shaping up for Alibaba's Singles Day, despite new anti-monopoly pressure hanging over the tech giant's head. Kiko, I know that you've been taking a look at that today as Hong Kong-listed tech shares across the board got walloped on that regulation risk. What are you watching there?
Yeah, I mean, let's start with Singles Day because you pointed to that $56 billion in what is the largest shopping day in China. That is nearly 40% higher than last year. So you could certainly say that was a success story, but a lot of that, to your point, has really been overshadowed by these draft rules that have been put forward by regulators over in China, cracking down on what they describe as these anti-competitive behavior by the major tech companies. And we've seen those tech shares just get hit. We're talking about $280 billion or more than $280 billion in market value lost over the last few days in names like Alibaba, Tencent, Xiaomi, and Meituan as well. Let's talk about what regulators are trying to go after, because there are some similarities between what we're seeing with tech regulators here in the US and what Chinese regulators are raising. One is the exclusivity clause, and this is something that we have seen the likes of Alibaba take part in, cracking down on platforms that force businesses into exclusive agreements. Also unfair pricing, which is something that has been raised, these platforms using individual data of consumers to determine on the same product how much individuals should get charged. And then there's also the concern about companies sharing sensitive consumer data. So it's been interesting to see the share reaction today, but the timing of this is of course no coincidence, because this came down just one day before the largest shopping day in China.
Yeah, also comes after that Ant Group IPO fiasco we saw play out as well. But interesting to think about how China is now right neck and neck with the U.S. in terms of this regulatory concern and question mark. As we see our own tech giants here in the U.S. face similar things, we're going to try and figure out how this is going to shape up. But when it comes to how investors should be looking at this, it's an interesting question. As we see tech stocks today back here in the U.S. enjoying an unusual turn of events in terms of kind of that relative rotation into cyclicals here. So with that question, I want to turn to our first guest today. Matt Miskin is John Hancock Investment Management Co-Chief Investment Strategist. And Matt, when we're looking at this, obviously, it seems as though a switch has been flipped when we got that vaccine news. A lot of investors looking forward to what could be a return to normal in 2021. But as Akiko is talking about here, this question mark hanging over tech giants' heads, not unusual, not unique to what we're seeing in China, what we're seeing here in the U.S. Talk to me about how investors should be looking at that question as they maybe shape up portfolios for next year.
Yeah, we do think that the technology companies, from a fundamental standpoint, still have a lot going for them. So the return on equity, the margins are great. They're seeing growth this year in a world where growth is really hard to come by. You do have this overhang as it relates to regulatory concerns. The question becomes, if the government does intervene in the technology space, how do they break them up? And is that really the most optimal way? I mean, go back to the AT&T days where the baby bells were broken up and then they came back together. Microsoft has been under scrutiny for years, and it's been hard to come up with a better solution than what the capital markets or the free markets propose. But this is a shot across the bow on a global basis coming out of China about the regulatory stance of governments and some of these huge tech companies.
I mean, to that point, Matt, the difference between what happened during Microsoft and what's happening now is that global crackdown that we're seeing. We're talking about China today, US as well, but just yesterday it was European regulators that came out and pressed charges against Amazon for what they deemed their antitrust or anti-competitive behavior. So how do you factor that into where some of these big tech names are trading right now? We've heard over and over the last few months, a lot of our guests say, look, that is something that's happening down the road. That's not going to be weighing on shares. Has that calculation shifted, you think?
Not in our view. We actually see that the tech companies will continue to see strong results. If you're trying to use government intervention into your process, it is one that has been failed investors over and over again. And you look in the U.S. right now, the fact that it is most likely gridlock suggests they're probably not going to agree on anything. And if that is the case, more likely than not, the government is on the sidelines as it relates to the markets. What's happening in Europe and Amazon, Europe has come after other tech companies as it relates to taxes. At the end of the day, those companies have survived and bounced back from these headline risks and these risks before. You look across the equity spectrum and you're trying to find the best businesses right now with good free cash flow that brings you to tech. So we continue to like the sector, even though there's been a mini rotation out of it just in the last couple of weeks.
Yeah, I'm glad you say mini rotation. One of the questions we've been trying to parse out over the last couple of days here on Yahoo Finance Live is really looking into whether or not that kind of rotation is coming more from maybe people who had been more focused on growth, or just coming from the fact that you got $4.5 trillion sitting on the sidelines here to maybe look at some of those beaten down cyclical stocks. So when you're looking at those relative opportunities across sectors, which ones are you really liking and kind of advising clients here to take a look at?
Yeah, so I mean, you don't need to be one or the other. I feel like nowadays, we just got past the election, and now it almost seems that an investor has to either be the reopening trade or the longer duration tech trade. In our view, you want to have both in the portfolio. So in our view, though, you want to have about 2/3 the longer duration, the technology, the quality stocks, and about 1/3 to the reopening. And the way that we're playing that is industrials. Out of all the cyclical sectors, we see industrials cheap. We see the earnings recovery developing, and they don't need higher interest rates to continue to outperform. So you got to have both in the portfolio. You want to right size it. We actually prefer biasing more to that quality tech engine. But you don't want to just say you're one or the other, because in time, both these catalysts will likely unfold, and you want to have both in your portfolio.
Matt, where do the travel names fit into your allocation? We've seen some of those stocks rally over the last few days, the airlines, the cruise liners, and yet the outlook seems so uncertain, especially because we're going through what some have called this third wave in the virus. That's got to be concerning for airlines too. I mean, do you think that investors should be buying into these stocks right now?
I mean, we would be much more diversified. So if you look at, for example, the industrial complex and mid caps in particular, there are some of those airlines. So Southwest is in there. There's other ones in the mid cap complex. You're going to want to pick the ones you think are going to survive this and make it through. There's probably going to be consolidation in some of these industries. But if you think about a broad portfolio of these industrial companies, there's a lot of different verticals across conglomerates. There's more in terms of, there's airlines, there's transports, there's different ways to play it. We wouldn't be overexposed to it, but if it's in a broader portfolio context, I think it's fine. You're basically putting a call option on a vaccine in the next couple of years on some of these industrial companies. You might have to be patient, but we do think it's a good part of your portfolio for that longer term reopening trade.
Yeah, there's also that risk in some of these companies maybe diluting the upside here with more share offerings to try and weather that short term. We saw that out of the cruise operators yesterday. But I wanted to get your take on Goldman's call too, because I mentioned it off the top, but they boosted their year-end forecast and especially pointing to a 16% potential return for 2021. How much of an important role should investors be placing on the Fed and the fact that they seem to be increasingly accommodated when it comes to maybe letting this rally run a little bit longer than I think a lot of people expected when this all first started?
Yeah, I mean, I see a lot of upgrades across the sell side right now, and there's nothing like price to increase sentiment. Now that everything seems awesome, we just came off a week of somehow managing through an election with little volatility. In fact, the market went up. Then we get vaccine news, and then you get all these upgrades, and we wouldn't chase that here. Yes, the Fed's going to be supportive, but it's hard to get incremental support out of the Fed. They've already done so much in 2020, $3 trillion on the balance sheet, cut interest rates to zero. How much more can they really add next year? To us, it means you've got to go and find the businesses that have the fundamental support, the cash flow growth in next year. And it goes back to that balanced portfolio of reopening trade and longer duration trade. Now, longer duration trade is okay in our view because the Fed's probably going to be unchanged for many quarters to come.
Yeah, hard to think of more catalysts there coming through on the Fed front. But Matt Miskin, John Hancock Investment Management, Co-Chief Investment Strategist, appreciate you coming on to share that with us today. Be well. I want to turn our attention back to Singles Day, though, because it looks like we're going to have ourselves a record sales tally there above 70 billion in terms of the pace we're seeing right now. I want to chat how big the sales event actually is with the vendor selling through on that. You know them well if you're well-versed in music. Fender Musical Instruments CEO Andy Mooney joins us right now. And Andy, appreciate you coming on. I know you've been involved in Singles Day for quite some time here, but I'll play the skeptic here in terms of saying how big are these one-day events really when it comes down to it. So talk to us about what you've seen through Singles Day and how big it is for Fender.
Well, our business overall in China has been growing at double digits for a number of years now, but our business with Tmall and Alibaba has actually been growing at triple digits. We've been involved in single days for the last 3 years, and it can represent as much as 25% of the annual retail business with Alibaba. So it's a big day.
Andy, one thing I want to get to here, because we are talking about Singles Day. Yes, it is the biggest shopping day, but this has kind of been overshadowed by what regulators have come out with over in China. And one of the concerns seems to be just the pricing of products, that there is, for example, with Fender, it would be a guitar that would be priced differently according to the customer and depending on the data that's on them. Have you seen anything like that? Have you encountered any concerns working through Tmall, some of these other platforms?
No, the presentation that we have on Tmall is a Fender branded presentation. We control pretty much everything that's on the site. So we determine the prices. They're the regular retail prices that everyone else would have access to. Singles Day, there's usually discounting done. So the prices are likely to be lower for anybody who shops on any brand on Singles Day, but there's no manipulation of prices that we're aware of by individual consumer.
And when we talk about, looking past Singles Day, I mean, obviously this is all coming during a pandemic. We've already seen e-commerce sales surge across the board, not just through Alibaba. We've been seeing that play out for most of the year. For you guys, though, what kind of boost have you seen tied to that? As I assume, myself included, people have a lot more time on their hands to maybe try guitar out, try a bunch of hobbies out. So what have you seen this year?
Yeah, when the lockdowns went into place in March, I never would have predicted in my wildest dreams that the company was going to end up having a record year. But in fact, that's what's going to happen. People really use their time to invest in themselves, and learning how to play a musical instrument, a guitar in particular, seemed to be near the top of their list. So we've seen an absolute tsunami of new players coming into the market, and our biggest issue now is just finding supply to meet the increased demand.
Yeah, Andy, what's interesting looking at some of your numbers is that it's not just on the lower ends or the new entry consumers that are buying up guitars. You've seen a big pop on the higher end as well. You said the only concern really is to be able to keep up with demand. How have you had to adjust your operations in light of the big boost that you've seen?
Well, in our own factories, we've had, of course, to put in protocols to kind of ensure the safety of our employees. So within our own factories, we're definitely seeing reduced output per hour or per man. And there is limitations to the actual quantity that we're going to be able to get out this year. On our kind of OEM supply, mostly from Southeast Asia, we've just been finding incremental capacity. And we've been able to do that quite successfully, but we're literally running at full tilt to keep pace with demand through the end of this year and the beginning of next.
Yeah, I mean, I'm more of a saxophone guy in lockdown myself. I tried to pick that up, but when we look at guitars, I haven't kept pace on the pricing that's come from this, but I assume, the additional challenges for you guys is adding to pricing pressure there. We've talked about inflation and the fact that more people are turning to actually buying physical products rather than services. So on the pricing front, what have you seen in terms of, I guess, having to increase the total cost to the end consumer here when it comes to guitars?
Yeah, there's no doubt that costs are going up. Labor rates are going up on multiple fronts: California, South America, Southeast Asia, and then the costs of production are going up because of the impact of COVID, again, without a doubt. So you're going to see some significant price increases from us going into the spring of next year.
And Andy, to the broader question, in an industry that you serve, there's a lot of questions about just how long it will be until people can go out to concerts again, how long until live events will return. What's your sense right now? There seems to be so much excitement around potential vaccine coming to the market, but are we looking 6 months down the line or even longer until we can go out to concerts the way we did pre-pandemic?
Well, I'm not sure I have a really great crystal ball on that, but we're optimistic that we'll see the return of outdoor live festivals coming around Memorial Day of next year. perhaps even the return of kind of modified indoor concerts around Labor Day. But we are already aware that all of the big acts, they are desperate to get back on the road. They're already planning their tours for spring of 2022. And actually even getting a large concert venue space for 2022 is becoming tight. So music will come back, live music will come back strong. And in the meantime, all of those artists have been locked up in their studios. You're also going to see a tidal wave of creativity get unleashed here in the back end of next year and the front end of the following year. And they've also been buying a lot of recording equipment. One of the things we've seen a boost in sales to artists, and we've also seen a big boost in home recording equipment. So the artists are not idle. They're continuing to create at higher levels than any time in history.
Yeah, and hopefully we get back to that soon, because these virtual concerts just don't hit the same, man. It doesn't sound as good, but I appreciate you coming on to give us that. Look forward to it. Andy Mooney, Fender Musical Instruments CEO. Thanks again.
Thank you. My pleasure.
Coming up, Lyft taking a bite out of food delivery. The company looks to tap into the growing market as its ride-sharing business continues to recover. We're going to break down the very latest quarterly results coming out of the company after the break. Shares of Lyft are getting a pop in this session. That stock up nearly 4% right now after the company reported a big increase in ridership in the third quarter as they continue to see that recovery on the back of the big drop we saw in the initial days of the pandemic. Looking through the numbers here, active riders coming in at 12.5 million now. Revenue per active rider at $39.94 there, and revenue coming in at $499.7 million. Let's bring in Tom White. He is a senior vice president and senior research analyst at D.A. Davidson. Tom, it's good to talk to you today. Looking through your notes here, you've got a buy rating on the stock still, a $42 price target. So it looks like you still see some more upside here. What do you think is going to be the big catalyst?
Yeah, look, so I think I think the vaccine is probably the most essential catalyst, but until we get broad distribution of that, I think there are a couple of things that investors are kind of tuned into and can keep pushing the stock up here. One is that we have continued to see a steady recovery in the ride-sharing business. It hasn't been momentously or overly robust, but it's kind of slow and steady recovery in the ride-sharing business. And in fact, We think Lyft is outperforming Uber a bit during this recovery. Their business, we think, was down a little bit less than Uber's U.S. ride-sharing business. It's hard to know for sure because Uber doesn't disclose that. But and then the other big factor is just this increasing confidence from the market that Lyft is going to be able to kind of honor their original EBITDA profitability timetable of the fourth quarter of next year. And I think that was really the main takeaway from last night, that, this company and the management team have really focused on controlling the one thing that they can control, which is costs. They've taken $300 million of fixed costs out of the business. They're focusing on variable expense efficiencies. And so I think people just really increasingly believe that these guys are going to be able to deliver on that profit timetable.
Yeah, that's what's interesting to me when you think about them trying to add this delivery segment to the business. Obviously, Uber's had that. It's kept them afloat here when we think about Eats versus rides for Uber. But for Lyft, I mean, how are you thinking they're going to be able to roll that out without additional costs here? And kind of what it might look like for Lyft if they want to start in retail and maybe expand to restaurants where we know pricing pressures already exist?
Yeah, so I'm glad you mentioned the retail piece, because I do think there's maybe a little bit of confusion from the market about exactly what Lyft's doing here. They are taking sort of a novel approach to the idea of delivery. Lyft, certainly, at least not initially, is not planning to be kind of a Grubhub clone or an Uber Eats clone that has sort of a consumer-facing app. You're not going to be scrolling through your Lyft app, looking through menus and ordering. They're trying to kind of take a B2B type approach where they partner up with local businesses and help them facilitate that kind of last mile delivery for online orders that maybe come directly to the local business through their own website or their own mobile app. And the initial focus really is retail. It sounds like restaurants can sort of expand into restaurants over time. But as far as the impact to kind of the numbers for next year, this is in a very embryonic state, I would say. It's very early. It sounds like very small. There will be some incremental investment that is baked into the EBITDA kind of timetable for next year. It's not going to be massive, but they're going to kind of dip their toe in the water here a little bit more. And if it turns into something positive and they see good growth, I presume they'll kind of lean into investment there more. But I don't think it's going to really upset the apple cart in terms of the margin profile or the profit timetable for next year.
Tom, when you think about Lyft and their messaging over the last several years, I mean, they've been pretty consistent that they are all about rides first. And yet this delivery component, yes, they're not going to this consumer-facing product, but I'm wondering how much of this is an admission on the company's part that, yes, they do need to offer more than rides right now in a very competitive environment. And to your point that you just made, even if it's in the early stages, how big of a driver do you think Lyft ultimately wants that to be because of just the amount of growth and the scale of the growth that we've seen in delivery over the pandemic?
Yeah, no, it's a really interesting comment that you made about, really the core focus of this company being all about disrupting transportation, right? If you think about one of the co-CEOs, Logan Green, this has been sort of his, his big focus since he was in college is really, disrupting personal car ownership, eroding personal car ownership, and so, the fact that we're sort of seeing a little bit of a pivot here is interesting. I think Lyft is going to approach the opportunity in a way that's consistent with sort of the Lyft brand, which is, I would say, probably more viewed as more sort of socially responsible and viewed as sort of being a better corporate citizen, maybe, than some of the other kind of big internet platforms. So, I think you're going to see Lyft talk about how they're, really going to be helping small local businesses compete on a level playing field with some of the big online platforms. As I said, this is not Lyft, at least now, Lyft not trying to sort of insert itself as an intermediary between local businesses and consumers and sort of take control of the relationship with customers, but it's Lyft kind of operating in this behind the scenes and effectively outsourcing its last mile delivery network so that local businesses can kind of compete on a more equal footing when it comes to their kind of digital presence.
Tom White from D.A. Davidson, good to talk to you. Thanks so much for your time.
All right,
We've got a lot more coming up on Yahoo Finance Live. We're going to take a quick break here, and we'll be right back.
Welcome back to Yahoo Finance Live. I want to highlight the action we're seeing here as the Dow swings back into positive territory, up by about 1/4% right now as we see energy and materials in terms of a sector by sector basis lead the S&P 500 in terms of sectors in the red right now. Energy off more than 1%. Want to get to those movers today, though, with Yahoo Finance's Ines Ferre in more detail. Ines?
And Zach, let's take a look at the Nasdaq, because that's really where most of the action is taking place right now, up about 1.5%, a reversal from what we saw over the last 2 days. So if we just take a look at some of the components on the Nasdaq, you're looking at quite a bit of green. You're looking at the big cap names, which yesterday had been under pressure, today are seeing green. Amazon up 2.5% today. Apple is up 2%. Microsoft up 2%, Facebook also higher, and Nvidia and Adobe higher as well. In fact, if we just take a look at PagerDuty, which had been in the red yesterday, up 9%, the best performer on the NASDAQ 100. Mercado Libre, which had also been under pressure, up 7% today. If we just take a look at the Dow, you can see that Disney is down more than 2%, American Express down 2.5%. Just looking at the sector action, technology is really leading the gains today, as well as consumer staples is up as well. Materials and industrials, those are lower. Those are the ones that had been seeing gains over the last couple of days. And if we just take a look at the travel sector, which has been quite a bit volatile. On Monday, we saw the travel sector really in the green. Today, you're looking at Delta down 2%, Southwest down more than 1%. Also, the hotels are lower as well. Looking at some of the trending tickers on Yahoo Finance, of course, we've been paying quite a bit of attention to Alibaba. I know you guys have mentioned this, but Alibaba, single day, the biggest shopping day of the year. They started this 10 years ago, more than 10 years ago. Some preliminary numbers that have come in with orders for its e-commerce platform reaching 70 billion. Now, remember that this year, Singles Day included some of the days also at the beginning of November. Looking at some other companies that are trending tickers, Rocket Companies down more than 3% after its quarterly results. And also, I want to take a look at Revlon, up 30% after announcing that it's nearing creditor support for a debt deal to avoid bankruptcy. It saw yesterday a gain of more than 45% on news that it may reduce its debt substantially. And I just also want to mention AMC, which today is in the red after filing to offer up to 20 million shares after a big spike on Monday.
Yeah, there you go. More of those names under pressure here, trying to issue a bit more shares for some cushion in the winter months. Some trouble ahead, perhaps, on the COVID front. But Ines Ferre, appreciate you bringing us that. We're going to take another quick break here on Yahoo Finance Live. When we return, digging into a lot of the question marks on the travel front, especially airlines, as Ines noted, potentially troubles ahead for them as well. Stay with us. We'll be right back after this. Welcome back to Yahoo Finance Live. Of course, the market's been reacting positively to the vaccine news we got from Pfizer earlier this week, but it's overshadowing a worrying spike in coronavirus cases as the nation continues to set new daily case counts here in the U.S. We've heard warnings from President-elect Joe Biden talking about why the next few months mask wearing is going to be rather important. But let's dig into that issue a little bit more here as one new doctor to that new coronavirus task force for President-elect Biden warns that the next few months here could be COVID hell. Joining us now is Dr. Michael Osterholm, University of Minnesota Director of the Center for Infectious Disease Research and Policy. And Dr. Osterholm, appreciate you taking the time. I know you're very busy here trying to parse out this kind of transition phase in terms of handling the pandemic right now. In terms of that front, what are you seeing play out here? And what are you trying to stress to Americans as you come on board here in this new task force to take over and trying to get this under control?
Well, first of all, thank you for having me. And in terms of the task force and working with the president-elect and vice president-elect, right now we really don't have the detailed agenda that's being crafted as we speak. So I would just say that there really is an effort being made to, first of all, be prepared to hit the ground running on January 20th. And number two, in the meantime, even though not in control of the government as such, what can we pull together and share with the states and cities out there that have often been left to their own devices in terms of trying to respond to this pandemic, so that in fact that kind of information and support can be there. So you'll be hearing much more, I think, in the very, very near term in terms of what the transition team is working on.
On that transition process, Doctor, we've heard a lot about some of the challenges other departments and agencies are facing right now because the Trump administration isn't necessarily on board with the transition as they look to these legal fights in individual states. From your standpoint, as you try to craft a more comprehensive COVID policy to take effect in January, how big of a hurdle does that create for you?
Well, I wouldn't say it's a hurdle yet. I can't comment on that as just as a member of the task force. I know that the leadership of the task force, as well as the staff and the transition team, are working on that issue. As you know, from listening to people like Tony Fauci and others, we've had, a fair amount of information exchange that already has occurred over the recent months, and that's continuing. There's a fair amount of transparency in that piece. It's just a matter of what the actual points are that will be made a priority. So I think at this point that will work out. And we surely, both as task force members and as our just everyday professional careers, we are already communicating with people at HHS on an extensive basis.
And Doctor, as one of those new members of the task force, as well as you said, just an expert in kind of getting this under control, I'd be curious to get your take on what you might stress to the task force in terms of changing some of the strategies we've seen fail under the Trump administration. Specifically, I'd point to what's playing out in El Paso right now. They went from 3 mobile overflow morgues there to 4, now 10. The city, despite having only under 700,000 people there, has more cases, more hospitalized patients than some states. And we've seen, officials there grappling, the mayor battling the governor, battling the county judge, and all this. What are you looking to do differently when it comes to actually implementing some changes to protect Americans?
Well, the first thing that has to happen is we have to have a story to tell America. We have to be able to explain to them what's happening. This is the virus versus us. This is not the virus versus one group of politicians versus another, one regional area against another, hospitals versus what goes on in the community. This is us versus the virus. I said yesterday that we are entering this period that I call COVID hell. Back on Labor Day, we were at about 23,000 cases of new coronavirus infection every day. Today, we're going to be in the 130s to 140,000 again, and that number is going to keep rising rapidly. And, we've been predicting this. It's a combination of pandemic fatigue, people just being tired of trying to, avoid the public and the places that put you at increased risk, pandemic anger. We're up to a third of the U.S. population doesn't believe this pandemic is real to begin with, so why adhere to any kind of public health recommendations? And then we just have indoor air. We have a situation where going indoors right now, we know that virus concentrations build up inside and transmission is much more there. So we have to tell the story of what's coming. People don't want to hear that El Paso isn't an isolated event. El Paso, in many instances, will become the norm. And, we have healthcare systems right now that are overwhelmed already right now. And we're talking about potentially doubling the number of cases over this time period before the president-elect even takes office. And so I think that the message is, how do we get through this? We need FDR moments right now. We need fireside chats. We need somebody to tell America, this is what in the hell is going to happen. And this is what we got to do about it in a way that they believe it, they understand it, they feel it, and they see that somebody's trying to lead them. And that can be anybody. But I believe that the transition team surely is placing the president-elect in particular to help guide us. And his message has been very clear. So just understand, everyone on this screen will know a COVID-related event, either in yourself or your family or your colleagues in the days ahead. If you haven't had it happen already, it's going to happen. There won't be any blue or red states anymore. There won't be blue or red counties. It'll be COVID colored.
Doctor, to that point, we've seen a number of states over the last few days move more aggressively in placing restrictions, implementing restrictions. We had Utah with that mask mandate earlier this week. Now we've got these reports suggesting that in New Jersey, schools could close down from the end of this month into January. How effective can these policies be state by state in the absence of a federal mandate?
They're going to have some limited impact. But let me just come back to a point, because this has been, I think, a very confusing issue, and that is lockdowns. If I interviewed 50 people today in the U.S. for what they define a lockdown as, I could get 75 different answers. And I think that one of the challenges has been that there really isn't an understanding of what a lockdown is all about. We talk about the pain and suffering of the virus, but the pain and suffering to the economy and what it does. I'd refer everyone back to an op-ed piece in early August that Neil Kashkari, the president of the Minneapolis Federal Reserve Bank, and I did in the New York Times. Number one, we predicted where we'd be right now. We said this would happen if we did nothing different. Number two is that when you look at the personal savings rate in this country, it's now gone from about 8% to over 22%. We have a big pool of money out there that we could borrow at the historic low interest rates by the federal government. We could pay for a package right now to cover all of the wages, lost wages for individual workers, for losses to small companies, to medium-sized companies, for cities, states, county governments. We could do all of that. If we did that, then we could lock down for 4 to 6 weeks. And if we did that, we could drive the numbers down like they've done in Asia, like they did in New Zealand and Australia. And then we could really watch ourselves cruising into the vaccine availability in the first and second quarter of next year and bringing back the economy long before that.
Well, Doctor, I really wanted to quickly ask you before we let you go about the vaccine push here too, because that's going to be key for your task force. And when we look at that, there are increasingly worries that Americans just might not want to get the vaccine. When you think about polling at 50% of Americans roughly saying that they wouldn't want to get it. Talk to me about the incentives that the task force is going to have to work with to maybe push Americans to get it out there, since we know it's important to getting this pandemic under control. What do you see playing out?
Yeah, that's absolutely critical. Particularly when you look at the fact that this virus infection has disproportionately impacted the Black, Indigenous, and communities of colors out there. It has. We have to understand that they also have reasons not to trust things like vaccines. So while we all want all Americans to be vaccinated eventually, we're going to have a hard time getting some groups who may be at the highest risk. And so we have an urgent need to begin educating the public about these vaccines, what they can do, what they can't do, about their safety. Again, telling a story. We need to tell a story. And, we can't go from day to day, from crisis to crisis. How are we going to get to the point of protecting our country and the world? It's going to be getting to vaccines that are safe and effective, and it's going to take a while to get there. So what do we do in the meantime? And that's, I think, what is the immediate issue right now. And what I think all of us need to work towards is, how do we help Americans? How do we help the world get to a time when we will have adequate supplies of the vaccine and not have to have, thousands and thousands of deaths before that happens.
Yeah, we'll see how that goes. But the new member of Biden's task force here, coronavirus task force, challenged with exactly those goals. Dr. Michael Osterholm, appreciate you taking. We're going to take another quick break here on Yahoo Finance Live. We'll be right back after this.
Welcome back to Yahoo Finance Live. We are watching shares of American Airlines right now, down about 0.7% on the back of a report from Reuters saying that American Airlines will resume flights to China from the U.S. in the coming days. Reuters citing a source from the Department of Transportation there saying this will increase the total number of U.S. flights to 10 per week for American Airlines. Also, we got that announcement from United Airlines saying they will resume flights from JFK Airport here in New York City. Certainly a lot of questions about how the airlines can pick up some of their business as we go into what is typically the busiest travel season over the next few months. Let's bring in John Grant. He is a senior analyst at Aviation Data Specialist at OAG. We also have Alexis Keenan, who covers the airlines for us here at Yahoo Finance. John, let me just start with your outlook on where the airlines stand right now. This is sort of typically the month where the airlines would be looking for a very, very busy holiday season. How does that look right now, given this most recent surge in the coronavirus?
Incredibly quiet. An amazing amount of capacity being put into the US market, particularly domestic flights, by all of the majors. But in terms of bookings and activity, it's still relatively quiet. Plenty of deals out there, cheap fares, and it's not going to be a classic Thanksgiving for the airlines, that's for sure.
John, now most U.S. airlines, not all of them, have added seat capacity for Thanksgiving week. And I want to show our viewers on the screen what that looks like. We have Delta adding for Thanksgiving week compared to this week, 300,000 flights, Southwest adding 500,000, Spirit adding 217,000. But then we have American decreasing its capacity for 200,000 seats there, and United Airlines decreasing but remaining relatively flat. Now, do those numbers, do they suggest an increase in demand? Is it wishful thinking by the airlines or something else?
I think it's wishful thinking, really, Alexis. It's a really strange situation we have at the moment. The global market, global capacity has fallen since September quite significantly. In Europe, for instance, where I am, we're seeing airlines flying 30% less capacity than they were 2 weeks ago because of the lockdowns. And I think what you're seeing American and United doing is balancing capacity to what they expect demand to do. And the other airlines are still putting more capacity in the market. I suspect as we get closer to Thanksgiving, there will be consolidation. There will be more flights that are being merged into one. And, that capacity will continue to disappear all the way down to Thanksgiving Day because there just seems to be too much capacity. It looks like it's overheating.
Now, this time of year, starting in the US with Thanksgiving and then going all the way through internationally through the new year, this would typically be a really strong revenue season for the airlines. So how important really to the bottom line is this time frame, this November, December, January timeframe for the airlines?
It's pretty important because you get a good mix of business travel. So you've still got the corporate high-end, front-end traveler out there, and you've got all of this leisure stuff that suddenly appears that is flying domestically and internationally. Well, that's not there at the moment. Corporate demand has been suppressed. So we don't expect to see that coming back, certainly until the back end of March, perhaps in 2021. So average fares at the moment in the United States are anything up to 20% below the level they were at this time last year. So we have this sort of double whammy of fewer people traveling, and those that are traveling are paying less than they were paying this time last year. It's not good news for the airline industry, which is why we saw that big spike in stock prices for many airline stocks around the world when the vaccine was announced, because suddenly airlines and investors are thinking, come the summer, there might be a return.
Certainly a reminder that there's still a very long road ahead for these airlines as they look to try and bounce back from the lows here. John Grant, senior analyst at Aviation Data Specialist, OAG, and our thanks to Alexis Keenan as well for bringing us that interview.
You're welcome.
Coming up, the battle here between gaming giants Microsoft and Sony's PlayStation finally here with the rollout of the next-gen gaming consoles. We'll break down who has the best chance to win right after this. Welcome back to Yahoo Finance Live. If you know a gamer out there, perhaps it's your offspring. They're probably stoked by the new release of the next-gen consoles between Xbox and PlayStation out with their consoles now. We've talked about this being a big battle between the two giants, but it could perhaps be one where both sides win. Let's break that down here with Yahoo Finance's Dan Howley, along with Brent Thill, Jefferies analyst who covers the space. And Brent, I'll start with you here because that is the question mark. Obviously, there's been a lot of demand in lockdown in 2020. Talk to me about what you're seeing play out as both these consoles come to market.
Yeah, this is a really exciting cycle. When you look at the Xbox, it's already sold out in the pre-orders. I've never seen a pre-order sold out. Why can't you just take a ticket and say, hey, we're going to fulfill? So we've had multiple conversations with Microsoft. Why not open up this even broader? But I think they're trying to create the velvet rope outside the New York nightclub to say, hey, like there's more people outside to create the excitement. So no question, pent up demand. We're all locked in. Listening to your previous guest from the University of Minnesota, it sounds like we're going to be locked down a lot during the winter. So gaming activity is going to only escalate, and the category itself is growing across demographics. And so we think ultimately, when you look at this, you've got a sold out situation on the pre-orders. For gaming, for Microsoft, it's only 8% of the revenue. It's a lower margin business, but it is creating nice recurring revenue in their Game Pass and Xbox Live subscriptions that we continue to believe that investors, love what they're doing here. Many thought they would punt this business many years back, but it's good that they stayed, and their largest acquisition to date, now year to date, is in the gaming space.
And Dan right now is juggling both, I believe, over there. Dan, what are you seeing when you have them in your hands?
Yeah, so I do have the Series X right here. This is it. It's just a big block, basically. Microsoft essentially said we're going to put the best we can as far as performance into a box, and they did just that. And then in my other hand is the PlayStation 5 right here. This is essentially the wackiest design I've seen out of a console. And the thing is, the reason for the size has a lot to do with the cooling, because the performance out of these is supposed to be worlds better than what they have right now in the current generation systems. And the more power you put into something like this, the hotter it gets. That's just how processing goes. And so a lot of what you're seeing out of the size of these is just fans. But I do, I want to ask you, Brent, I guess as far as these consoles go, we're talking more and more about cloud gaming. Microsoft, obviously, part of the appeal of the Series X is that they're going to have their Game Pass as part of it. And with that, Game Pass Ultimate, where you'll be able to play some of your Xbox games or all of your Xbox games eventually on your smartphone or your tablet. You won't necessarily need one of these. So do you think that this is the last generation where we'll have these absolutely, I'm trying to lift it up with my other arm, these absolutely massive consoles? Or do you think that they'll continue to go on for some time soon?
I think it's we can't definitively call if this is it, but we do think it is coming to an end. And the power of the cloud with Microsoft Azure is effectively powering this. So we think when you look at the commercial business with Azure and what Azure's been able to do, one of their biggest reference customers is the Xbox business in riding that kind of demand. We think from a technical capability, they're actually able to do this now going forward. We think that there is a lot of pressure. Amazon, Google, a number of the other cloud providers are getting into this. And we think, again, when you look at the largest deal that Microsoft did this year at $7.5 billion was in gaming. It wasn't even in their core enterprise business. So I think what it shows you is they want to own more of the content. They want it to shift to the cloud. And they want it to be, to your point, ubiquitous, where my kids could be on their phone, they could be on a console, they could be on a computer, they could be anywhere. And we think that vision is playing out. So my sense is this is probably it. But again, I think there is a hardcore gaming community that will still be wedded to these devices for quite some time.
Brent, we've heard more and more that the kind of subscription model that we've seen from the likes of Netflix is what we're going to see in gaming moving forward. And, we got that announcement from Facebook getting into gaming. We've got Google as well and Amazon. And how do you think some of those players are positioned when you look at where the growth is going to be in this space? And ultimately, where does that leave a company like Sony?
Yeah, I don't cover Sony, so I can't really talk to that, but I can talk to Facebook, Snap, and the rest of these vendors. So even you look at Snap's adding video games to their platform, and what we call snackable forms of video games, where you have 5 minutes between a Zoom call and you want to play a quick game to clear your mind. You're sitting waiting for a bus. You're in an airport, right? Those lightweight games, I think, are becoming a lot more attractive, and we've seen that continue to grow as a category. So we ultimately think that these vendors are all jumping in, and there's going to be diversions, right? We think Microsoft and Sony will own the hardcore gamers, and then the social platforms can own the lightweight gamers. So you want to play a game of backgammon with your mom in a remote situation, great, go to those platforms. So we think there's a real divergence, but ultimately the categories are big enough to support multiple vendors, and the overall growth of the entertainment industry is there to support both these angles that both companies are taking.
Yeah, nothing wrong with backgammon with the mom. Got to say, it might be a little bit different out there, but we'll see how the new console launches shake out. Brent Thill, Jefferies analyst, Yahoo Finance's Dan Halley. Appreciate you both.
We've got a lot more coming up on Yahoo Finance Live, including a conversation with J. Michael Evans, the president of Alibaba, and what is their biggest shopping day of the year. A lot more coming up ahead. We'll be right back after this quick break. Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Zach Guzman. It is noon here in New York City, 2.5 hours into the trading day, and we are seeing stocks green across the board here in terms of the major indices. The Nasdaq seeing the biggest gains, certainly as expected, perhaps because of the sell-off that we saw over the last few days and the rotation out of tech. The Nasdaq up 208 points right now, the Dow up 63, and the S&P 500 up 29. Alibaba is shattering its singles day sales record, but shares are trading lower as China's new regulation rules create concern for the company's outlook. Our very own editor-in-chief, Andy Serwer, speaking to Alibaba Group President Michael Evans straight ahead. And also virtual home buying, how millions of Americans are purchasing new homes without ever walking through the door. That's all ahead here on Yahoo Finance Live. But first, let's get to the markets. We've got Neil Shah, who is Senior Portfolio Manager at Peak 6 Capital Management. Neil, it's great to talk to you. Tech, certainly the big headline we're watching today, especially the news coming out of China and those draft rules that came out on potentially anti-competitive behavior from the big tech names. And then, of course, we've been watching the tech sell-off over the last few days. How are you looking at that space right now, especially in light of the regulatory environment, not just in the US, but around the world?
Yeah, so over the last couple of days, you've seen a rotation take place in the market. You've had tech stocks take a beating. You've had your traditional value stocks get a big uptick, and that was kind of the vaccine news basically drove that, right? The question is, what's going to happen going forward? Today, you're starting to see the tech stocks come back a little bit. But the question again, is that going to be sustainable? The biggest headwind for tech stocks, yes, it is regulatory going forward. It's not like tech stocks are like egregiously priced at the moment. But again, you do have those regulatory headwinds. I think the biggest catalyst going forward that I would be looking forward to is the Georgia runoff, right? If you get a Democratic sweep, then can tech stocks be in a little trouble? Absolutely. But that could also create a great buying opportunity if you're a longer term investor.
Yeah, and when we look at kind of when you say tech stocks aren't incredibly overpriced here, it does raise questions about opportunities in the value sector as well. And I know you've been focusing on some of the beaten down names through this, Boeing being one of them. Talk to me about how even the pop that we saw with the vaccine doesn't necessarily mean the opportunity for investors to get into some of those names is past us now, as you said, if you're a longer term investor focusing on that.
Yeah, as far as value stocks goes, this is really the first uptick. And are you first uptick as in this is the first time they had a good move up? Are you looking to sell into that, right? I think if you're selling and taking profits, you're giving up on some great returns that could lie ahead. If again, the vaccine gets embraced by everyone, we get everyone vaccinated and people come back, the economy gets back to normal, then I think value stocks are significantly underpriced.
Neil, you mentioned the Georgia Senate race. It seems like the market is pretty much priced in a divided government, and many investors see that as a positive to sort of keep the most progressive policies that the president-elect Joe Biden has put forward in check by Republicans. What happens if Democrats actually win those seats? Could we see a pullback?
Yeah, I think that's the headwind that I've talked about, and I think you could see a potential pullback. But in the end, can anything significant come out of that? I don't think so. I think if you look at the Facebooks and the Googles of the world, which they're really going after, those stocks, even if they do get split up, like the sum of parts at the end of the day is probably worth more than a standalone company as it is right now. If you were to split up WhatsApp out of Facebook or Instagram out of Facebook, at the end of the day, sum of parts, those stocks could be worth more.
Yeah, we always hear that kind of relative breakdown, the names there and what those risks might mean. On the flip side, though, you've got some other names you could talk about there. We're going to be discussing Apple in just a second here. But if there is one that you would lean on in terms of those regulatory risks not posing as huge of an issue, which one would you look at?
Yeah, I think that Facebook is kind of one that could survive this. Facebook also has gaming platform. It has the Libra currency, the cryptocurrency, which that goes through, which could be big. There's a lot of catalysts ahead for Facebook. And Facebook is not just your work from home stock, it's a stock in both worlds.
Neil, how are you looking at this most latest wave of the coronavirus and how that is likely to impact the economic recovery? We had Dr. Michael Osterholm earlier on today. He's part of the Biden task force. And Zach and I were saying, he certainly didn't try to calm fears here, saying that we are in the midst of what could be a 3-month COVID hell. He also didn't rule out lockdowns altogether as well. Do you think that the market is being a little too complacent about the potential for more stringent restrictions being reimposed?
Yeah, at times I ask myself that same question. I think the market does get complacent at times. People think it's going to be, it could be potentially be just a Santa Claus rally at the end of the day. You could get potential fiscal stimulus along with monetary stimulus from the CBs. And, if those things, if all the stars don't line up at the end of the day, then, stocks could get a big hiccup before things get better, because COVID is only going to get worse as we, again, approach the holidays and people have get-togethers and so forth.
Neil Shah joining us from Peak 6 Capital Management. It's good to talk to you today.
Great. Thank you for having me.
Let's turn our attention back to Alibaba shares. They're seeing a slight pop here in the session, up about 1.3% on those big numbers coming out of Singles Day over in China. $56 billion, a new record for the company. But That news slightly overshadowed by what we heard from Chinese regulators in their attempt to crack down on some of the big tech names over in China. We've got our very own Andy Serwer standing by with Alibaba President J. Michael Evans. Andy.
Thanks a lot, Akiko. Yeah, it is a big day for Alibaba, their annual Singles Day on 11/11, and delighted to bring in Mike Evans, president of Alibaba. Mike, how are you doing over there? I know it's late in the day, but things going well?
Doing very well, Andy. Thank you very much. And just a quick correction for Akiko, it's $74.1 billion US dollars, not 54.
Well, 10 billion here or there, you know.
Actually.
I know it's a lot. It's 20. It's a lot of money. So tell us how that number, this is the gross merchandise value, which is the metric you guys use. What exactly is that number, Mike, and how does it compare with previous years?
Well, that's an 11-day number. Okay, and that's different than what we did last year. Last year, the number was 38.7 billion. But this year, we decided to do something different for a couple of reasons. First of all, merchants, particularly in China, needed more time to prepare and to get ready to profile their new products and new innovations. And consumers, we felt, would need more time also to browse and decide what they wanted to select. And a number which we haven't disclosed yet, which I'll tell you though, is that we have 2.25 billion packages that we need to deliver coming out of this year's shopping festival. And so we were also trying to take the pressure off the logistics system in China, not just our own, but all the couriers and the delivery people, trucks, everything. So there are a number of reasons for changing it, and therefore it's not a completely like-for-like example. But I think the most important message that comes out of it is that we are in a post-pandemic market in China where consumption levels are phenomenally strong and where almost every category has returned to pre-COVID levels of activity. So this is a demonstrated example of the huge power of the Chinese consumer to buy brands in China and from all over the world.
Wow, it's so amazing to hear that phrase, post-COVID economy. And the number of packages is pretty amazing too. I guess it's time to release the drones, Michael. I want to ask you about the U.S. and how this figures into what's going on here, because it's historically been the U.S. has accounted for the top 5 in terms of merchants on Singles Day. Where does the U.S. rank this year?
Well, the U.S. this year is the single largest contributor to the shopping festival of all countries outside of China. So the number as of about an hour ago, we're not quite finished tabulating the final number, was north of 5 billion US dollars. So those are products sold by US brands, small businesses, retailers, and even farmers to consumers directly on our platform. So this is an extraordinary result for the US. And I think it reflects 2 things. First of all, most of these brands, and there were thousands of them in the US, understand that a part of the future growth of their companies is going to be the China consumer. And the second thing that they've all experienced is that while last year 135 million or 140 million Chinese people may have left China to travel the world, they're not traveling the world this year. So they're sitting at home and they're buying the products that they would have bought from American companies in China. So this is one of the reasons why we've seen such a big boost in the numbers.
That's fascinating. I remember you talking to me, Mike, last year in Davos, Switzerland at the World Economic Forum and basically telling me that this coronavirus pandemic was coming. How has Alibaba responded? And are they now sort of matching the post-COVID economy as you describe it in China? Are you now moving beyond? And is that the same as it was before?
Well, Andy, it's really interesting. While I didn't really predict the pandemic or even that it would be called COVID-19, I was concerned, and I did express it to a number of people, including you, that this could be much bigger and much more dangerous than people understood it to be. And this is rooted in our DNA because of what happened to Alibaba during SARS. So under the leadership of our chairman and CEO, Daniel Zhang, he did an absolutely brilliant job of marshaling the team and the resources to do three very important things. The first was make sure we look after our employees. So everybody went home. And that was part of the government quarantine. But they went home and were able to work from home because of the way that our business is digitalized. The second thing that we did was we looked after the 11 million small businesses on our platform, because none of those small businesses had the capability to look after themselves. So what does that mean? What did we do? We lent them money through Ant Financial. We cut our commissions that we charged them on the platform. We helped them find temporary help. We helped them digitize their offline operations so they didn't have to remain closed month after month, which would surely have bankrupted many of them. And then I think once we felt that they were stabilized, the Jack Ma Foundation, the Josiah and Clara Tsai Foundation, the Alibaba Foundation, we kicked into gear to deliver 200 million units of PPE, ventilators, test kits to 150 countries around the world. Why did we do that? We did that because it was the right thing to do, given the manufacturing capabilities in China. But equally important, we have businesses in many of those countries and employees and offices in many of those countries. So we felt that would be how we could make a contribution at a very difficult time globally. And we, of course, people like me and others worked with Governor Cuomo in the state of New York, which was so badly hit by COVID initially, but also helping other states and other governors deal with their PPE requirements as well. So this was a huge effort and arguably a big distraction from our business, but it was also an investment in the future of what really matters to us and to the brands and merchants on our platform.
Michael, Akiko mentioned the regulatory crackdown that seems to be occurring in China from the government and directed towards technology companies. Can you comment on that?
I don't know whether I'd use the term regulatory crackdown. I think, for example, what Ant has experienced is quite typical of what you would see anywhere in the world, which is an industry, financial services, in a state of high and quickly evolving innovation, where the regulator also needs to evolve and adapt and adjust the regulatory environment. So I don't think this is unique to China. I think you see it everywhere. And I think the key is that we need to be in close collaboration with the regulator, and then we need regulatory transparency before we can move forward, and so that everybody knows what rules we're playing by. On antitrust rules that are, or proposals that have just been put forward, it's very early days. Those proposals are out for comment till the end of November. It's going to take some time before we get clarity on that, and it's probably not the best use of time to speculate on what the outcome is going to be.
As a North American executive in China, which is a rarity, do you sense that the environment has changed and has become more difficult for Western companies to operate there and partner, say, with Alibaba?
No, on the contrary. I think it continues, particularly as we tell the story year after year at 11/11, but we also live the story 364 days in the rest of the year, onboarding brands, onboarding merchants, dealing with all the issues that people worry about in terms of IPR and infringement, making sure that we can provide fast logistics and safe payments, technology solutions to the extent that offices are closed because of a pandemic or any other reason. And I think people are getting more comfortable that, notwithstanding the difficulties with geopolitics, there is a trade channel between the United States and many other countries of the world for brands and SMEs that they can take advantage of, that they can navigate safely, and that they can build a fantastic future for their companies. Not the only channel, but a very, very critical channel. So if you don't have a China strategy as part of your plans for the future, that's probably going to be a problem.
Michael, we should be getting a new administration here in the United States starting January 20th. And I want to know what you think about the rivalry between the United States and China when it comes to technology platforms and technology companies. I mean, you know, we had one internet, one technology world only maybe 5 years ago, and now it seems to be much more bifurcated. Do you see that continuing between the two countries?
It's hard to know what will happen. And I think it's very difficult to make predictions on this. So what we've decided to do, what Alibaba is very focused on, is focus on the core strategy in the US, which is to connect all of those great brands, all those great products to the Chinese consumer. Last year in 2019, this is a number we disclosed, we sold $40 billion worth of American products to Chinese consumers. This year, we will probably disclose again at the end of the year an even bigger number. So the point is that we have to be able to look after our most important customers here in the US, doing the only thing we really do in the US, which is to support connecting them to the Chinese consumer. And irrespective of where the geopolitics go, that's great business for the US and US brands, and it's great business for the Chinese consumers.
Yeah, speaking of the Chinese consumer, Mike, last question here. What is the future looking like for those individuals? What are Chinese consumers going to be looking to purchase and their consumer activity going forward?
Well, first of all, just to comment on the big picture numbers. We now have 800 million of them on our platform. 400 million have now emerged into the middle class. More of them are heading in that direction. You saw the third quarter GDP print in China at 3.9%, or 4.9%, excuse me. And so the economy is doing well. The middle class is growing. And the availability of products from all over the world is still there. So I love to highlight one of the best examples, which is a US small business, Fender, which is the guitar manufacturer. That business does phenomenally well in China because in the COVID environment, people have had a lot of time at home. So great opportunity to buy a guitar and learn how to play it. So I think the Chinese consumer, of course, will buy lots of Chinese brands, but they will never stop buying the great American and European and Australian and New Zealand and Korean and Japanese brands because it's super high quality products, reasonably priced and safe. So there's a great future ahead for the US and many other markets.
All right, we'll be looking for the next Jimi Hendrix coming out of that.
Coming to you.
Yeah, right. Alibaba Group President Michael Evans, thank you so much for your time.
Thanks, Andy.
Back to you.
Thanks so much for that, Andy, and our thanks to Michael Evans as well, joining us from Alibaba. Zach.
All right, we're going to take a quick break here on Yahoo Finance Live. When we return, though, digging deeper into the big event there held by Apple as they announced and unveiled their M1 chips designed in-house as they break from Intel. We'll chat that with the former CEO of Apple, John Sculley, joins us on the other side of the break. Stay with us. Welcome back to Yahoo Finance Live. I want to spotlight shares of Apple right now, up more than 2% after their big rollout of Macs with their new in-house designed chips. The company unveiled the anticipated M1 microchips to enable faster performance, better battery life, perhaps even bigger profits after shifting away from Intel chips. Of course, the hardware update follows the new iPhone rollout and updated wearables with the focus on health earlier this year at Apple too. So joining us now to break it all down in terms of Apple's new endeavors is John Sculley, who led Apple as CEO for a decade and current CMO and chairman of RX Advance as well. John, it's good to be chatting with you today. First up, just want to get your take on the momentous shift away from Intel here and what it signals to you as Apple clearly has now a lot on its plate.
Well, I think Apple's making very smart moves. As we all know, Apple doesn't usually care about being the first, they care about being the best. So for years, they have lagged about 18 months behind Samsung in terms of technology like the latest cameras inside of the iPhone. But this new microprocessor that is homegrown at Apple is a really big deal because as Apple has focused on security being important, particularly in healthcare, the fact that they can do so much on board on an iPhone, now they can do it on a Mac. That's a big deal. And particularly as we see things like video and online gaming and many of the really big growth areas in healthcare, of course, having Apple's use their own microprocessor, not dependent on Intel, not dependent on Samsung as much as they had been in the past, that's a big deal. And you'll see that playing out throughout the decade, I believe, in many new types of capabilities and services from Apple.
And John, on those microprocessors, that really just the latest step from Apple to try and fortify its ecosystem. You talked about healthcare. That's certainly been a big growth area for Apple. We saw the most recent Apple Watches being able to measure blood oxygen levels, very timely with what's happening with the pandemic. As you look at that particular segment for Apple, where are we in the growth story for that? Is this just the beginning? How much growth do you see moving forward from here?
Well, Tim Cook has said publicly a number of times that he believes that perhaps the greatest legacy of Apple could well be in healthcare. And I think it's going to go well beyond what Apple has done so far with their very successful Apple Watch. Let me kind of zoom out and give you a context. I've spent the last 14 years largely working in health tech. And the thing that I think about is that we have a U.S. healthcare industry that is approaching $4 trillion. About 85% of that spend, of that almost $4 trillion, is with chronic care patients. And so it's really a sick care industry. And so when big tech, whether it's Apple or Amazon or Google or even entrepreneurial companies think about it, they are starting to focus on not the sick care, but they're focusing on the fact that about 75% of chronic care diseases are reversible. The type 2 diabetes, reversible. Sleep apnea, reversible. Certain types of heart ailments are reversible. Obesity, reversible. So what the real opportunity for technology, and Apple is obviously a leader at this point in health tech, is to say, how do we focus on preventative and wellness care as opposed to just sick care? And then you can start to play in the importance of health tech and technologies and what the digital economy can play in healthcare. So that's what really gets me excited. And particularly about things like when you think about government policies with the new administration coming in, we've started to see telehealth has become a serious business. Now Teladoc is having acquired Livongo. It's now a $40 billion market cap company. And it's doing about $2 billion of revenue now. And it's the leader in telehealth, but there's other companies like Amwell and MD Live, which are growing incredibly fast. All of these companies have had an acceleration of growth during the pandemic. People couldn't have face-to-face appointments with their doctors. Well, we're just at the early days of telehealth. It's less than 10% usage today. It's estimated by many people by later in this decade, it'll be over 40%. So I wouldn't be surprised to see companies like Amazon and Apple and Google looking at telehealth and looking at remote patient monitoring, which means digital, of course. And there are things that the government can continue to do in terms of putting a priority with rules and regulations to make it easier for telehealth to become as broadly adopted over this decade as fintech has been over the last decade.
Yeah, and John, I mean, on that opportunity, when you look at it, having led Apple before, do you think that the way the company is structured now under Tim Cook is good enough to have them capitalize on that opportunity you're describing? Or do you think that right now the company might need to acquire some of these people who are already working intensely, specifically focused on healthcare rather than developing some of these things internally?
Well, Apple has never grown its company through acquisition. It does acquire, lots of little companies. I think over 200 companies in the past decade have been acquired by Apple. But these are relatively small acquisitions, several $100 million. The one exception was Beats, where they had to get into streaming music quickly. But I think for the most part, Apple will continue to build its own businesses. I don't think it's going to change the way it does. It's organized vertically. It has incredible talent, but it takes its time. It's in no hurry to do things, but it wants to do things better than anybody else. And I don't see why Apple would move away from that formula.
John, let me ask you another question that is hanging over the tech space as a whole right now, which is, what does this tension between the US and China really mean for the tech sector? We've certainly seen it very elevated under this administration. We've got another deadline coming up on potentially TikTok getting banned. But now you've got the Biden administration coming in, which hasn't made very clear how they're going to approach this. How do you see this relationship evolving, and what does it ultimately mean for innovation on either side?
Well, I think the reality is that China is going to continue to be very successful. There's a 100-year journey that China has been pretty articulate about. By 2049, the 100-year anniversary after Mao Zedong started what is now the current China Communist Party, that they intend to largely replace many of the Western institutions that were created after the Second World War, like the IMF, like the World Bank, like NATO and things of that sort. But that's not going to happen in a military sense. It's going to happen, if it does happen that way, it's going to happen over another couple of decades. So the reality is China is drawing their boundaries of the parts of the world that they want to have more dominance in, like the South China Sea. The U.S. and China are going to get along. I don't think we're going to see any military actions between us. But the reality is that we have to learn how to coexist. And I think that the Biden administration is much more experienced than the current administration on how to play that particular strategy out. And I suspect that even though there'll be tensions over different issues between China and the United States, I suspect that we'll learn how to get along a lot better. In the tech world, we already are getting along. I mean, look at companies like Adobe, that is incredibly successful, but they have very close ties back to China, which helps them move beyond their original business of doing tools for various types of creative tools. And now they are in many dominant areas and become a major global company. And we'll continue to see cooperations, I think, between Chinese companies and American companies. They just won't always be in the headlines.
Yeah, and Apple, certainly one of those companies is benefiting from those mutual relationships as well. But John Scully, privileged to have you on to chat all that today. Thanks again for joining us.
Thank you very much.
Coming up, Zach, we're going to be talking about the strength in the housing market. New home buyers looking to buy without even looking at their next home. Sarah Painter is going to join us with that story on the other side of the break. Welcome back to Yahoo Finance Live. Just 3 hours into the trading day, we are seeing tech stage a comeback, if you want to call it that, especially after the big sell-off we've seen over the last few days in the rotation out of the sector. The Nasdaq now up 216 points, the Dow up 69, and the S&P 500 up 30 points there. One of the big bright spots in this economic recovery has been the housing sector. Certainly a lot of competition out there with new home buyers trying to get in on very limited inventory. And now, increasingly, these home buyers looking to buy their next home without ever viewing them. Sarah Painter is here to bring us that story. And Sarah, you've talked a lot about just how competitive the market is right now, but where are we seeing this? Is it on a national level? Is it really confined to individual markets that have been especially hot?
Hey, Akiko. So, yeah, we're seeing a lot more people buy homes without actually seeing them, just relying on virtual tours. And a lot of the time that happens when people are moving to a new state. So we have a lot of suburbanization right now, people moving from cities to maybe now that they can work remotely, they want to live in Colorado or, somewhere mountainous, somewhere beautiful that is remote. And so a lot of times they will go ahead, not a lot, 5%, but still much more than before. We're seeing people purchase those homes without setting foot in them first.
And I wonder how much of that really stems from, this being an incredibly hot housing market right now, but it is kind of cold for one region of the market that would be first-time home buyers. We're seeing some weakness there as prices continue to rise. Why is that right now, Sarah?
Yeah, so this year was supposed to be really good for first-time home buyers because there were a lot of them coming into home buying age of the millennial sector. But what happened is because of the pandemic and so much demand for housing, in part driven by low mortgage rates, everybody was trying to get into the market. And that drove prices up really high. Most first-time home buyers are looking for homes that are in the $200,000 range or less. And right now the median home price is $350,000. So that is way out of range. And those homes that are less expensive, they're getting more expensive and they're also flying off the market really quickly. So it's very hard for first-time home buyers to find something that they can actually afford to buy.
Yeah, it certainly points to just how heated the market is right now. Sarah, going back to your earlier point, though, about just how many people are actually buying now without actually viewing their homes. I mean, it does also speak to where we are right now, which is in the middle of a pandemic. I've seen the links on a lot of these homes that are listed on these sites about being able to take the virtual tour. How much do you think this is a permanent shift, or is it really just something that is come out of necessity?
I had the same question, Akiko, and what I've been told by economists is that, yes, in the short term, this is a bump driven by the pandemic, but it also caused the technology to move forward. And so we have that lasting infrastructure now that people know how to create these 3D tours and are used to operating, even realtors like FaceTiming their clients to show them the property. And so now that we're used to doing it that way, it's going to be more accessible, and that's going to be lasting beyond even just the necessity going into convenience after the pandemic.
Yeah, some interesting trends for sure emerging out of this pandemic. Sarah Painter, appreciate you bringing us that story.
Well, we're going to take another quick break here on Yahoo Finance Live, but when we return, still focusing in on earnings season. I understand we got a lot of news out right now, but it is still time to focus on earnings. We'll chat the latest there in terms of the cloud and what updates we're seeing on the earnings front there with the CEO of Rackspace right after this. Stay with us. Welcome back to Yahoo Finance Live. It is, of course, still a Q3 earnings season here, getting some important updates in the cloud space. Rackspace, one of the latest companies to report there, showing a revenue in the third quarter jumped up to $682 million. That's up 13% year over year. The company also slightly upped its full year guidance, projecting about 10 to 11% growth versus the prior guidance of 9 to 10% here. So to discuss the boost we're seeing in the cloud space, joining us right now is the CEO of Rackspace, Kevin Jones, joins us. And Kevin, it's good to be chatting with you. First up, one of the things we've been discussing here, particularly in the cloud, is this boost, the shift to a lot of companies, interacting with customers here on the internet in the wake of all the shutdowns we've seen here. So talk to me about where you saw the biggest gains in the quarter in Rackspace's businesses here.
Well, thanks, Zach. Thanks for having me back. Look, things are fantastic here at Rackspace Technology. As you mentioned, we just announced our third quarter results. We had the highest revenue in the history of the company, the highest sales in the history of the company, and our best quarterly cash flow since 2017. So you're exactly right. We've got lots of momentum in the business, customers using more and more cloud than ever. This is now 5 consecutive record sales quarters in a row for us. And we raised guidance across the board, as you mentioned, for 2020, for revenue, cash flow, and profitability. So really what we're seeing in the market is this tectonic shift in the industry to cloud. And we don't see any signs of it slowing down. It's a $400 billion market opportunity, lots of secular tailwinds. So we're super excited and optimistic and helping our customers get to the cloud every day.
Yeah, Kevin, it's been really interesting to hear so many of these companies that have talked about their digital strategy really being accelerated as a result of this. Also surprising to hear how many had not necessarily put in the investment prior to the pandemic. There seems to be a sense in the market right now that maybe even if there is growth, that momentum could be slowing a bit if things start to open up when the vaccine comes to market. Where are some of these areas that you see more runway for? You talked about growth as a whole, but what in particular are you optimistic about, even if things start to open back up again?
Yeah, thanks, Akiko. It's a great question. And, we were one of those companies that doubled down when the pandemic started, right? We kind of foresaw that demand would pick up, particularly in the cloud with the pandemic. So we invested ahead of the curve, and obviously you've seen kind of our record results. So we're really glad we did that. Now, here's kind of how I see the future as it relates to a vaccine and what that would do to the cloud market. Obviously, we all hope for a vaccine. I mean, that's very exciting news. But look, whether we're all working from home or going back into the office, we're in a great spot in this particular market because of this tectonic shift in the industry to the cloud. Cloud was already accelerating before the pandemic. It further accelerated with the pandemic. And we actually strongly believe the momentum will only build as the world emerges out of the COVID-19 situation. And it's because COVID-19 really accelerated years of digital transformations. Companies cannot roll that back, right? For example, you don't go from digital to analog. Customers don't like to go backwards. So digital transformation is about businesses saving money. That's fairly timeless, and being agile and protecting their data. And that's where we come in at Rackspace Technology. We help customers move to the cloud and enable that transformation.
Yeah, Kevin, we were talking with Orlando Bravo, the founder of Thoma Bravo, on the show yesterday, one of the largest PE firms focused on the cloud. I think they even acquired a spinoff from Rackspace in the email space last year. But he said cybersecurity, cloud infrastructure, some of the most overlooked opportunities in cloud. I mean, even after the quarter you guys were talking about or reported here, your shares are still below where they priced in the IPO at $21 here. So do you get the sense that investors right now are overlooking the opportunity you're describing?
So look, it's a great question, Zach. As CEO, I don't focus on the short-term market ups and downs. We're just going to continue to execute. And, we just announced the sensational third quarter. We're raising our guidance for 2020. So I'm confident the market is fantastic. And I'm also confident if we keep our eye on the ball, we keep executing, taking care of our customers, and delivering quarters like the one that we just announced, the market will recognize the value we're creating here.
And Kevin, you've got some good visibility on a lot of these companies and how they're looking at their 2021 strategy right now. From an investment standpoint, what are you hearing in terms of the outlook? Are they a bit more optimistic? Are you seeing more investments coming out, especially in this space? Or do you think that momentum is kind of slowed down as we've seen this uneven recovery?
Yeah, look, great question. No, we're seeing more momentum, right? And we're seeing more investments from customers, pretty much because the cloud is really a secular trend, right? It's not dependent upon short-term market fluctuations. It's really something in a great market. It's terrific because customers enact digital transformation programs, and in slow markets, customers want to save money. So kind of both sides of the coin for the cloud, you continue to see growth and investment. So we're actually really optimistic. Our partners are optimistic as well. So we're really excited about 2021.
And Kevin, lastly, I mean, when we talk about this, is particularly in the cloud, it's interesting to see the breakdown for a lot of these companies and how big of a share of revenue some of these bigger tech companies comprise here. How has that looked at Rackspace as you guys have grown over the years to kind of diversify and bring on some smaller clients here to kind of, I guess, build out your customer portfolio?
Yeah, it's a great question. Of course, we love our customers here at Rackspace Technology. It's a fascinating question because, our company has 120,000 customers, and where the company really for the last, we've been in existence 22 years, the first 18 or so years, we're really in the small and medium-sized business segment, and those customers continue to demand Rackspace Technology services. And now where we're seeing a lot of growth is in the enterprise part of the market. So we definitely have a, kind of a much different profile of customers than you'll see in a lot of our competitors in the market. Extremely diversified, right? We don't have any large customer concentration at all. And what that allows us to do, gives us great revenue visibility, allows us to continue to invest ahead of the curve like we talked about, and be there for our customers.
All right, the CEO of Rackspace, Kevin Jones, appreciate the latest there, and congrats again on the quarter.
Thank you.
Coming up, another market check as we see the Nasdaq up 223 points now. Also, Goldman Sachs out with their outlook for 2021. Certainly seeing more optimism on the other end now that we got that vaccine news from Pfizer. We'll break down that note for you on the other side of the break. Welcome back to Yahoo Finance Live. We are taking a look at the S&P 500 and the Nasdaq hitting session highs right now. The Nasdaq now up 221 points. Jared Blickery is tracking that for us. And Jared, we spent so much of the last few days talking about the rotation out of tech. Investors certainly looking to dive into the opportunities now.
Yeah, and to be fair, it is a bond market holiday, bank holiday, and we got pretty low volume, but we still have a flip of what we see in the prior 2 days, which is the Russell 2000 and the Dow are lagging. We got these big tech giants doing very nicely. So let's get straight to the Nasdaq 100 heat map. Now we can see Apple, Amazon, and Microsoft each up just shy of 3%. We got NVIDIA above 4%. It had been a big laggard yesterday. And just looking at the Dow Jones here, we can see some pressure in the financials. That's also a reversal from the prior 2 days. JP Morgan here is off about 1.3%. And also looking at Disney. Disney's down 2%. Honeywell down 1%, so the industrial is not faring as well. And if we checked out the sector leadership and laggardship, we're going to see that tech, consumer discretionary staples, all in the forefront. Tech is up the most, 2.38%, as you see there in the upper left. To the downside in the lower right, we got materials, energy, industrials, and financials all in the red, and those have been really the standout sectors for the last 2 days. The 2 days prior. Looking at the travel heat map, also inverse. Delta is down about 3.5%. United and Southwest each off more than 2%. Royal Caribbean here off more than 3.5%. And then looking at the semiconductor space, we talked about NVIDIA before, and we've got some nice leadership here. Qualcomm up over 5%. Skyworks Solutions up about 5% as well. All right, well, let's take a look at our Yahoo Finance premium investment idea of the day. This is going to be Moderna. We know a lot about this stock, and we can see year to date, they've just had an incredible run up 315%, but haven't really done much over the last few months. So let's see what Argus Research is saying about Moderna today. Well, they're raising their price target to $88 on continued vaccine progress. And let's read some more of their reasoning here. Moderna recently completed the enrollment of 30,000 participants for its phase 3 study of mRNA 1273, which it is conducting in collaboration with various research groups. Upon the accrual of assessment of 2 months of safety follow-up data, it will determine whether to submit a dossier to the FDA requesting emergency use authorization. They go on to describe how many hundreds of millions of doses various countries have offered to buy from Moderna, but they close with a risk disclosure. There are still risks to owning mRNA shares. The company is not profitable, and there is no guarantee that its coronavirus candidate will reach the market. Guys?
All right. Thanks so much for that, Jared. Zach, it's interesting, Jared highlighting Moderna there, but we got that note from Goldman Sachs today, raising their assumptions or baseline assumptions for 2021. One of the key things they're looking at, though, is the expectation of approval from the FDA from one of those key vaccines, though Goldman doesn't name specifically which one. But, you know, we're looking at here, Goldman saying S&P 500 could rise by as much as additional 11%. 4,100 by mid-year on the expectation of a potential vaccine coming to market.
Yeah, and I mean, you look at a year beyond 4,300 in terms of where you look at year-end 2021. I think it's interesting when you think about the timeline to that vaccine, because we were talking about this yesterday, and one of those names that's hard to hit here, trying to weather the storm, AMC. Trying to forecast out how much runway they have, looking to kind of hit that problem area in terms of their debt load by February. We're seeing them issue shares again. It's the key question. And Goldman also in that note kind of broke out some of those names that they screened for in the value space that still has some room to run when you look at the gap between the forecast level of consensus 2021 earnings per share and the level of pre-pandemic profits in 2019. On that list, you're going to see a lot of those names that look a little shaky, the cruise line stocks, but also some of those bigger names that we haven't talked too much about. Disney, obviously they have their struggles with the park business, but that being one to look at there. The airlines also on that screener list. I mean, obviously they're pointing towards opportunity and value, which is what we've been discussing pretty much all week here. But interesting because the cash position for some of these companies, I think, will be the key factor when we think about where investors are going to be looking at in the value space, but maybe that's just me.
And to your point on Disney, we've got their earnings, so we'll be watching very closely to see how things shake down there. But, I think it's interesting. The counterpoint to all of this is what we heard from Neil Shah, our guest earlier, as well as Dr. Osterholm, who made it very clear that, yes, there is optimism for a vaccine, but in the meantime, as the doctor described it, you've got 3 months of COVID hell. And I keep wondering with the vaccine, how is this going to be administered? What is the process going to be? And to the point of these stocks, how profitable are they going to be for these individual drug makers? So there's still a lot of questions. We've seen the vaccine optimism really drive the market so far this week, but you can't help but wonder if there is a little complacency right now at a time when we are seeing a huge surge in these COVID cases, 100,000 or upwards of 100,000 daily case counts.
That's a really good point. And you think about how much Pfizer said that they could get out by next year. It's going to take 2 doses, and it's obviously going to go to those frontline workers and susceptible populations first. So it's not as if everyone's going to be vaccinated, I think, as soon as some investors out there are hoping. And to your point, obviously the upside is being laid out here by Goldman Sachs, but for some of those value names, if they continue to dilute the upside, what's the benefit of seeing a gap here in terms of forecasted earnings per share in 2021? If you keep issuing shares out there, there's not going to be a lot of upside to capture. So I think that's something, too, that might be overlooked. When we look at these year-end targets, obviously, you're looking at the total market here, and Goldman Sachs clearly a little bit more bullish than we've seen them in the past. But still, I think individually, a lot up in the air and breaking out which one of these might be the best opportunities on the table now.
Yeah, Goldman lifting its year-end target to 3,700. We're seeing the S&P 500 trading at 3,576 right now, so an upside of 4% or so. Certainly a lot more to come here on Yahoo Finance Live as we do a final check of the markets here. The Nasdaq off of its session highs now, up 208, but we're still seeing investors looking into tech today after the sell-off of the last few days. The Dow now up 80 and the S&P 500 up 30. We've got a lot more coming up here on Yahoo Finance Live. Keep it right here.
Welcome to Yahoo Finance Live. It is 1 p.m. I am Kristen Myers. It is Veterans Day, so I did want to start today's show by first thanking all of the millions of Americans who serve and are currently serving this country. Let's look right now at the markets. All 3 major indices are in the green. The Nasdaq, the leader on the day, up 1 3/4 percentage point right now, as we are seeing tech stocks rebounding from some of those losses on a sector basis right now. Tech up over 2%. We're looking at the laggard when we look at sectors, materials, energy, and industrials. Tech, however, remains the leader of the day. S&P 500 up roughly just over 0.75 of a percentage point, with the Dow almost somewhat flat, up 0.2 of a percentage point right now. I want to look at some of those big tech names. Again, investors are snapping some of them up after it had taken a beating yesterday. Looking over at Apple right now, up 2.8%, Facebook up over 1%. We're seeing Twitter up roughly 1.5%, and Amazon up roughly 2.75 of a percentage point. On the flip side, however, let's take a look at some of those travel names. On the news of that Pfizer vaccine having a 90% efficacy rate, we had seen some of those stocks really starting to soar. That is now starting to be reversed a little bit today. We're seeing United, Delta, American, all in the red right now. Delta are taking the biggest beating of some of those airlines, down roughly 3.5% right now. Cruise line stocks are also in the red. Royal Caribbean down 3.5% right now. Carnival down 1.3 of a percentage point, and Norwegian is down nearly 2%. But I want to start with the elections and where we stand right now with the many lawsuits that the Trump campaign has filed. We're joined now by Yahoo Finance's Jessica Smith for more. Hey, Jess.
Hey, Kristen, let's start in Georgia, where the Secretary of State announced an audit today that will trigger a full hand recount of the presidential race, of the results in that race. Officials say they want to begin the process this week, and then they hope to have it completed by November 20th, which is the certification deadline. Reporters asked the Secretary of State if he was doing this because of the allegations from the Trump campaign and from President Trump himself. He said, no, they're doing it because it makes the most sense. He added, though, they stand by their numbers. This race is very close, with President-elect Biden leading by 14,000 votes or so in Georgia. How this recount is going to work is election officers are going to divide up the ballots into piles for each candidate and then run them through a scanner. That scanner doesn't read data. It just counts those ballots. And then at the end of the audit, at the end of the recount, the losing campaign can request another recount, which would be done by machine. The Georgia Secretary of State has faced backlash from his own party as the two Republican Senate candidates who are going into those runoffs in January have called for his resignation, saying there were failures in the election, but they did not give any evidence or real specific examples of any wrongdoing. The Secretary of State called those allegations laughable. There is a new poll out from Remington Research Group that showed neither candidate in either race has a clear advantage here. The Republican candidates are leading the Democratic challengers, but just slightly. So this is going to be a very, at least it looks like it's going to be a close race, and it's going to be paid a lot of attention to as it goes over the next couple months, as this could determine the control of the Senate.
Jess, I want to ask you now about what's going on in Michigan. We do have some updates there, at least when it comes to another lawsuit, right, that the Trump campaign has filed in that state.
Right. There's another lawsuit in Michigan asking that Michigan results not be certified until ballots are verified there to ensure no illegal ballots were cast. The suit alleges irregularities, incompetence, and unlawful vote counting. They say they have witnesses to some of this alleged wrongdoing, but so far we have not seen any evidence of any widespread voter fraud. We have seen several suits from the Trump campaign tossed out, and we've heard from local officials, state officials from both parties across the country who say there was no widespread fraud. The election process worked as it should have. We did reach out to the Michigan Secretary of State about this particular lawsuit. We have not heard back from her yet, but over the past week or so, she has defended her office and the election results. She said in a tweet yesterday that she and her colleagues are working to dispel false information and partisan rhetoric designed to erode voters' confidence in what was truthfully a very secure, transparent, accurate election. President-elect, have to get used to saying that, President-elect Biden leads Michigan by more than 146,000 votes. So that's a very large lead to overcome with so far baseless allegations. Kristen.
All right. Thank you so much, Jess Smith, for breaking all of that down. It seems like every day there is something new. So appreciate you taking us through that and giving us all of the latest. Well, as we just heard from Jessica Smith, the Trump campaign continuing to attempt to prevent states from certifying elections due to their claims of voter fraud. Let's dig into some of this more now with Lieutenant Governor of Pennsylvania, John Fetterman. Lieutenant Governor, so we were just hearing from Jess Smith about where we stand in respect to all of the lawsuits. Pennsylvania has been one of the states rather targeted by the Trump campaign for some of the lawsuits. As you see it and where you guys stand right now in Pennsylvania, are you expecting that every single one of these lawsuits are going to be thrown out?
Yeah, LOL, like send another 1,000 lawyers. You're going to get the same answer. It's your story. Tell it the way you need to. Send as many lawyers as you want. But the bottom line is math doesn't care about your feelings. Math doesn't care about your baseless lies and allegations. And math has made Joe Biden president-elect, and you are standing in the way of an orderly transition. And it's just time we get on with it. So this idea that you somehow can alter the outcome through a lawsuit without any evidence, without any facts, when the math is overwhelmingly against you, I don't understand, why they want to continue this on.
So we had a postal worker in Pennsylvania who raised allegations of fraud. That would be Richard Hawkins, and he has since recanted those allegations. That's all according to the House Oversight Committee. And they tweeted, I just want to read the tweet for everyone here. USPS, United States Postal Service, IG investigators, so Inspector General investigators, informed committee staff today that they interviewed Hawkins on Friday, but that Hawkins recanted his allegations yesterday and did not explain why he signed a false affidavit. I know that you also have tweeted about fraud to your counterpart in Texas. That, however, was someone who was trying to vote for President Trump. Are there any other allegations, as you know them, inside the state of Pennsylvania?
No, and I got my eye out because I want some of that reward from the lieutenant governor in Texas. But I held up my end of the bargain, Governor. I sent you evidence of voter fraud in Pennsylvania, and this man is charged for voter fraud for voting for Trump with his dead mother's ballot. And I just want to know, when can I expect the reward? And again. The Cowboys are lousy and the Steelers are undefeated. And, other than that, everything else is pretty much the same, that we are running away with the lead in Pennsylvania. The margin continues to grow. And these lawsuits are nothing but lies attached to an agenda of continual chaos, when there isn't one person from the president on down that actually believes any of this. And we all have to collectively turn our backs on all of this nonsense and say and affirm that yelling voter fraud in the absence of one scintilla of evidence is the metaphorical yelling fire in a crowded theater. And that is not free, protected speech. That is dangerous, and that is and cannot be acceptable.
I'm also curious to know if you'll be receiving that $1 million.
$1 million, yes.
$1 million.
Yes, I would love to get that $1 million. But the bottom line is this: it's like if they're going to bring their A game, now's the time, because right now it hasn't amounted to anything, and it's embarrassing. at the end of the day, it's like, if this is the best you got. Every Republican in Pennsylvania is looking for voter fraud. And, 8-9 days later, they still can't find it, except for the one dude in Luzerne County that voted for Trump with his dead mother. At the end of the day, how many chances are you going to get to come up with something, anything at this point? And I think we all just, again, as I said, just need to collectively turn our back to this nonsense, turn the page to and embrace the Biden transition.
So to that point, because I want to read for everyone at home something from the documents. It was from a transcript between a Pennsylvania judge and one of Trump's attorneys, Mr. Goldstein, where he says, quote, that to his knowledge at present, no, he is not alleging any fraud. This is, of course, in relation to about 600 ballots inside the state. So I have to ask you, because you're kind of hinting at this, They're not alleging any fraud. As you say, they have not produced any evidence. So why then continuing to push forward, do you think, with these lawsuits in the state of Pennsylvania, in the state of Michigan? Is it only just a PR stunt? Is that how you're seeing it, that this is just for publicity?
I don't know. I mean, it's great for billable hours for the legal team. I mean, I know that. I guess I wouldn't mind, being on but again, assuming that the lieutenant governor of Texas sends me my reward, I mean, it must be pretty nice to be filing baseless lawsuits and getting paid for it. But I don't know what the upside is, to be honest with you. And let's also get one other thing out. They keep threatening to go to the Supreme Court over these so-called late arriving ballots in Pennsylvania that arrived from 8 p.m. election day until Friday. And I'm like, take them, have them, I'm like, give them all to the president as far as I'm concerned, because we're talking maybe 10,000 ballots. And the president-elect's lead is, on the order of 50,000 votes and growing. It's not going to have any impact. Like, there is no card to play left, none. And it's not dignified. It's long stopped being dignified. And at the end of the day, we just have to get down to one fact, and that's math. And math has said the president-elect is Joe Biden, and it's time that we turn our backs on this nonsense and turn the page for a Biden transition. Our country needs to unite and really take care of the true enemy in all of this, and that's the coronavirus that is killing, 1,400 Americans every day and growing.
I want to ask you what you view to be the most damaging about all of these allegations. Is it undermining the trust of the American people? Is it undermining our electoral process? And moving forward, you just spoke about unity. How do you govern a people that don't trust you? How do you begin to move forward once all of this finally does end, when your own residents of your state believe that somehow you, the governor, and others inside the state have stolen an election?
I reject that question out of hand, with all due respect. A majority of people don't believe that. Half the population doesn't believe that. There are people that are like, they call them protest beliefs, where they might say something or whatever, but they know what time it really is. And everyone knows, like, they loved the election result in 2016. So Governor Wolf was governor then. Now, what changed other than a result that you don't like? And the bottom line is that people have already accepted this on the ground. When Fox News calls a state against the president, that is as nail in the coffin for a campaign as I think it gets, quite frankly. And there isn't one reputable, even disreputable news organization that hasn't called this race over. And again, it's all over but the crying. And I would just hope that the president just acknowledges math. And when he does, he will step up and step down and allow for a Biden presidency to begin to assume and help unite this country.
I want to ask you about something that you mentioned just a moment ago, which is, of course, coronavirus. We are seeing the virus surging all across the country, including inside your state of Pennsylvania. Are you guys thinking about or anticipating that you might be forced to do some sort of lockdowns, that curfews might be coming to some cities inside of Pennsylvania?
I don't believe that's currently the plan, quite frankly, because the governor has done an outstanding job in making sure our PPE stocks are high, our ventilator capacity is robust, and we are prepared for we would expect that there was going to be a surge. What I would hope is we could stop arguing about masks. Like, for God's sakes, arguing about a piece of cloth over your face that stops the virus from coming to you or you infecting somebody else, that is a political football. And that's one of the things that I hope the president, Joe Biden, can begin to start addressing, where stop arguing over public health measures. We wouldn't be arguing whether or not you should flush your toilet after you're done using it. I mean, it's public health, it's basic sanitary measures. And somehow we've been arguing about masking during a pandemic. Like that's just peak 2020 at this point. We need to move on, and we need to accept math, and we need to accept science and epidemiology, and realize that the only enemy at this point is this virus, because it is claiming 1,400 of our fellow citizens' lives every day, and that's expected to grow.
All right. Trust math, trust science. Those are great ending words for this conversation. Thank you so much for joining us, Lieutenant Governor of Pennsylvania, John Fetterman.
Thank you.
All right. Well, coming up next, we will be digging more into the coronavirus pandemic. That's coming up. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices remain in the green. The Nasdaq, the leader on the day, up now roughly 1 9/10 percentage point as we see tech stocks starting to claw back some of those losses from yesterday. S&P 500 and the Dow also remain in the green. S&P 500 up over 0.5 percentage point with the Dow up 0.2 percentage point. Well, yesterday I told everyone that we had crossed the 10 million mark in terms of coronavirus cases here in the United States. Well, today that total stands now at roughly 10.3 million, and almost 240,000 Americans have now lost their lives to this deadly virus. These are all totals, of course, according to the Johns Hopkins University Coronavirus Tracker. I want to bring on Anjali Kamlani now to give us an update on the virus. Hi, Anjali.
Hi, Kristen. Yes, unfortunately, we're seeing some of the most sobering numbers of the pandemic this year. And this is exactly what health experts were worried would happen as the confluence of cold weather plus the ongoing pandemic. And here we are also in flu season now. So really a lot of concern for hospitals and a lot of strain as well. Yesterday, a new record again with more than 61,000 individuals hospitalized in total, beating an April record of about 59,000. And that's really adding to the pressure right now. On one hand, we do know that there are at least some medical protocols that have been adopted, like using dexamethasone, and now with the antibody approval from Eli Lilly, some hopes of being able to use some more tools to help address that strain on hospitals. But as it stands right now, the deaths that could tally up in the coming days and weeks is still what we have to keep an eye on, because that had been slowed down because of these protocols in the past. Meanwhile, a new study out from Stanford University looking at what exactly is causing some of these buildup of cases and pointing to places that we've seen open up, even in parts of the country where the virus virus has been curbed, and that includes gyms and bars. And talking about how these smaller spaces especially are contributing in large part to the buildup of cases, and numbers like 10, these places account for about 10% of the places where the coronavirus is spreading, but they account for 80% of cases as a result. And so that kind of shows you exactly what experts have been warning about. But the study did point to something that many health experts have said, and that is that a shutdown overall, broad strokes, is not necessary. Just reducing the capacity of some of these places is key, and that has been adopted in some states and some metro areas. But really, a more widespread adoption of these rules could help curb the pandemic in the future. Kristen.
All right. Thank you so much, Anjali Kamlani, with, again, that sobering check on where we now stand in the United States in regards to this pandemic. I want to shift this conversation now to Dr. Hero Tipirneni. She's an emergency medicine physician and a former Arizona candidate for Congress. Doctor, you were just hearing Anjali go through, giving us a pretty sobering picture of what we're dealing with now in the United States. And it feels as if we've all been pretty distracted from the virus, given the elections. I'm wondering if you think that we really should be far more alarmed now in November than we were, say, back in April, when we were all in lockdown and staying in our homes.
Yeah, well, Kristen, it's good to be here with you. I wish the topic was certainly less dire, but yeah, I mean, look, here we are. What is it? 8 months into this, and obviously, I understand that there was a steep learning curve at the beginning, but we know how to mitigate the spread of this virus. We know this because not only have we seen it work, and bringing down surges, but we've seen it what has worked in other countries. And the fact that we are now seeing additional surges, we are seeing all of these hotspots where, as your prior guest just mentioned, restaurants, bars, gyms, cafes, all of these places where it is just not feasible to maintain the public health guidelines that are necessary to prevent further spread. We have to make some really hard and thoughtful decisions, and it has to be based in the data. We know that so much of this could have been prevented. We are at a place where, as you mentioned, over 10 million cases here in the States. We have one state, Texas, that has now itself exceeded 10 million cases. Here in Arizona, we have over 6,000 deaths. So much of this was preventable. And if we haven't learned the lessons of our past 8 months, then it is going to be a very dark winter.
So how bad is the picture getting really here? It feels as if we're almost okay now with living through this pandemic, but really, how bad is it? You are an emergency room physician. So how bad is it inside the hospitals? How bad is it when it comes to the supplies? How bad are you seeing it personally firsthand getting when it comes to the deaths?
Yeah, I mean, look, I've been speaking to so many of my former colleagues who are out there working on the front line still, and the numbers continue to creep up. They are worried about, resources, right? ICU beds, ventilators, but it's not even just the equipment. I mean, you have to have healthy staff. You have to have nurses. You have to have respiratory technicians. You have to have all of the team members that are going to be able to fully care for these patients. And we are seeing a level of exhaustion on healthcare workers' parts, on the resources. Back in the summer, our state, we had to go into, at one point, entertain the emergency care guidelines, which would have essentially had us rationing care. I mean, we should, at this point, have better protocols in place and enforce them so that we are not at risk of going back to that. I mean, here in Arizona, we don't have a statewide mask mandate. We're still debating the use of a mask, as I think one of the other guests mentioned. This is not up for debate. It is no longer up for debate. The science is clear what is going to help us get out of this pandemic. And those guidelines have to be enforced. They have to be followed widely. And it is a, all hands on deck situation. And we cannot afford to become lax on this. And now with cooler temperatures, more people indoors, limited ventilation, flu season upon us, all of these are confounding factors that, if we do not address them urgently, will make this incredibly worse.
So to that point, you just mentioned winter, the flu season. We also have the holidays. We have Thanksgiving coming up, Christmas, Hanukkah, the New Year coming up. Do you think if we continue on the path we are on now, which, as you mentioned, we do not have a national mask mandate. We see folks, at least a couple of weeks ago, were attending rallies without any masks, crowding together very close together. And of course, people want to get together with their families, with their loved ones for the holidays. So if we continue to do what we are doing now, if something does not change, where do you see us in February after the holidays are over? We're having case counts up over 120,000 cases in just one day. Are we headed for some kind of doomsday scenario where we might have 250,000 cases in a day?
Yeah, and I mean, look, this is about facts, right? We're not fear mongering. We're giving the facts. We want people to take this seriously. And the data is clear that if there continues to be exponential rise of cases, then that is where we will find ourselves in the spring. But we also have mitigation strategies that we could implement. We could continue to invest in widespread, further expanding our testing capacity. Right now, we still are not at the testing capacity we should be at. We don't have rapid results of our testing. We don't have contact tracing infrastructure in place. We don't have a mask mandate. We are still having, these non-essential businesses that are open. And I don't take that lightly. Obviously, people need to have jobs. But if we are putting them at risk and putting their families at risk and their communities at risk, it is not a trade-off that any of us should be willing to make. And it is scary when you think of the fact that we are getting somewhat numb to these numbers, right? When we hear of thousands of people dying, we've over 1,000 that die a day. And the fact that we are still debating whether we should wear a mask, it's unconscionable. And the way we're going to make sure we really address this head on is to make sure our leaders take charge. Leaders need to lead by example. There should not be a single leader out there that at any point is out there in public with other folks without a mask. They should be emphasizing the importance of staying home as much as possible, of washing our hands, of getting tested, of investing in this kind of infrastructure, making sure we have adequate PPE. All of these things are factors. And, we heard some great news recently, right, with this vaccine potentially being very effective from Pfizer. Well, that's wonderful, but let's now put in a plan of how will we mass produce it? How will we mass produce the needles, the syringes, manufacture it? What does our supply chain look like? What about distribution? Who are the populations to receive it first? All of these are critical decisions to be making now so that we are ready when the time comes.
All right, Dr. Hero Tiperneni, emergency medicine physician, thank you so much for joining us today.
Thank you for having me, Kristen. Take care.
And on the other side of this quick break, we will be breaking down today's market moves. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices remain in the green. The Nasdaq, the leader on the day, as we see tech stocks starting to claw back some of the losses that they had seen. The tech sector right now up nearly 2.5%, the leader on the day, followed by consumer discretionary and real estate. Energy and materials lagging right now in the market. I want to look over at some of those big tech names that we had been focusing on over the last couple of days. Amazon right now in the green, up 2.8%. Also joined by Facebook and Apple. Facebook right now up about 0.8 percentage point, whereas Apple up right now 2.8 percentage point. I want to go to our next guest now, Anik Sen. He joins us from global head. He's the global head of equities at Pine Bridge Investments. I want to chat with you about what we are seeing. I was reading your note, and you mentioned that you see great volatility over the next few weeks. Wondering what positions investors should be considering to reduce some of the risk to that volatility.
Well, yes, I guess that note was written before the U.S. elections. We obviously, were concerned that the outcome could have been somewhat unpredictable. We did think that, the opinion polls were somewhat wide of the mark. I mean, they have been for Brexit. They had been in the previous elections. And indeed, we came into these elections with our portfolios being very balanced, fearing that there could be some, heightened volatility around the elections.
So speaking of the elections, they, of course, they're now over somewhat. We still, of course, have many lawsuits being filed by the Trump campaign. Do you see any room for some volatility, election-based volatility around those lawsuits?
Well, never say never. I guess, from a market standpoint, what I'm looking for is, the consensus view right now to prevail, which is that, we get a divided Congress and, President Biden in the White House. I think if that is the outcome, it would be a very positive outcome for equities.
I'm wondering how, and I was just mentioning tech, that sector doing very well today, of course, having some losses yesterday and had been underperforming for the month of October. How should investors be approaching tech going forward? We had Lamar Villery yesterday saying that investors should be cautious about those big tech names, the Facebook, the Amazons going forward. Is now the time, as you see it, to really trim exposure there? Or do you still see some room for growth in those big names?
Well, one of the things that we have been, writing about and advising investors about is that this market has been a very narrowly driven market, all year. In fact, when you look at the number of stocks that are in positive territory, it's a minority. It's only about 40%. And that ratio is, in fact, increasing. So it's a very narrowly driven stock market, particularly through the tech sector. And valuations there are definitely now expecting a lot of good things to happen in the future. So expectations are generally high. And within our teams, we have been harvesting gains and we have been recycling some of those gains in other sectors, particularly because we see that the fundamentals across the board in corporate America is unusually positive right now, coming up through the depths of the recession back in April, May of this year. So, we think that 2021 is going to be a very equity positive environment. And with that broadening of market, participation by more companies, we see a lot of opportunities, in fact, not just narrowly in the tech sector, but in the wider equity market.
So speaking about that opportunity, we saw a lot of different sectors reacting, of course, very differently on the vaccine news. The stay-at-home plays, of course, taking a huge beating, while some other sectors like travel, for example, of course, really doing well on the back of that news. Moving forward, and I know that you are quite bullish in the 2021 outlook, moving forward, if you do recycle some of those gains that you made from tech and you want to place it to work in this market, where do you see either certain stocks or certain sectors outperforming next year?
Well, both, stocks and sectors. This is a marketplace where I think most CEOs and CFOs have been, unfortunately, for not just for this coronavirus period in 2020, but even from 2018 and 2019, first 2018 was largely due to concerns about a hard landing in China. 2019 was really all about the trade war. And then 2020 has been all about, the lockdown. And I think, there's so much pent up demand and there has been so much uncertainty for 3 years now that any release of that, valve, where animal spirits are allowed to come back in, a little bit more certainty in terms of planning for companies, this is sorely needed right now. And with that, what you see is that analysts this time around, particularly, post the coronavirus troughs in the market, have been way too fast and way too severe in cutting earnings estimates. So what we see today in 2021 is a removal of some of that uncertainty, potentially quite a bit of that uncertainty, as well as earnings upgrades generally, coming through after those very sharp earnings reductions that were put in by sell-side analysts. And then finally, I think in terms of the vaccine development, we had Pfizer, as your previous guest mentioned, but there are 3 or 4 other major companies, drug companies, that are yet to produce their phase 3 trials. So I'm kind of optimistic that we will see those mass vaccination programs around the world, potentially by the first half of next year. But I think obviously the stock markets, equity markets will anticipate, that happening. And so I think there are broad-based opportunities across, a large range of sectors, from financials to industrials to materials and so on. The reality is that, there is a big gap right now in valuations in terms of stock market participation, and some of that closing of that gap, which is what is needed right now.
And Ink, I know you're mentioning the vaccine, of course, taking a lot of the strength out of the biggest headwind that we've been seeing, which of course is coronavirus. Wondering your approach then to stimulus. They keep saying that stimulus talks are going to be restarting somewhat soon. How do you think that the market and the economy, at least in the near term, is going to be approaching that given the vaccine news?
Well, the stimulus is very much needed, obviously, because the mass vaccination of large groups of populations around the world isn't going to happen, in the next few months. It's going to take a while before we see that completed. So, but for the time being, there are many swaths of the economy which is still shut, and so we need that stimulus package. We need it fairly fairly soon. And so I think that, the markets are anticipating some of that stimulus package to come in the foreseeable future.
Right.
It's very much needed.
Absolutely. All right. Anik Sen, Global Head of Equities at Pine Bridge Investments. Thank you so much for joining us.
Thank you for having me, Kristen.
All right. Well, coming up, we will be looking at the total cost of the election and who spent the most money for each vote. That's next. Welcome back to Yahoo Finance Live. I want to talk now about the cost of the 2020 election. It's long anticipated to be the most expensive. We have Yahoo Finance's Rick Newman here with us now. And Rick, it seems that President Trump actually got the most returns on his financial investment, at least when it comes to the votes. Break it down for us.
Yeah, if Trump's looking for a consolation prize, he did run a more efficient campaign than Joe Biden in terms of the amount he had to spend for the number of votes he got. Of course, there's no prize for running the most efficient campaign. It just goes to whoever gets the most electoral votes. That's all that matters. But for what it's worth, Biden and groups supporting Biden spent about $1.15 billion on the presidential campaign. That's the most ever. And that works out to about $14.85 per vote. Biden got around 75 million votes, so that's how the numbers work out. Trump spent considerably less, $809 million. He got about 72 million votes. So if you do the math, he spent about $11.20 per vote. So $3 less per vote than Biden. And then if you break this down by some of the key swing states, I got numbers on advertising spending for all of them. Biden, again, really outspent Trump overall, and he spent about $29 per vote on advertising in 7 swing states. Trump spent just $17 per vote. So I guess if you're the Biden campaign, you say, look, we don't really care if we had to spend a lot more for each vote we got than Trump because we won.
All right. So to that point, as you mentioned, Biden having to spend over $1 billion just to take the race from President Trump. What does that spell out then for the future of elections when it comes to the cost, when it comes to fundraising?
There's more money than ever in elections. I mean, there's a lot of reason to think this is not great for democracy. I mean, this has a lot to do with that Citizens United decision from, I think, a decade ago, which allowed all this corporate money to flow into politics, no limits on corporate money. Now, of course, that has to go into these super PACs, but super PACs remain a big part of the spending story, and those are reflected in the numbers I was talking about. There's one really interesting case study here, which is Georgia. Biden spent very little in Georgia, and it was among the swing states. It was the one state where he spent the lowest amount per vote, and yet he won Georgia. So what does that tell you? It tells you advertising and spending money in campaigns, it isn't everything. It's not always true that the candidate with the most money wins. And sometimes things going on the ground are more important than what the candidates are doing at the top level, running ads and things like that. I think we're going to learn a lot more about this as we learn exactly who voted for whom. We don't really know all that data yet, but interesting. Georgia's going to be something political scientists are paying a lot of attention to.
I don't know, Rick. I learned that we need to get into political advertising. That's where the money is.
There's a lot of money there.
Journalism, perhaps, and that's where
yeah, but it's only once every 4 years. You got to do something else for those other 3 years.
Oh, rest, perhaps. All right. Thanks so much, Rick Newman.
Yeah.
All right. Coming up next, we will be focusing on veterans in our Funding Our Future segment. Welcome back to Yahoo Finance Live. Well, it is Veterans Day, so we'd like to spend the next several minutes chatting veterans issues with Mike Kelly. He's the Associate Vice President of Military Affairs for the United Services Automobile Association, or the USAA. Mike, I wanted to thank you for your service. I know you are a retired major in the United States Air Force, so I wanted to thank you, and thank you so much for joining us today.
Thank you so much, and really great to be here with you so that we can highlight the impact that veterans have across our nation.
So I want to start first with the pandemic. We've been chatting a lot about it throughout the show, case counts continuing to rise. Now, we've often talked about the impact of the pandemic on minorities, on lower income workers. I'm wondering if you can highlight for us perhaps the impact that this virus, that this pandemic has had on veterans specifically.
Well, they have had a significant impact in the veteran community and for military families. We work very closely with an organization called The Mission Continues that works to help engage veterans and military communities across the United States. And right now, it's food insecurity. Believe it or not, there's still a lot of military families that are impacted by that. So we'd like to partner with organizations like The Mission Continues so they can deliver support to communities across the United States.
Now, we know that veterans have long struggled with issues around employment, with issues around healthcare. Those two things, of course, right now are in particular focus. Wondering, what is the USAA's outlook for the economic recovery going forward, particularly when it pertains to those two things in the veteran community?
Well, we are very pleased to see a reducing number of unemployment for the military families. Spouses still continue to be unemployed and underemployed at a much higher rate, sometimes double the unemployment rate for their counterparts in the civilian community. So it's very important for us to support organizations that help veterans and military spouses make successful transitions into meaningful careers. And you mentioned healthcare. When you're on active duty, the military has a very strong, very robust healthcare program. So when they transition out of the military, they have to take that into consideration, because unless you are retiring from the military after serving a career of 20 years, you don't necessarily take that healthcare with you. So they have to look at the cost and the impact of replacing healthcare as well as life insurance and increased taxes, because a lot of their benefits while they serve on active duty are non-taxable.
I want to ask now about the recovery. Of course, everyone looking forward to that. But, you know, in the past, when we've had recessions, there have been a lot of groups that did not recover to the same extent as some of their counterparts. We talk a lot about minorities, for example, in regards to this. Is there a fear from the USAA that, you know, veterans might be a little bit left behind when it comes to the economic recovery over the next couple of years?
Well, I think the positive thing is that we are seeing that unemployment go down for veterans in transition. So I think that's going to help address that particular issue. But you had someone on earlier talking about small business benefits and programs that are available for the veteran community to help them start their own businesses. We think that's a great opportunity for veterans as well as military spouse entrepreneurs to build their own businesses, because there is a lot of financing available to support those opportunities.
Now, of course, I read out the full title for the USAA, and I remember when I first heard about it, I thought it was all about cars and car insurance, but it's not. You guys have a full financial service that you do provide to military members and their family. We now have a new president-elect. Wondering what you're anticipating in terms of policies from the Biden administration, and how you guys are anticipating or expecting it to impact the USAA specifically and your business.
Well, if you look at who we are and who we serve, it's very important that we keep track of any regulatory issues and things that are going to impact our membership. Now, 13 million members of USAA that have served in the military, or family members who have served. So we're keeping a close eye on those type of things. At this point, we're just kind of monitoring and looking at what the impact might be. But obviously, we're very concerned about and want to ensure that we continue to take good care of our military members through insurance, financial services, some of the most highly regulated industries out there. We'll continue to monitor for potential negative impacts as well as positive that are coming forward.
All right. Well, we will leave that there. Mike Kelly, Associate Vice President of Military Affairs for the United Services and Automobile Association. Thank you so much for joining us, Mike. And I do want to remind everyone that this was for our Funding Our Future segment. Funding Our Future is an alliance of organizations dedicated to making a secure retirement possible for all Americans. Major Kelly, thank you so much for joining us today.
Absolutely. Glad to join you.
All right. Well, coming up after the break, we will be talking about Fed loans for nonprofits and who is going to be taking advantage. That's coming up next after the break. Welcome back to Yahoo Finance Live. Checking market action right now. All three major indices remain in the green. The Nasdaq, the leader on the day, accelerating some of its gains, up roughly 2% right now. The S&P 500 up 0.8 of a percentage point, with the Dow lagging today, up 0.2 of a percentage point. On a sector basis, of course, with the Nasdaq leading, we see tech right now, the leader of the day, up 2.5%, followed by consumer discretionary and real estate. We do have some sectors right now in the red: materials, industrials, energy, health, and financials, with materials right now the laggard on the day, down 1.5% right now. Want to quickly highlight some of those tech names. We have been chatting about it today. Tech right now clawing back some of those losses from yesterday. Amazon right now is up over 3%. We're seeing Zoom, a stay-at-home play, had taken a huge beating off of the news from Pfizer and their vaccine efficacy. Zoom right now up 7.8 of a percentage point. Looking at some of those other big tech names, Facebook up over 1%, Apple up 2.8 of a percentage point. We also see Pinterest up nearly 6.5%. But I want to get now to talking about college sports, because I don't think most folks would think of college sports conferences as a nonprofit. And yet we have a new report from Yahoo Finance's Brian Chung about how the Sunbelt Sports Conference is actually tapping into a loan from the Fed, which is earmarked for nonprofits. Hey, Brian, break it down for us.
Well, Kristen, normally I talk about things like central banking and the economy, but a little unusual for me to be talking about college sports, but relevant because we've been talking over the past few months about the Federal Reserve's Main Street program. It's their emergency loans to for-profit, but also nonprofit organizations. And the Fed has officially extended credit to the first borrower that's a nonprofit organization since it opened that up to those organizations in September. It is the Sun Belt Conference. This is a D1 program that covers 12 schools throughout the Southeast. Think of the Ragin' Cajuns in Louisiana, Appalachian State. This is based on disclosures from the Federal Reserve that were released this week, showing that the Fed tapped the Main Street lending facility for a $4.4 million loan that was in early October. This is pretty remarkable given the Fed's intention to really open this up to nonprofits. They had announced that back in June, but it didn't go live until September. As the Fed was trying to work out exactly how they would do this, no one was able to successfully complete the application until Sunbelt ultimately got its through the First Bank and Trust Bank in New Orleans, Louisiana. I had the chance to speak with the commissioner. He said that he did this to beef up their cash position. He said they have a strong balance sheet, but they really did this to try to sustain the revenue hit of having to obviously move their sports schedule due to COVID. They also have to pay more for COVID testing, but it might be a surprise to many watching this nonprofit space to say, actually, it was a sports league, not maybe a humanitarian organization that ultimately turned to this Fed program to get some help.
So, Brian, I want to ask you now about some of the pros and cons of this lending program, especially because throughout the pandemic, and you've talked about this, there have been a lot of criticisms for some of the lending programs from the government, particularly when it comes to small businesses and the loans there. So walk us through this program here.
Yeah, absolutely. We just flashed the terms of the program, I believe, in a full screen. And basically, the terms of this are: it's a 5-year loan. You will be able to get a loan that's as large, or rather, minimum size is $100,000. So hopefully accessible to a number of types of organizations. But the problem is that its pricing, LIBOR plus 300 basis points, is actually more expensive than where they could find in the private market. In the case of Sunbelt, based on the conversation I had with the commissioner, it appears they really liked the feature specifically that allows you to defer principal payments for the first 2 years. The Fed was hoping to use this as a carrot stick to get lenders to offer these types of loans, but any sort of other organization that might be facing liquidity issues. One issue is that there's an EBITDA test where you have to have enough earnings to actually qualify for this program. But obviously, by nature of it being a nonprofit, there are a lot of organizations that have too little margin to actually qualify, which might have explained the low uptake. But at least for the Sun Belt, they have made enough money to qualify, which is a little ironic given the nature of this program, but definitely worth watching in the future.
All right. Thank you so much. Our Fed whisperer, Brian Chung, thanks so much for breaking that down for us.
Thanks, Kristen.
All right. Well, Yahoo Finance Live will be continuing in the 2 p.m. hour. Alexis Christophorous will be chatting with Jonathan Miller. He's the president and CEO of Miller Samuel Incorporated on the outlook for the luxury real estate industry.
Hello, everyone. Good afternoon. I'm Alexis Christoforous. Welcome to Yahoo Finance Live. It looks like investors have rekindled their love affair with big tech stocks after back-to-back losses this week. News from Pfizer earlier in the week about progress on its COVID-19 vaccine sparked a rotation out of those mega cap tech stocks and into cyclical sectors such as manufacturing and energy. Investors also piled their money into those beaten down pandemic-sensitive stocks such as airlines, cruise lines, and hotels. The thinking there being that a vaccine would help get life back to some kind of normal and those companies would benefit. Those are the very stocks that are actually not doing all that well today. With 2 hours left in the trading session, here's where things stand right now. The Dow Jones Industrial Average up 43 points there, but look at the Nasdaq up 219 as those tech-heavy stocks come back into favor. Amazon and Microsoft helping to lead the advance there. We've got the S&P 500 up about 30 points. Want to get right to Jared Blickery, who has been following the charts today. And let's start with those FANGs, Jared, and what is leading us higher today.
Apple is leading the FANGs, and it has been a bellwether for the entire market we've known since March. And this is after its One More Thing event yesterday, where it debuted its own in-house chips for its Macs and iMacs, and a couple of analyst commentaries on it, all of them very bullish. This one's from Raymond James, saying that while the iPhone is by far the most important product cycle, the Macs are an important additional catalyst, which we expect to continue into next year and help further strengthen the ecosystem. And then Apple's forecast for Macs in the December quarter should be easy to achieve given the new product cycle and continuing work and learn from home demand. These new iMacs are a demonstration of how far Intel has fallen behind the industry. And we know that Intel has been getting its market share eroded not only by Apple now, but really by AMD in the server division. But moving on, Link's equity strategies had an interesting comment too. The street has been too timid modeling Mac and iPad and too bullish modeling iPhone. So maybe we'll see some strength from this division, which we really have kind of forgotten about, Alexis.
Yeah, you know what I've been tracking today, Jared, are the travel stocks, particularly the airlines. I'm surprised to see them pull back. I mean, I know they had two back-to-back good days, but today a lot of those airlines are resuming their international flights. I know American Airlines has started flights up again with China, yet those stocks are under a lot of pressure.
Yeah, it's a pretty big reversal from the prior 2 days, but I just throw out, it is a bond and bank holiday, and we do have pretty low volume, so not going to make too much out of this. But back to American, yes, we now have 10 flights going to China, and the 4 are coming from Delta, 4 from United, and an additional 2 from American. They're going to be starting today, Wednesday, from DFW International, that's in Texas, and that's where their home base is, to Shanghai's Pudong, and they're going to stop in Seoul. And just a few more information facts about this new deal. The United States and China, they agreed in June to start allowing 4 weekly flights. Then they subsequently raised the number to 8 in August. But the U.S. is not happy that it's only at 10 right now. In fact, we have an agreement with China to operate more than 100 weekly flights, but China is only allowing incremental at the time being, Alexis.
All right, I want to get to those industrials because another sector there that did well the past couple of days, pulling back today, and in the spotlight in particular, General Electric going to disband its corporate audit program. What's that about?
Yeah, this is a program, pretty fascinating, goes back to the beginning of the prior century, and this is what they used to groom some of their senior executive leadership. They'd send them all around the world, analyzing various business units, looking for ways to tighten up their internal controls, but it's costly, and it's over a century old, so you can imagine maybe it could be done a little bit better. And a lot of this is coming at the behest of their new CFO, Carolina Dybeck-Happ, and she joined earlier this year. So this program is now being updated. It's going to last 5 years, or excuse me, it used to last 5 years with few participants surviving that long, but now it's just going to be run a little bit more streamlined. And of course, they need to groom the appropriate talent, but they're just not going to be sending them completely around the world, which makes sense in the new environment here.
All right, and I want to get an update on Revlon because this time yesterday, you and I spoke about the company. It's trying to dodge bankruptcy. The stock was up 60%. Where are things right now?
It's up 15% now, and it had been up significantly higher, 65% at today's highs, but that pales in comparison to the 120% it was up yesterday's highs. And you can just see on the Wi-Fi Interactive here the incredible run it's had over the last 2 days. Now, the story behind this centers around the company trying to avoid bankruptcy, and that is because they have about $1 billion worth of debt that's coming due, and they need to make an agreement before November 16th. That's next week. Well, now they have about 69% of bondholders on board. This affects $343 million worth of bonds, and this is led by billionaire Ronald Perelman's cosmetic empire to ease its debt load. And on the other side of this is Carl Icahn. So these two billionaires have been kind of at loggerheads right now, but they seem to be reaching some kind of an agreement.
All right, Jared, we'll talk to you a little bit later on. I want to stay with the markets now and bring in Michelle Schneider, partner and director of trading research and education at marketgauge.com. Michelle, thanks for being here. So look, we've talked a long time about how the market rally has really been concentrated in a few choice tech stocks, and we're starting to see much greater breadth in the rally now. What do you make of the recalibration?
I think it's nothing but good news. After years and years of following the rotation into growth and seeing value getting killed, what really I think is the truest measure of optimism for the U.S. economy, and not just a lot of hype, is the rotation into some of the industrials and manufacturing, and particularly the small caps. I'd created something called the economic modern family just to track that. And the three lead instruments in that would be the small caps, transportation, and retail, and not just online retail. So they kind of started the ball rolling this even before the election and before we've heard the vaccine news. The fact that they have gapped up and are holding, especially the small caps, even with it being down against the Nasdaq today, to me, that's just healthy digestion.
When you look at market catalysts in the short term, is a vaccine, a viable vaccine, actually more important for the economy and for the stock market than who wins the White House?
Well, I don't know if I would necessarily weight one as majorly over the other in terms of influence on the markets, because right now we have a contested election. And of course, if that turns out to be more than just allegations, that can really do a lot of damage to the overall market, because it sends a shock to the confidence in the United States, first of all, and it will really impact the US dollar. In terms of the vaccine, I think what makes that so highlighted right now is because we have surging cases, not just worldwide, but here in the United States. And that is definitely being canceled out by the hopes of the vaccine. And also what it tells the market right now is that businesses will not shut down. And that's really the major focus when you get down to it, is will the economy stay open and continue to open up? And you mentioned before about the airlines. There's a perfect example of where the optimism is really being spread.
What happens if we don't get stimulus right away? I mean, it could be, you have Biden, if he's going to be sworn in January 20th, perhaps stimulus doesn't come down the pike until February. Are we going to see investors take their money out of the consumer trade and the more retail stocks as they wait for another round of stimulus checks?
I think that's a great question, because already when you look at some of the numbers that our people have been surveyed about how much they plan to spend for the holiday season, it comes out to be about an average of $100 less per family than they spent last year. And so that really shows the strain of the consumers in terms of how much money they have and that they're waiting for more stimulus. But the market itself may not necessarily care. It may be a temporary blip to the downside because, as we know, it's forward thinking. And that's really why I believe that with stimulus coming in February, people will get optimistic. And also the other part of it is how many people are actually going to continue to return to work. The labor force has increased, which has been another happy news. Where we might see that impacted, what you're talking about, really is more in these big Nasdaq stocks, which are already drowning in their own greatness. How much more upside they have, I don't know. Apple had good news. How many more people are going to buy the Apple stock or the Amazon stock at these levels? There are so many other better opportunities that I'm seeing emerge. Whether the consumers have a big party at Christmas time or not, at this point, I think whatever that opportunity that emerges from that will be a good one if you know where to look. And that's where the industrials and the manufacturing comes back into play.
Michelle, you touched on it just there, but expand a little bit more on where you see those opportunities for people who want maybe less exposure to those mega cap tech stocks.
Well, one of the big groups that we've been looking at, and I think you and I talked about this months ago, was the small cap growth stocks. Stocks like Fastly, for example. There's a whole bunch of others. There's a couple of bank stocks. I have a list of them, not off the top of my head, but if you look under small cap growth stocks, those have been really the hot stocks. Like one in particular I can just think of right now is Form Factor, which is a tech stock, but it's not a tech stock in Nasdaq. It's a tech stock that's actually in the small caps. And that just went on to make new all-time highs up again today. So that's really kind of what we're looking for. In terms of value stocks, we're looking for companies that had a pretty good balance sheet, but haven't really gotten going yet. A classic, which would fit within a mega trend, would be like 3D Systems, for example, DDD, because we really believe in 3D printing as the future. And that stock has been basing, hasn't gone anywhere, but we're actually in it right now, looking for it to start making a move. So, we're mixing up our portfolio. We also have a lot of commodities in there, mainly food commodities, because the food commodities have skyrocketed as well. So we're also looking at some inflation plays as we're adding things in, and we think the opportunity there is still really very green in terms of what can happen with commodities going forward.
Back to techs for a moment. I want to touch on chip stocks. You mentioned NVIDIA in your note. How do you like NVIDIA right now? We know Intel got hit hard after Apple came out and said they're going with their homemade chips. They're not going to be using Intel's anymore. But it's been quite a year for AMD and a company like NVIDIA.
Well, right. And NVIDIA looked like it was teetering on falling off the cliff as we came into this week. It hit $500, which is a real big support area, and is bouncing today. It typically does very well seasonally as people go out and buy cyclicals and buy technology. That's really when NVIDIA shines. So I think it's a great barometer to watch. Right now, last look, it was trading about $533 with a nice bounce today following Nasdaq. But if it's still inside the range where it was trading yesterday. So it could just be more of a buying against the support, maybe some short covering in that. And if it cannot continue up from here and starts to roll over and breaks 500, I think that will really be an interesting sign for exactly what we're talking about, which is that rotation out of the monster techs and more into some of the manufacturing, industrial, small caps, and even, like I said, commodities.
All right, Michelle Schneider of MarketGauge.com. Always good to see you.
Nice to see you too.
Thanks. All right, coming up, we're going to speak with the CEO of AES about what the new Biden administration might mean for the clean energy industry. We'll be right back. Make money on Wall Street recently has been to bet against the fossil fuel industry and buy renewable energy stocks. Investors are betting that a Biden presidency will accelerate the shift to renewable energy. Joining me now is Andres Gluski. He is president and CEO of the global power company AES, which is based in Arlington, Virginia. Andres, good to see you again. We see this shift from fossil fuel companies to renewable energy firms accelerating even during the Trump administration, although the president had said, he was going to support the U.S. coal industry. What would a Biden presidency mean for that industry and for your company in particular?
Well, hi, Alexis, and great to be with you. I would say, look, first, there's a real change in technology. Renewables are getting cheaper. So even, as you mentioned, under Trump, you had really an acceleration of the adoption of renewables. So under let's say a Biden administration, I would expect them to really extend some of the tax incentives for renewables, perhaps set out more goals, but realize that it's also going to depend on the Senate. And even in the Republican Senate, will they pass extensions of some of these tax laws, such as the investment tax credit, production tax credit? I personally think it's likely because a lot of the renewable resources are in states which have Republican senators. So it would be in their interest to have these extensions.
Now, at AES, I know that you plan for coal to account for less than 10% of your electricity generation by 2030. Can you talk to us about how you are doing with that? Are you still on target? How do you plan to achieve that goal?
Yes, well, there's definitely a transformation of the sector. Now, it can't be done overnight because when people talk about renewables, it's really, renewables just give you energy. They don't give you capacity, which is the ability to provide energy 24/7. So therefore, you have to replace the thermal generation probably with energy storage, and that's going to take some time. So what we have really is we have power purchase agreements, or basically our coal plants are contracted. When those contracts burn off over the next couple of years, we won't renew those contracts and those plants will come offline.
Now, I know globally also AES is looking to build 5.4 gigawatts of renewable generation capacity. Can you give us an idea of where, demographically speaking, you're going to be building these?
Well, we're one of the 10 leaders, let's say, in the world in the building of solar energy. So we're building about 3 gigawatts a year. About half of that's in the US, half is outside of the US, mainly in countries like Chile, countries like Mexico, countries like Colombia. And within that 3 gigawatts, about half is solar and about half is wind. But we're also the leader really in the adoption of lithium ion based energy storage. And this is very important because it allows you to store that energy. And, for example, there's a lot of solar from 12 to 3, but what do you do after that? So we have some of the world's first 24/7 renewable energy, like out in Hawaii. But again, that's going to require investments in energy storage.
Do you plan to build any new fossil fuel plants in the short term? We don't have no plans at this point. I mean, we do have a longer term plan of a natural gas facility in Vietnam. And that's because in some markets, such as Vietnam, for example, you think it's a tropical country, but it doesn't have very good sun because it's very cloudy. It doesn't have a lot of wind. So basically, we will be bringing in LNG from the US to Vietnam and being able to burn LNG instead of building more coal plants in Vietnam, instead of burning heavy fuel oil. So it's really a transition fuel to that, say, carbon-free future. But certainly, over the next decade, I see a great need for natural gas. What are you hearing from your clients as they now also try to pivot, some of them needing to play catch up? What are some of the solutions they're looking at right now?
Well, what our clients are really looking for, and I would say that we have a very strong digital arm, AI assisted digital solutions. We have energy storage, and then we're the leaders in things like prefab solar, which we can roll out very quickly. So what the clients really want is more than saying, I want, solar or I want wind. They're moving towards, look, I need energy that looks like this, and I want it with the lowest carbon footprint possible. And of course, they want it as cheap as possible.
Right, that's always good. If you can give it to them at an attractive price, all the better. I know that with your recent earnings report, you did something few companies are doing right now. You issued guidance. You reaffirmed guidance and expectations for this year, also looking at 7 to 9% average annual growth through 2022. What made you feel so confident to be able to do that, Andres?
Yeah, we have a very resilient business model. Our business is 75% long-term contracted. So that means that, we have long-term, sometimes on average, like a 10-year contract for somebody to buy the capacity and buy the energy from our power plants. And then the other 25% is U.S. utilities. So at the beginning of the year, we said, look, let's basically guide down slightly because there might be a drop in demand in the U.S. utilities. But what we're seeing is that, quite frankly, we're going to be very close to our pre-COVID guidance, and we're going to be at the upper end of our revised guidance. And that really just shows what a resilient model we have.
Yep, exciting time for the company. Andres Gluski, President and CEO of AES. Thanks for stopping by.
Thank you very much, Alexis.
All right, switching gears here. It looks like China's Alibaba hit the jackpot with its mega shopping event called Singles Day. Emily McCormick is here now with the eye-popping sales totals. And Emily, I know Singles Day usually takes place over 24 hours on November 11th, but this year it was spread out over several days, right?
That's right, Alexa. Singles Day was a longer event this year for Alibaba and the other Chinese e-commerce giants that participated. This year, the event spanned from November 1st through the end of November 11th in China, when typically it is just a 24-hour shopping spree on 11/11. Now, Alibaba absolutely shattered sales records with this year's Singles Day. We saw over the course of those days, overall sales came in at more than $75 billion, or nearly double the $38 billion that Alibaba had brought in during Singles Day last year. Now, a similar strategy that we're seeing here from Alibaba relative to some of the US companies like Target and Walmart, which have really been pulling forward their discounts and special sales for Black Friday, for example, in order to try and capitalize on that pent-up consumer demand during the pandemic. Now, for Singles Day, a number of US companies, including Apple and Nike, also participated, offering some discounts on their products, or at least Alibaba offering discounts through the platform. And US singer Katy Perry actually performed via live stream at the kickoff yesterday. Now, Alibaba has not provided details or breakdowns on what products specifically or what companies' products actually sold best during the event. But just in terms of what this means overall for the company, Singles Day sales likely provided a much needed boost here for Alibaba, given the results that we saw for the September quarter, when sales growth was actually the slowest ever that we saw for a September quarter for Alibaba. Now, I also want to give an update on JD.com. That's an e-commerce company that competes with Alibaba. That company also offering Singles Day deals between the 1st and 11th of November this year. Those sales coming in at more than $40.8 billion. The company also giving some pretty shocking details about consumer demand during this year. The company noted that in the first 11 minutes of the Singles Day event, JD private label sales exceeded sales during the entirety of November 11th last year. So again, record-setting day for these Chinese e-commerce giants, and potentially something here that could feed into the results that we see for the current quarter. Alexis.
But, despite those record sales that you just laid out for us, we saw Alibaba stock and JD.com stock come under pressure, although I did see recently JD.com starting to bounce back. But does this have anything to do with the Chinese government coming out with those new antitrust regulations?
It absolutely does, Alexis. And we do still have shares of Alibaba down about 11% for November to date, really seeing China looking to rein in some of the power of the country's largest companies. And it could be consequential for Alibaba, JD.com, and other players like Tencent. We had the State Administration for Market Regulation releasing yesterday draft rules that listed specific guidelines over what it considered anti-competitive behavior. Now, these include conducting unfair pricing, selling below cost, limiting transactions to curb
curb competition and using data in certain ways to target shoppers. Now, these new rules also suggest that violators may be forced to divest assets, intellectual property, or technology, or adjust their algorithms. So that's something that could potentially create business changes that have to befall companies like Alibaba. Now, the administration is seeking public feedback on these regulations until November 30th. But again, just the specter of this additional crackdown causing a bit of choppiness in these stock prices. Alexis.
All right, Emily McCormick, thank you. And coming up, we'll look at where investors are putting their money to work when it comes to exchange-traded funds. We're back after this. Welcome back to Yahoo Finance Live. Time now for our ETF report brought to you by Invesco. Despite the stock market's stellar performance this year, there was still a lot of money sitting on the sidelines. My next guest says investors may want to think about putting that cash to work with some choice exchange-traded funds. Todd Rosenbluth is head of the ETF and mutual fund research at CFRA. Todd, good to see you here again. Tell us what demand has been like for ETFs over the past few weeks.
We've really started to see investors return to taking on risk heading into the election and then post-election. So we've seen, for example, the Spider S&P 500 ETF SPY as it goes by, which had been seeing outflows for much of the year. Really saw an institutional investor demand pick up. We saw inflows into some of the more cyclical sectors. The financial sector ETF, XLF, saw strong inflows since the election. I think there's optimism about the economy. There's optimism post or the likelihood of a vaccine coming to market in the coming weeks and months, and what that will do for the broader economy. And investors are more willing to take on risk using ETFs than they had been heading into the election.
What about demand for clean energy ETFs, especially if we do indeed have a Biden presidency? We know he's more focused on the environment than the Trump administration. He would most likely have the U.S. re-enter the Paris Climate Accord. Are you seeing investors sort of jockeying for position there?
We have. So this is something that was happening heading in, and prior to the election. We saw ETFs like Invesco's solar ETF, TAN. We saw Alps Clean Energy ETF, ACES, have had tremendous runs because the underlying securities have performed well. And we've seen those continue to see inflows in recent weeks. We at CFRA have a forward-looking approach to ETFs. And despite the fact that they've had a strong run, We think they're likely to continue to climb higher in the coming months. As you touched on, the Biden administration is going to be more favorable about clean energy than the Trump administration had been. And I think that's just going to be a driver in terms of overall demand. And that's the beauty of ETFs. You touched on with a prior guest about what's happening at one company in particular, but ETFs offer that diversification across various clean energy technologies, not just solar, for example.
You bring up a good point because I think a lot of investors are frankly a little confused about putting their money into something like an exchange traded fund versus a mutual fund, because you can get index ETFs and index mutual funds, so they could mirror something like the S&P 500. But can you give us some tick off some things that investors might want to consider when they're thinking about going with either an ETF or a mutual fund?
Right. So an ETF in general tends to have a lower expense ratio, a lower fee than a mutual fund. That's regardless of whether it's index-based or it's actively managed. Most ETFs, as you touched on, are index-based. So instead of trying to beat the market, they're trying to replicate an underlying index. There are actively managed ETFs, but there are fewer of those and fewer assets. ETFs are more tax efficient. So the trading takes place between buyer and seller and doesn't impact the underlying market. In fact, today is Veterans Day. The bond market is closed and you can buy or sell ETFs like HYG or TLT, among others, whereas a mutual fund that thus taps into the underlying bond market would be closed. So there's advantages, in fact, many more advantages for ETFs over mutual funds, but some investors are just comfortable with the mutual fund structure, and there's nothing wrong with holding on to something that's worked for you in the past.
No, there is not. All right, I want to get back to ETFs for a moment and some opportunities for investors, because we've been talking a lot about infrastructure. We'll have to see if it actually winds up happening under a Biden administration. But what about some ETF opportunities in that space?
Right. So, the Trump administration had talked about infrastructure, but we didn't see the money moving into it. And as a result, the ETFs didn't necessarily perform as well. There's a handful of ETFs, either that are US focused or global in terms of their infrastructure opportunities. One of them that's US focused, the ticker is PAVE, PAVE. It's a global X ETF. You got to love the tickers for some of these thematic oriented ETFs that paint a real picture. But you get exposure to industrials and materials companies that should do well if there is US infrastructure spending. There's another ETF from ProShares, TOLZ, which is a global infrastructure across various sectors. iShares has a global infrastructure ETF. I think the ticker on that is IGF. Apologies if I'm wrong on that. The good thing is you have various choices to be able to participate if you want something that crosses sector. We touched on a bit industrials, and your prior guest talked about industrials being a great way to play infrastructure spending and just a recovery in the economy. And XLI, the Industrial Select Sector Spider ETF, is by far the largest of these sector-oriented ETFs across various S&P 500 companies, and it's market cap weighted.
All right, great insights as usual. Todd Rosenbluth of CFRA, thank you.
Thank you.
Coming up, has the exodus out of big cities during the pandemic been overblown? And a little later, Chipotle opens its first digital-only store. We'll tell you where it is and what you can expect after this. Oil prices are extending their advance. A report late yesterday from the American Petroleum Institute added to the bullish sentiment. It showed a large drop in U.S. crude oil stockpiles. The oil market's closing just a short time ago. Jared Blickery is here now with a wrap-up. Hi again, Jared.
Hi again. And normally on a Wednesday, we'd get the DOE official numbers at 10:30 a.m. That's being pushed out because of the Veterans Day bond market holiday and bank holiday that we're seeing today. But crude is still up. It's trading at 41.47 right now, just settled at 41.45 at 2:30 p.m. for the official settlement. But let's take a look at some charts here. Now, this is a 2-month chart, and you can see the price action over the last 2 weeks. Pretty bullish here, but I want to point out a couple things on this candlestick chart. We had a rejection of the 33 and change low, and we can see that with this wick right here on the candlestick. And we just had a rejection of the $43 level, and that's indicated by this wick right here. So the meat in between is kind of 35 to 42. Maybe that's the trading range, with something that we've been talking about with a lot of analysts. And you can see over the last 6 months here, we've been trading roughly sideways since June in this big box. So not a lot of surprises here, but we do have some incremental news on the next OPEC meeting. The OPEC president is saying that that OPEC might be able to extend the production cuts or even increase them going into next year. And so that does give a little bit of a bullish tilt to the market, but we will be looking out for that DOE report later this week, Alexis.
All right. Thanks so much, Jared. Chipotle has seen its digital sales skyrocket during the pandemic. Now it's trying to capitalize on that newfound revenue stream by opening its first ever digital-only restaurant in upstate New York. Sabeel Marcellus has the scoop for us. Sabeel, pretty exciting news here for Chipotle. Tell us how this digital-only restaurant's going to work.
Yeah, so this is super exciting when you're looking at the reaction from investors. So Chipotle's stock is up more than 5%. And Chipotle is one of those fast food companies that's been doing really well during the pandemic. They're up more than 50% year to date. And the third quarter, their digital sales were more than tripled in the last quarter. So it's really impressive to see how Chipotle has been handling the pandemic. People have really been going there, relying on them. And now they're opening their first digital-only restaurant. They're opening it on Saturday in New York. And the way it's going to work is that basically you can use your app or go online. You can order your meal, get it delivered to you, and you don't have to wait in line to place your order or have to deal with the dining room situation. Now, this is part of Chipotle's push to expand in urban areas where if it's a digital-only restaurant, they don't have to worry about expensive real estate. So once they open this digital-only restaurant, we'll see how much they expand. But of course, other fast food rivals are also expanding their own digital offerings. You've got, for example, Burger King and Shake Shack. They're adding new drive-through lanes. You also have Starbucks adding new mobile cafes for pickup. And in terms of Chipotle, they expect the digital sales to go even higher this year, more than double what it was last year, to surpass $2.5 billion.
Wow, I have a feeling we're going to see more of these, Sabeel. I mean, I know this is just sort of a test run, but I have to think we're going to see more. Sabeel Marcellus, thank you. And perhaps a sign of the times, JP Morgan Chase has tightened mortgage terms on jumbo loans for co-ops and condominiums in Manhattan. Many lenders are following similar paths during the pandemic, raising maximum credit score requirements, requiring more cash reserves, even limiting or altogether eliminating home equity loans. Joining me now to talk real estate is Jonathan Miller, real estate appraiser and consultant with Miller Samuel. Jonathan, always good to see you.
Likewise.
What number of loans in Manhattan are these jumbo loans? Did this surprise you to see what JPM is doing?
Well, actually, initially, my response was I was encouraged because we're actually seeing financial institutions practice risk management, which is not what we saw during the financial crisis. The other sense I get is since about 50% of the mortgages that are issued in Manhattan or rather 50% of the sales have a mortgage. The other 50% are cash. So this is not catastrophic or significant to the market, but it is another headwind that the market has to deal with. A market that's been pretty slow coming out of the lockdown period, unlike most other markets around the country.
Is Manhattan, though, an anomaly here, or are you seeing these kinds of things taking place in other large metropolitan areas?
Well, at least now it seems to be more of an anomaly. And I think it's because it's been the laggard nationwide in terms of contract activity responding, coming back to life after the lockdown for COVID. In fact, when you look at, I cover about 36 different housing markets across the U.S., and all these markets are seeing sales well above last year's levels, and New York is still trailing, or Manhattan specifically is still trailing.
When you look at all of those places that you cover, are you seeing this exodus out of cities to the suburbs continuing at the pace we saw just a few months ago when the pandemic was when we were in the throes of the pandemic?
No, we're not. When you look at I call it a rocket ship, essentially from April or May up to about July, around the country, there was this surge in contract activity, and it was driven by two factors. One was just the fact that there wasn't a spring market. So everybody that was looking to buy or looking to sell during the normal spring, which is the most robust period of any housing year, the can was kicked down the road into the summer. So you had that combined with this outbound migration from urban markets out of concerns, safety, close proximity to others. What we've really been seeing around the U.S. has been, since about July and August, depending on the market, is we're seeing suburban markets that were benefiting from inbound migration from urban markets are actually plateauing or declining, still well above year-ago levels, but that sort of rocket ship trajectory has not been able to be sustained.
I want to move from buying to renting for a moment, because a lot of those moratoriums that we saw are going to be lifted very soon, and folks are not going to be able to make good on those rent payments. When are we going to start to see this tsunami, if you will, and what will the domino effect be for the landlords, who then in turn will not be able to pay off their mortgages?
Right. It's not a good situation, and there's a lot of uncertainty tied to it. Both the foreclosure, there's a foreclosure moratorium and there's an eviction moratorium. Both are expiring or set to expire at the end of the year. So unless they're extended, we could see a lot of difficulty, a lot of economic damage to the housing market beginning at the beginning of the year. So that's a real concern. And that would, like you had mentioned, that would bring on, perhaps a lot of default rates, raise the default rate on small-time landlords. In the U.S., about 50% of landlords are actually small businesses. They're not large REITs. And so they're particularly vulnerable.
But, we're seeing a lot of those rents fall right now because people have been leaving cities. Are you seeing a sign that people are coming back into the cities now to take advantage of those lower rents?
Yes, we are. One of the things that happens when you have inventory raised to very high levels, you have concessions very high by landlords, and you're seeing rents fall. At some point, you start seeing tenants come in, or would-be tenants or renters come in, and essentially that's what we're starting to see. It began in Brooklyn and New York City, and seems to be spreading, where you're actually having a break even or an uptick in activity from last year, which was unthinkable 2 or 3 months ago, given how far behind the rental market is. Granted, activity is our pricing is at a much lower level in general than what it was. And one of the reasons for that is because rents are closely, very reactive to economic conditions. And the unemployment picture in the U.S., although it's been improving, has been heavily skewed against lower wage earners, which tend to be renters versus homeowners, and have been impacted disproportionately.
You mentioned earlier that New York City is sort of lagging other large metropolitan areas and bouncing back from the depths of the pandemic. Where do you see New York City real estate a year from now? Because, we always talk about the resiliency of this market. You look at history as a guide. After 9/11, after the Great Recession, the fiscal crisis of the 1970s, it did bounce back. It came back better and stronger. But is this time going to be different? What do you see a year from now?
Well, I think a year from now, we're just going to be in the vaccine distribution process. I really think that we still have a couple of years before we can start thinking about recovery. I think we're sort of, we're going to be muddling along as a market until people feel comfortable coming back in. And we're not going to be where we were in the past because of Zoom, of the ability of workers to work remotely. So I think we're going to end up with a hybrid, and that's going to, the city's going to have to adapt to that. One thing that is encouraging is that we're seeing a tremendous influx of younger consumers. And, we may end up seeing some sort of renaissance that we can't really imagine at this point. I'm very optimistic about that aspect of the city's future.
All right, we'll leave it on an optimistic note. Jonathan Miller of Miller Samuel, thanks so much.
You bet. Thank you.
Coming up, why millions of Americans are still waiting for their unemployment insurance checks 8 months into the pandemic. An unprecedented number of Americans have applied for unemployment insurance since March, but a new report finds as many as 6 million people still have not received benefits because of ineligibility or a backlog. Denitsa Sikova covers personal finance for Yahoo Finance, and she recently wrote an article on this. Denitsa, good to have you with us. So tell us, what gives? Why are millions of these people still out in the cold?
So yeah, as you said, it's nearly half of the people who filed those claims in the last 6 months. These are 21 million people out of 47. So what we have to here is two things. The first thing is 15 million people have been ineligible. Some of those people maybe have moved to other programs. So we can't say that all of them have got no benefits. Some of them may have filled the application with maybe mismatching a name, not putting the right address that they have on their driver's license, and so on and so forth. But the second thing that's going on, it's a really big issue, is that 6 million, which is 1 in 8 of the people who have applied, are still waiting for a decision. And as you remember, in March, we had nearly 7 million claims in 1 week. So there was a really the system was really overwhelmed. But now we're 6 months into that pandemic, and we still have a huge backlog. And people are waiting 4 to even 16 weeks to get their benefits. And that makes a really big difference. And what we're seeing is, like everything with unemployment systems, there are states like Georgia, Washington, Oklahoma, which have had really big difficulty paying the benefits and are very slow to process the claims. And people living there may have wait even longer or have higher chances of getting their applications rejected.
Yeah, I mean, it's startling and really unacceptable for those millions of people who are struggling. So what have some of them been able to do? Have they gone to other programs? Are there other programs out there, and what do they look like?
Yeah, that's a great question. So under the CARES Act, which gave us a lot of relief, and one of the things was the pandemic unemployment assistance. So that was a program that was available to contractors, self-employed workers, and all those workers who don't necessarily qualify for our typical unemployment insurance system. And they got pretty much the same unemployment benefits, they got the extra benefits and everything throughout the pandemic. But the problem here is that system is expiring in 6 weeks at the end of the year. And last week, there were 9 million people who were part of that program and were getting benefits. So at the end of December, millions of Americans won't get any unemployment benefits because they won't be able to qualify for the normal program. So what we're seeing here is a really big cliff of millions of Americans who are going to lose unemployment benefits. And this happens after we had already 2 cliffs. So the 600 expired in July, a really big hit for unemployment Americans. And then the 300 under the president's memorandum expired in September, another really big hit. So what we're seeing is moving from very generous government support to super limited government support. And the public health crisis hasn't really got better.
No, it has not. All right, some sobering statistics there. Denisa Sakova, thank you.
Thank you.
Coming up, did the Trump administration forget about its fight with TikTok? Details straight ahead. The deadline for TikTok to sell its U.S. assets is this week, but the popular Chinese video app says they haven't heard from the Trump administration for weeks now. Tech editor Dan Howley joining us for this one. So I wonder, Dan, if all, the lead up to the election, now we have a contested election, did the Trump administration forget about TikTok?
Yeah, it seems that way. At least according to ByteDance, they've been asking CFIUS, that's the Committee on Foreign Investment in the United States, basically to allow them that 30-day extension from the November 12th deadline that really called for ByteDance to divest itself of any of its U.S. assets. But they haven't heard anything from CFIUS or the administration. That basically means that unless there's something else available to them, they would have to go ahead and follow that November 12th order. But there's also a secondary case that's going on that allowed them to avoid that deadline. So where exactly the CFIUS order stands remains to be seen. And look, it is, according to my watch, a day away from when they're going to have to follow up with what CFIUS has ordered. So it really is interesting to see the administration go from what seemed like a 5-alarm fire here with TikTok to kind of forgetting that they left the burners on entirely and allowing it to continue to kind of languish here. They do have, by the way, ByteDance, that agreement with Walmart and Oracle that was supposed to go forward, but that hasn't had sign off from China yet. So that's still stalled as well. So it really does feel like ByteDance and TikTok are left here in limbo along with all of their users.
I want to follow up real quickly here with Facebook. They're not going to be, or they are going to be extending their political ads on the platform?
Yeah, they're going to be extending a ban on political ads on the platform for an extra month. And this comes as we're seeing a lot of disinformation going around about the election, people claiming various degrees of fraud, none of which has been proven and all of which, in fact, has been disproven. The New York Times actually called up the election heads from each state and found no evidence of any form of widespread fraud. But because of this, Facebook is going to extend that ban on political ads for another month. Once it's over, hopefully those kinds of rumors will go away. But chances are it's Facebook, they'll still be there.
All right, Dan Howley, thank you. Coming up in the next hour, we're going to speak with FanDuel CEO Matt King. Mixed market at the moment, tech stocks taking off with the Nasdaq up nearly 2%. I'm Alexis Christoforous. Thanks for being with us.
We've got about an hour left in the trading day, and here's what's happening. Alibaba sets new singles day records with more than 74 billion in sales as the multi-day deal bonanza becomes the largest shopping event in the world. But threats of new regulations may go boom in Jack Ma's face. A new study shows the hot spots to avoid catching the coronavirus, and it's bad news for businesses struggling to reopen as the pandemic reaches new infection records in the United States. Beyond Meat hopes to score a bigger piece of the pie with its new Pizza Hut partnership. CEO Ethan Brown spoke with our Brian Sawsey about serving up better earnings following this week's disappointing earnings report. Welcome to Yahoo Finance Live. I'm Adam Shapiro.
And I'm Shauna Smith. You're looking at a mixed market here with just an hour to go in the trading day. The Dow has not ventured too far from the flat line, off just around 81 points right now. The S&P back in the green, up just around 0.5%. But the Nasdaq, the rotation back into some of those big tech names, that's what's really helping the performance today. And with that, Adam, I want to take a look at what we're seeing from Amazon today, because this has been in the group of stocks here that have been beaten down over the last couple of days. The stock bouncing back today, up just around 2.5%. We've seen Amazon and some of those other big tech names fall out of favor as investors really focus on and buy into some of those cyclical names, those beaten down names that haven't really been in favor during most of the pandemic. So Amazon gaining today, Apple is another big standout. And then you also have names like Facebook and Google here posting gains right now. For the week though, it's still a little bit of a different story. Amazon sell off just around 5.5%. I also want to take a look at what we're seeing in Lyft. So we had earnings out yesterday. This name was very closely watched given the pandemic and the impact that that has had on the ride sharing business. Shares today, we're not too far from the flat line, right around there today, giving up some of those earlier gains that we saw. The street, though, still seems to be digesting some of the numbers that we got out yesterday. We did hear from Lyft executives, though, saying that they do expect to be EBITDA profitable by the end of 2021, so by the end of next year. Adam, we had revenue topping the estimates, but when you take a look at the share price reaction, Jay, it seems like investors are still trying to make sense of the numbers that we got out yesterday.
Shauna, watching Moderna, especially after the news we got from Pfizer, so those shares are up almost 10%. They've been trading higher all session long. Part of this is what Goldman Sachs chief strategist David Kostin said. He upped the S&P year-end price target, and he said, quote, "A vaccine is a more important development for the economy and markets than the prospective policies of a Biden presidency." Now, you can read more about Goldman and what they're predicting for the S&P 500 year-end 2020 in Brian Sawzy's latest, which is on the yahoofinance.com platform. But regarding Moderna, they've got an experimental vaccine very similar to the Pfizer vaccine, has to be stored very cold. Remember, Pfizer's vaccine stored at minus 100 degrees. The Moderna vaccine, not quite as cold, but still a chilly -4. They are going to report early data from late-stage trials later this month. So all eyes on Moderna, especially after the Goldman call. Then there's the issue with Atlas Air. We talk a lot about the airlines, and when we talk about the airlines, the passenger airlines. But cargo's been a big story during the pandemic, and Atlas Air, they are the largest air freight in the world, with largest owner of 747 freight jets in service. They reported third quarter revenue not too long ago, $810 million. Analysts are looking at the 2021 full year revenue are upping at 4.4%, not dramatic, but still good, to 3.16 billion. So what does this mean for Atlas Air? Well, shares today have been flat to up almost 2%. Right now, not quite 1%. Cowen analyst Helene Becker is going to join us in the 4 p.m. hour with more, not only on Atlas, which has a potential pandemic business slowdown, positioned well for the future, but some of the other airlines that you may not be paying attention to. But right now, Shauna, I'm throwing it back to you, right?
It's all about the markets right now, Adam, with just around 60 minutes, a little less than that, 56 minutes left in the trading day. When you take a look at the action that we're seeing, it's a bit of a mixed picture. I mentioned the fact that the Dow is moving to the downside off just around 95 points right now, but the S&P and Nasdaq are holding on to gains. And a big reason for that is the outperformance that we're seeing in some of those big tech names. So for more on this, we want to bring in Kevin Mon. He's the Chief Investment Officer at Hennian and Walsh Asset Management. And Kevin, great to have you on the program. Stocks, I guess you could say, taking a bit of a breather today outside of what we're seeing of some of the buying action in technology. But what do you make of the market at this point? Is there reason, do you think, that this rally is going to keep going?
Yeah, and I think what's happened over the course of the past couple of days is the pullbacks we've seen in certain areas that have really been providing performance to the market throughout the context of the COVID-19 pandemic in areas such as biotech, larger cap healthcare, traditional technologies, revolutionary technologies, and e-commerce perhaps have created attractive entry points for investors looking for growth opportunities in the months and years ahead, as it's hard to imagine that Americans and, quite frankly, citizens across the globe aren't going to continue to shop more remotely, aren't going to continue to work more remotely. And God forbid, unfortunately, there are likely more rare and chronic diseases that will plague society for years to come. And the solutions to those types of viruses and diseases generally come from the smaller cap biotech companies. So we do see growth opportunities there, but we're getting more and more inquiries, Shauna, on income opportunities given the relative lack of income opportunities that exist in traditional areas right now.
So, Kevin, it's great to see you. Let's talk about income opportunities because what is it? Fisher always says, don't buy an annuity. We won't go there. But you talk about portfolios of preferred securities. Now, when I hear that kind of phrase, I'm thinking way back to Warren Buffett having preferred shares in Goldman, that kind of thing. Is that what you're talking about? How does someone who doesn't have billions get in on a preferred shares like you're talking about?
Sure. And given, Adam, that the Fed has basically told us that they're likely to keep rates at or near zero for many years to come, with the most recently issued dot plot chart suggesting that 15 of the 17 voting members think they'll keep the Fed funds target rate in the range of 0 to 25 basis points all the way through the end of 2022. Where do investors turn for income? Preferred securities, municipal bonds or municipal bond strategies, and dividend paying equities are three areas that we think are worthy of consideration. Preferred securities. They represent ownership in a corporation and have characteristics of both bonds and equities. Preferreds generally pay a fixed income, they hold a par value, they have a credit rating, and they trade on major exchanges. Generally, issuers of preferreds come from the financial sectors. In fact, the majority are bank-issued preferreds, but they pay an income level that's above that of common shareholders and generally above bondholders as well. So there's a lot of attraction towards preferred securities right now when you can earn a yield of 4-5% versus the 10-year treasury that's yielding around a little less than 1% right now.
Well, Kevin, I mean, it's interesting what you're saying. Well, let's go back to one of the things that you were talking about, and that's muni bonds, because it's interesting when you see, I guess, how the outperformance or the attractiveness that this has been over the last couple of months, because we had a total of $71 billion flow into that in October. It was a record-setting month for muni bond issuance. You mentioned that in your note. Why do you think then that demand is going to remain strong for muni bonds? Because I think you could also argue that there could be a couple of headwinds that they could face here down the road.
Certainly, and that's why you need to be selective, Shauna, in terms of the municipal bonds that you invest in. And we generally prefer to stay in the investment grade category. You are correct. There was a record-setting month of over $71 billion in issuance in October, as a lot of municipalities pulled their deals forward to avoid the election uncertainty in the month of November. Now, what we see is that supply is likely to fall significantly in the months of November and December. And if demand remains where it is or increases as higher net worth investors fear that higher taxes may be on the way, you could see even a higher amount of demand for municipal bonds and tax-free income in general. So that equation of lower supply, higher demand generally translates to good price performance.
When you mention municipal bonds, I hear Mitch McConnell say, let them go bankrupt. We'll invite you back on that issue because they can't go bankrupt. Who knows in this world? But the other issue, an old-fashioned way to get income are dividends. But I got to warn you, Kevin, and Royal Dutch Shell for years and years and years never cut the dividend. And then guess what they did? They cut the dividend. So what advice do you have for people who want to go the old-fashioned route?
Yeah, and it's good advice on your part, Adam, as I believe I saw a stat that over 639 or 640 companies have cut or suspended their dividends over the course of the COVID-19 pandemic. So you need to find those companies that have strong balance sheets, a history of growing their dividends, positive free cash flow to support that dividend, and also have relative growth prospects as well. As going back to 1930, dividends have accounted for over 42% of the total return of the S&P 500. I think that relative percentage is only going to grow in the years ahead, given where valuations are right now. So if you can find a consistent dividend payer of a company that's within a sector that's likely to continue to grow, such as technology, such as e-commerce, I think that's certainly worthy of consideration.
All right, Kevin Mon, great to have you back on the program. Chief Investment Officer of Hennian and Walsh Asset Management.
Thanks,
All right,
very well.
Here on Yahoo Finance Live, we'll get an update on the pandemic as hospitals see a record number of patients, plus a new study showing that the hot spots you want to avoid so you don't catch the virus. We're back with all that in just 2 minutes.
About 46 minutes till the closing bell. S&P 500 still positive, up 20 points. Dow's off, but not quite as much as it had been. It's off about 70 points. Nasdaq is positive today. It's up 200 points. During the commercial breaks, we solve all of the world's problems, and the big problem right now, COVID-19. We talk about these things as we prepare to talk about the big news, and that's why we invite in right now Angelique Kamlani for the latest on so many things that are breaking with COVID-19. There's that study about the hotspots to avoid. There's also the news out of New York taking a step back, right?
That's correct, Adam. So what we've seen, and this is, the buildup that health experts have been warning about for some time, and that is that we are going to see not just the increase of cases, but the trend that follows with it, which is increased hospitalizations, which then could lead to the 2-week delay before we start seeing that number affect the death toll. So as it stands right now, still getting more than 100,000 cases per day, a record here in the U.S., as well as hospitalizations now surpassing that of what we saw in April at more than 51,000 cases. So that's really a number that's concerning. We know that a lot of hospitals are strained right now, and there's been so much discussion up to this point about what needs to be done in order to help avoid that strain once again. Of course, no one has the appetite for a full lockdown, but things like curfews and reducing the capacity of specific businesses is a key to this. Many health experts say to that point. Stanford University out with a new study showing that bars, hotels, gyms, and restaurants are among the locations that have contributed to this high case count, and that's something that we know has been happening across the country. And in that note itself, in that study itself, citing the fact that just the idea of reduced capacity and limited hours could help with curbing this outbreak and this next wave. And so New York State, to that point, a curfew by 10 p.m. And that's something that we've seen rolled out throughout the country in different areas, but it's mostly been cities or specific local government action, like in El Paso, Miami-Dade County, Newark, Philadelphia. We've seen these curfews start to take hold, but more widespread use of that strategy is what health experts say is needed right now. Adam?
Angelique Kamlani, our COVID and health correspondent here at Yahoo Finance Live. Let's move this discussion forward with Dr. Lakshman Swamy. He's the ICU physician at Boston's Medical Center. Good to have you here, doctor. And as we talk about these potential upswings and we see cities like ours taking a step back, what's the most important thing you would want the people who are watching us right now to consider?
I think the most important thing right now is for people to realize that you can get away with doing a lot less in terms of pulling back on indoor dining and all of this without having to do a full lockdown if you do it sooner. And it's already, I think, passed soon for many states in the country. We're certainly feeling that up here in Massachusetts as well. We're starting to see the rollback happening, but I think the economic pressure is real everywhere. So I'm worried that the delays in pulling back are pretty serious. Individual actions matter too, right? Just because indoor dining is open doesn't mean everyone has to go and use it.
Doctor, what are the metrics that you're looking at just to determine? I mean, we're talking about how these government officials are a little bit delayed in their actions to pull back on some of their efforts. When should they be taking action at this point?
Yeah, I think, one of the challenging things about COVID is there's so much nuance involved. There's so many different metrics that are used for different purposes. I'll tell you as a clinician, what I'm thinking is, how many patients am I seeing in the ICU? And I'm seeing more. It's radically different across Boston, across the state than it was, a month or two ago. We're feeling it, right? We're seeing the case counts go up, in our region, across the country. So I think all of the metrics are to some degree lining up, and you can always make a case for, well, this one looks okay, that one doesn't. On the whole, I think we know what we're seeing.
Doctor, as we see the case counts go up, we're seeing the ability, I don't know how to phrase it, is it the death rate? We're seeing fewer people die. Is that because we have better treatments, or is that because it's younger people being admitted to the hospital?
I would say all of the above and more. I think compared to in the spring, the first thing that I would say is that the hospitals were under extreme strain. And when you hit that point, I think the care that's delivered is just, it's frayed, it's fragmented, it's diluted. It's hard to give people the attention they need. So the first thing is that. The second thing is certainly, as you said, younger people, the infection is it's spreading widely in a different way. We know what we're doing, I think, better. We certainly don't know everything, but we've improved our practices significantly. We've published on this a good bit. Not intubating people quite as early, quite as aggressively, using alternate technologies to get oxygen in without the breathing tube, without the ventilator. Dexamethasone, remdesivir. We have more knowledge, more skill now than we did in the spring too.
You're with Boston Medical Center. Do you have enough tests? Do you have enough PPE equipment to get you through a scenario that some are describing could get dramatically worse over the next couple of months?
Yeah, fortunately, I actually work at a number of hospitals across the city right now. And what I can say is that everywhere I work, I think now, compared especially to the early spring, we have a certain degree of comfort in knowing we have enough for right now. There's always this real, we're still rationing everywhere. I'm still reusing N95s around all the time. And I think what's especially concerning is that I'm wearing the N95 for the entire shift now. So everything's getting a lot more use out of it, and we're reusing it a lot. But on the other hand, it doesn't feel like the supply is going to fall out from under our feet like it did so much in the spring. This is all in the setting of rising cases without a real surge, though, still. So, of course, we're worried.
There was a report, I think I heard it on NPR, that talked about the change at the federal government, that not getting the data out there that allows hospitals within one community to share the kinds of things they might have available with one another. Is that true? And is that hindering our effort to treat Americans who are coming down with the disease?
I can tell you that, COVID absolutely exposes all of the vulnerabilities in our healthcare system, especially how fragmented and siloed we are within an institution, between institutions, between regions, between states. And we've advocated for, it really takes senior leadership at the federal level to be able to say, we need to move the resources to where they're needed, not just ventilators, but people. We need staff. How many people had to come in from other regions to help New York, to help Boston? And we need to have those pipelines ready to go, because staff everywhere are still exhausted, and we're dreading the kind of overwork, volunteer work, double, triple shifts, all that stuff that we know is coming.
Dr. Lakshman Swamy is ICU physician at Boston Medical Center. Thank you so much for joining us here on Yahoo Finance Live.
Thanks for having me.
Remember that poem, "My name is Ozymandias, King of Kings, look on my works, ye mighty and despair." So why do I quote that poem? I think it was Shelley. Because believe it or not, the Trump administration, they've forgotten about TikTok. Why the Chinese video app company is stuck in limbo as it figures out a sale of its US-based assets. We're back in 2 minutes.
Welcome back. TikTok wants the deadline to sell its U.S. operations to be extended. Its current company, ByteDance, now asking a U.S. appeals court for more time. Akiko Fujita has been following the story very closely for us here at Yahoo Finance. And Akiko, we're really down to the wire. We talk about the deadline being tomorrow. And from what we've heard, at least from ByteDance's point of view, it seems like the U.S. government has forgotten about it.
Yeah, they just haven't heard much from the government. And to backtrack a bit here, Shauna, because it's been a very long road to get here. All of this stems from that original ruling that came down from CFIUS, the Committee on Foreign Investment to the U.S. that called for TikTok to divest its U.S. operations by November 12th, essentially unwind that deal with Musical.ly unless the parent company ByteDance was able to sell its U.S. assets to an American company. Remember, there was Oracle and Walmart that came forward saying they, in fact, would be interested in that. Well, that proposal still has not been finalized. And now we're looking at the November 12th deadline. And TikTok says it just hasn't gotten any feedback from the U.S. government. TikTok yesterday filing a petition in the U.S. Court of Appeals saying despite their efforts to engage with CFIUS in good faith over the last 2 months, they simply haven't gotten, in their words, a substantive feedback on changes the company has proposed to address national security concerns. They've said that they have not gotten a lot on the privacy issue and the security framework. Now, there are a number of lawsuits that have been filed through the courts over the last few months. In September, TikTok filed an injunction asking for a 30-day extension to this deadline. That has not been granted. But you also had a lawsuit over in Pennsylvania that was filed by content creators on TikTok that had more than 1 million followers. They're essentially calling on the judge to halt this November 12th ban because that would take away, and there were professional opportunities for them. So the judge sided with those content creators that halted this November 12th deadline. And yet TikTok says we simply haven't heard from the U.S. government on how they want to move forward. And I want to be clear, this doesn't mean that the issue has been resolved in any way. And this filing in the U.S. Court of Appeals is essentially the company saying, please just explain to us where things stand. Do we need to make the changes? What happens when the November 12th deadline comes? And they simply haven't gotten any answers on that front.
Well, Akiko, I wanted to ask you about that just because if the deadline comes and goes, do we know what happens at this point? It sounds like everything then is still up in the air.
It is up in the air. And if you look at the CFIUS ruling, there's no real specifics about what happens if TikTok, or ByteDance, I should say, does not divest its U.S. operations, which is exactly why they're seeking that clarity. Now, Shauna, remember the conversation we had in the lead up to all of this, which was when we were looking at the November 12th deadline, we said, look, by the way, that's going to be after the election. That deadline was set because CFIUS traditionally has this 90-day review period. But you do have to wonder how aggressively the Trump administration wants to move forward with this. Because this was largely seen in the eyes of some as a political move to try and drum up the base to really go strongly against these Chinese tech companies. Having said that, we have seen both sides, both parties, lawmakers coming forward and saying they do, in fact, have national security concerns with some of these Chinese tech companies. So it's going to be interesting to see how they move forward with this, especially because TikTok says they just haven't heard anything as it relates to this ruling.
Certainly will be. And Akiko, you said it's been a long and winding road to get here. And I know that we're not even close to being at the end of that road. So I know we're going to be talking about this for quite some time. Akiko Fujita, thanks so much for breaking down the latest for us. All right, we want to turn to the housing market. We talk a lot about the mass exodus that we're seeing from cities to the suburbs. A lot of the people that are doing that being first-time home buyers. But there's a new study out showing that first-time home buyers actually hit the lowest level that we have seen in more than 30 years. We want to bring in Sarah Painter. She's been looking into this for us. And Sarah, you've been closely watching the housing market and the various dynamics at play over the course of the pandemic. Why is this the case? Why is the fact that first-time home buyers is hitting the lowest level that we have seen in quite some time?
Yeah, thank you. So first-time home buyers are often looking for homes that are at $200,000 or less. And right now, those homes are not available on the market. The housing market is so hot. There's so much demand that we have bidding wars driving prices up. And in addition to those low interest rates, that adds to demand. And so we have a lot of people trying to enter the housing market, and low price houses just are moving very quickly. They're getting more expensive and there aren't enough of them. So first time home buyers have been left out for the most part of this housing boom.
Sarah, is it a case of local, 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 or is this across the United States the exact same story?
It's going to be different, of course, in different local markets. This is the story for the most part across the U.S. But we do have more affordable options in certain local markets. And as prices are coming down for rents, especially in cities, young people are having more success there, but it's still very expensive to buy a house or a condo in a city. So it's still very difficult for first-time home buyers everywhere. The only first-time home buyers that are doing well are those that didn't have any disruption in their employment during the pandemic, that they were already very secure and were able to even maybe save up more because they weren't going out. That is a little bit more rare because anyone who doesn't own a home, someone who's a renter, is going to be more likely to make less money, have lower credit scores, and struggle a little bit more financially. So for the most part, this group was hit harder than other groups, but there are some who were able to save up more and enter the market as well.
Sarah, it's interesting because this is such an unprecedented time. So if you're out there looking to buy a home, you're not exactly going to see maybe as many houses as you would if you were doing this a year ago. A lot of potential home buyers have turned to virtual tours of their possible homes. Is this a trend? From you talking to people within the industry, is this a trend that's expected to continue here once we get past the pandemic?
It is expected to continue. Most home buyers are looking at about 9 homes during their home search, and that's been the case for the past couple of years. But this year, 5 of those homes they toured virtually. So that cut down on the in-person tours, just down to four in person. And the expectation is that that's not going to necessarily keep going past the pandemic, but it will help people be narrowing down their options. And now that infrastructure of doing those virtual tours exists, that can help people to be touring the houses virtually and see what maybe isn't a good fit for them, so that they can see only a more select number of houses in person.
Certainly a good way to save some time. All right, Sarah Painter, thanks so much for joining us. Coming up here on Yahoo Finance Live, Alibaba sets a new singles day record with more than $74 billion in sales. We're going to talk a little bit more about that with Foresight's Deborah Weinsflake. We're back with that in just 2 minutes.
All right, as we head towards the closing bell in roughly, what is it, about 27 minutes, take a look at what's happening with shares of Alibaba. So they're off right now about 0.5%, but the big news today was the $74 billion in sales during Singles Day, which is actually single days plural because it was November 1st through midnight on the 12th, China time. Let's discuss what this means and what it means for actually, the United States as well, because there is a component here that we need to address, and we're going to do that with Deborah Weinswig. She is CoreSite Research founder and CEO. It's good to have you here. And what is your takeaway? Because are you surprised that shares, at least here in the States, are trading down a bit?
I'm certainly surprised because, while we had high expectations, I don't think anyone was thinking $74.1 billion, certainly not $5.3 billion of that driven from the US. And, it's maybe everyone's kind of taking a moment and digesting, but it's everything we saw from Golden Week, right, which is the first week of October, certainly pointed kind of up and to the right. And that's definitely the path trend that we've continued to see.
Deborah, how about the success that we've seen from the U.S. brands? Because when you they broke out the U.S. sales for the first time this year, above $5 billion was the last figure I saw. What message does this send to the U.S. brands just in terms of their opportunity that's out in front of them in China?
The opportunity is significant. We saw some of the brands who'd been considering to head to China realize they had a lot of excess inventory, kind of hopped onto the platform, let's call it May, June, and from day one, they were, I think, the strength of their sales was unexpected. And we saw many companies sell out. I mean, if you look at just the data, there were 342 brands that did over $100 million in GMV. And these included companies like Adidas, Apple, Estee Lauder, L'Oreal, Lancome, and Nike. And right in the first 111 minutes, so let's call it 2 hours, they kind of hit these targets, which let's call it $15 million. I mean, that's significant.
Significant, but you also, I don't know if this is a warning or if this is a good sign. You point out the increased quality of apparel and footwear offered by Chinese mid-market brands is set to impact sales of global and U.S. brands during Singles Day. Break that down for me. Are we losing our market?
We've continued to see, and I really, what keeps me up at night truly is in the luxury side, because we are starting to see local luxury brands, and that market has represented at least 1/3, if not 50%, of many of the luxury brands' business. For many others, it is important, but not quite at that level. We are continuing to see not only, I'd say, this discovery process through live streaming, right, for many consumers in kind of tier 1 cities to rural cities, but this idea that they are discovering brands, there are a lot of new brands, and there's a lot of noise. That's why Singles Day is really kind of there's a lot more art in some ways than science around it. But it is very complicated to succeed. But we certainly have seen many brands do that.
Deborah, going off of that, I mean, what are some of the things that the global brands fall short on? Because when we talk about, you say that the Chinese market is so important, there's so much opportunity there. A lot of these global brands looking there. What are some of these brands doing wrong?
It isn't what you would think, because it often is customer service. And this idea, right, the Chinese customer is very discerning, very demanding. And this idea that there is any question or any issue with something you bought, they do expect to get somebody on a phone or a live chat. And what we often see, right, is in the customer service associate perspective, they will have the item there handy, and they will be able to talk the customer off the ledge, if you will, and oftentimes convert them into, right, a brand loyalist and almost an influencer for them. I don't think here in the West we understand the level of importance of that. And I do think that there is an investment that's needed there, but also there's a training aspect as well.
When we take a look at Alibaba's growth in China, what is it, 600 million people in the middle class? They haven't even begun to push the outer bounds of this. Do you have any projections?
Well, what I think was, to me, personally very interesting, if you look at the city tiers, the tier 1 cities and the rural were the strongest for Double 11. And what we saw in kind of the rural markets was around, kind of smart products. And I think, if you looked at, I think it was like sales of smart watches were up 144% year on year, smart accessories up 128%, electric toothbrushes, right, up 212%. So there are, right, this is a very large market, increasingly sophisticated, tier 1 city versus rural. There's a lot of room for growth, exactly as you said, Adam.
In the past, brands have shied away from the Chinese market because of some of the counterfeit issues that we have all talked about in the past when it comes to China. How do you think U.S. brands, or really global brands, are thinking about this issue now?
It's interesting. I mean, the AFA, right, with the American Apparel and Footwear Association, has certainly stepped up, I think, to educate everyone globally around, the challenges. But ultimately, I do think that because of so much of what we're seeing right now, which is these brand mashups, limited time, limited quantity, limited offer, this, right, what singles do, what makes it so special is, right, these items are, for the most part, they're kind of once and done. And when you have so much of that, right, the opportunity for other challenges to grow in the market don't exist like they used to. And so I think we're seeing, the brands themselves try and figure out the path forward so that those challenges aren't ones that, limit their growth in the future.
And what are you looking for? I mean, what's the next big thing for them? Is it next year's Golden Day, or is it, Singles Day this time around is 12 days long?
So some of the things that so Singles Day is important, right? Not only for Alibaba, but for JD.com as well. So JD did 40.9 billion. So you're talking just two, right? There's many more platforms, did $115 billion in sales. So this is important, but what many people don't know, right? There's 12/12, right? That's kind of the follow-up to Double 11. And then they make a huge deal out of International Women's Day, and they have 6 Valentine's Days. So we're always celebrating. There's always a festival, and the technology continues to, kind of elevate to, kind of shop with your friends, to celebrate, to just have fun, right? For no reason. It's just to have fun, right? That's all that it is. And we continue to see a lot of these festivals, I would say, getting louder, more technologically proficient. And, I think that I expect this year's International Women's Day, which is once again March 8th, to be at least up 100% year on year because of what we're seeing in the beauty market and the CBD market.
Deborah Weinswig is Coresight Research founder and CEO. Thank you for being here. I just want to let everybody know that in the 4 o'clock hour, our editor-in-chief, Andy Serwer, spoke with Alibaba's president, J. Michael Evans. We're going to bring you some of that discussion in the next roughly 30 minutes. But right now, coming up, following a big post-election rally, why BMO Capital's Brian Belsky thinks stocks have more room to run. He's going to make his case right after this.
You're looking at a mixed picture for the market here with just around 18 minutes left to go in the trading day. The Dow still moving to the downside, off just around 50 points. S&P and Nasdaq, though, are the winners today. A lot of that has to do with investors and some of those tech names that have been beaten up this week. So for more on all this, we want to bring in Brian Belsky. He's BMO Capital Markets Chief Investment Strategist. And Brian, great to have you back on the program. Markets today calming down a little bit from what we've seen play out over the last 2 days. Where do you think we're headed at this point? Are you in the camp that maybe we're slightly in overbought territory, or Are we still in a risk on period?
Thank you so much for having us, Shauna. I would say the death of tech was excessively premature. This binary trading and excessively emotional / rhetoric driven investment strategy continues even after the election. And this momentum driven market that we've really seen for all intents and purposes, really since the midway point of 2018, I think it's without saying that we're going to continue to see that into 2021. Just the concept and makeup of what's working in 2021, I think is going to be a little bit different. But again, it's this notion, quite frankly, Shauna, of stock picking. And I think a lot of people are missing this, is that, the stock market is a market of stocks. I think everybody likes to make this awesome and cool call to go into value or go into cyclical. But at the end of the day, it's all about individual company fundamentals that lead that. And there are several different areas within cyclicals and value that are working. But when growth is scarce, growth outperforms. And you think coming out of a recession and really kind of questioning what growth is going to look like over the next couple of quarters, and the higher likelihood of additional lockdowns on a state or even nationwide level really puts that increased confidence and bid into technology stocks. So again, the death of technology stocks and the stay-at-home trade, I think, is way, way, way too early.
Well, to take what you're saying, though, another step, though, is when we did have people on the program Tuesday and Monday who were talking about, the transition of the rotation out of tech into smaller cap and more, quote, value stock. And yet the market still kept going up. So what does that signal to you? It actually reinforces exactly what you're saying, doesn't it?
It really does. And I think it also reinforces, Adam, it's a great point, and how short-term people are and really how they want to make these big calls. I mean, I go back to 10 years ago, and what I've been doing is reading a lot of stuff that we wrote 10 years ago as strategists and trying to depict the shape of the recovery and when are interest rates going to go up. And it took way too longer than everybody thought. And the biggest thing that I think everybody missed, including ourselves, is this whole transition from bonds into equities. And when's that going to happen? It hasn't happened yet. I mean, we still haven't seen massive inflows into bonds. So on Shauna's question with respect to the risk trade, clearly the risk trade is still on into equities. We have a long runway here. We have basically built a foundation of low interest rates, high risk premiums, low risk free rates, and that's really going to drive continued equity investment. And that's why we're going to see kind of more of these momentum on-off type of days and weeks ahead.
Brian, you and I have talked about this in the past, that this is a stock picker's market, and you really need to examine the company's fundamentals. Once again, we had seen an earnings season come and go where a lot of these companies still are not giving guidance because of the uncertainty out there. What are the metrics at this point that you're watching most closely, just in terms of identifying some of these potential opportunities?
Great question. And, at the end of the day, a lot of these companies have been provided a free pass by not giving their guidance, especially given what has gone on in the pandemic. We actually reinstated our numbers in August with respect to what we thought for the market. But I think, we have to come back to simple measures as cash flow and balance sheets, but more importantly, from a longer term perspective, company managements and products and services and themes. The stay-at-home theme is an important theme. Private security is an important theme. Renewables are an important theme. Growth is an important theme in terms of technology companies really being more kind of consumer staples companies. These bigger, broader themes aren't going away. And with 70% of the economy really being driven by the consumer, you have to have exposure to those areas that really are driven by the consumer, not just these daily gyrations of cruise lines or hotels or airlines. Some of these companies had fundamental issues coming into the pandemic and are going to have fundamental issues coming out of the pandemic. So you have to be really, really careful on a stock by stock basis.
Brian, I want to get back to, where you're going to get your yield, where you can get some return here. And I don't want to talk stimulus from the federal government. Let's talk about the trillions of dollars Americans are saving. Before the pandemic, the savings rate like around 3-4%, skyrocketed it up to almost 30%. It's in the 20s now. So that money's sitting there earning nothing. It's going to come out at some point, but Americans are risk averse, perhaps. So would it go to equities, or where would it go? Would it be a foolish bet maybe to go into U.S. bonds, or would it go into muni bonds?
Did you just say Americans are risk averse?
Wow. When you've got a
we
savings rate close to 30%, yeah, I think so.
Well, yeah, I know. I mean, but you got to think about this whole term and an adjective unprecedented, right? 2020 was a year of unprecedented moves. We had a month-long cyclical bear market. We had a 2-month-long recession. We had prognostications of the Great Depression. It scared the crap out of everybody. And in our personal lives and our professional lives are intertwined more than any other time in history, I believe. And that's what really caused a lot of this. I don't think the savings rate, I mean, it's pretty safe. That's a pretty safe bet. Savings rate's not going to be what it was. But I think the broader question is, if you go back to yield and dividends, dividend growth product, dividend yield product is massively underperformed this year. I mean, massively underperformed because of this whole notion of when growth is scarce, growth outperforms, and you buy tech. I think dividend income and equity income growth is going to be a very, very important theme for the next 3 to 5 years. Not so much, Adam, high yield, I mean, in terms of utilities, REITs, and some other areas. It's going to be the actual growth in that income going forward. So guess what? Some of the tech stocks and healthcare stocks out there in America, and certainly the financials, are some of the greatest dividend growth names in the world. And we think that there's going to be a very strong bid in those companies for the next 3 to 5 years. That's where you get your yield. I think the real rates of returns and bonds are really going to end up being, to circle back to Shauna's question in terms of the risk trade. I think ultimately the risk trade is going to be bonds, but not until we start to see really the real rates of return turn negative. And we're still at least a year or two away from that.
Brian Belsky, Chief Investment Strategist at BMO Capital Markets. Always great to have you on the program. We'll talk to you soon.
Thank you.
Coming up here on Yahoo Finance Live, Beyond Meat CEO Ethan Brown on the rough quarter that was for Beyond Meat. Why he sees, though, a glimmer of hope just around the corner. We're back with that in just 2 minutes.
All right, Brian Sawsey from Yahoo Finance had the chance to sit down with Ethan Brown, who is the CEO from Beyond Meat. About Brian, I believe you had said, or how would you refer to the earnings report? I don't want to say the word you used. How would you say the third quarter was?
Tough quarter, Adam. But I asked Ethan Brown about how tough the quarter was. Stock got crushed. Here's what he said.
It's absolutely COVID related. I mean, that's what people, I think, need to understand is there was an enormous amount of stockpiling in the second quarter among consumers in the grocery stores. And there was a long tail of that as that burned off into the third quarter. If you look at the fundamentals of our business, household penetration continued to increase, purchase frequency continues to increase, the buyer rate. So each household is now buying more. So in June, they're buying about $32. Now they're buying $36. So all of the trends, if you want to see, are increasing. My favorite is the repeat rate. Consumers are now, the repeat rate is about 52% for our products. That is extremely strong in grocery. And so all the right metrics are occurring. We grew 63% in retail. It's our second largest quarter ever in retail. So what we need to do is see the lift occur around the stay-at-home orders that have been burning off and the ability for us in the QSR space to get back to where we were. Once you see that, you'll see that growth resume. So I'm very, very positive about where the brand is. And even though the quarter was a little bit difficult, you still see all those strong underlying metrics of growth.
So Adam, what you saw here is a company that has been growing by triple digits in terms of sales for most of the year. This entire investor base knows Beyond Meat as a growth stock, but this is a reset of the company this week. And in large part, that's not necessarily because of competition. It's pretty much due to COVID-19 and their exposure to a lot of independent and large restaurant chains.
Brian, real quick, how important is this new partnership for the Beyond Meat product on Pizza Hut on those pizzas?
Well, it's always good to see when you have a company like a Pizza Hut selling something nationally like a Beyond Meat, but it's also very important for Pizza Hut. I just wrote a story on this. I encourage everyone to click all over it.
All right, Brian Sozzi, thank you very much. Coming up, we've got strategist Jason Ware and Dory Wiley taking us through the closing bell on Wall Street as stocks try to get the post-election rally back on track. And we ain't talking Amtrak. We're back after this. All right, 3 minutes to the closing bell. We've got Jason Ware, Albion Financial Group Partner and CIO, here to help us get there, as well as Dory Wiley, Commerce Street Capital President and CEO. Dory, let me start with you. We've heard some pretty bullish calls that the S&P 500, we're going to have a year-end record close and into 2021 even better. What do you say?
Well, pretty interesting. Everyone got very bullish when they heard there was going to be a do-nothing Congress. At least that's what it looks like right now until it gets certified. So the markets have taken off on that. There was good economic news last week. It's been on Friday. It's been good all week. We've got a vaccine coming out from Pfizer. We backed off a little bit today. I think the COVID scare is kind of there, but it's probably also some profit taking. But as you said, we saw some revisions for forecasts for 2021. And most everyone I see is looking fairly bullish for 2021. And I guess that makes sense given all the bad news we had in 2020.
Jason, how about you? Where do you stand just in terms of where you think we'll end the year and then look ahead into the next year?
So I'd pick up on what Dory said, and I'd say that the vaccine news from Pfizer was absolutely a game changer in terms of the sentiment on the market. We're gonna get to a vaccine, I think, quicker than most of it had anticipated a few months ago. The virus has driven the economy since March. It will continue to drive the economy over the foreseeable future. So putting this pandemic ultimately behind us is most important. I think meanwhile, we're getting through the election. I think the outcome is something that the markets are okay with, and I think that's certainly undoubtedly good news. Earnings in the economy continue to track the way that they should, which is recovery, and we still have the Fed in the game, as we saw last week with the November FOMC meeting. So I think all of those things together certainly suggest that the influence on stock prices is probably higher over the near term.
All right, we're literally 9 seconds to the closing bell starts sounding. We're going to bring Jared Blickery in just a second, but some of the big stocks moving today. You got Apple right now up about 3%.
Who have you queued up?
Adam, I think we got another minute to go here, so I'm just going to take it. We got the S&P 500 now in the green, but the Nasdaq really the leader, and we can see this on the Nasdaq 100 heat map. A lot of these big cap stocks that just took it on the chin recently are not doing very well. So this is going to be the Dow. We got Apple up 3%, Microsoft 2.5% here, and looks like on the sector action, tech is still, by and away, the big winner, up over 2%, followed by communication services, and then discretionary. Those are the three sectors that house the FANG stocks. And then in another reversal from the prior 2 days, we got materials down 1.5%, followed by energy, industrials, and finance. So let's look at the travel sector, because reversal there as well. A lot of losses, not only in the airlines, but also in the cruise lines as well. Just about anything travel related, except for Travel Zoo getting hit right now. And look.
Again, you're looking at a mixed picture. We have the Dow ending the day in the red as we shake out the final trades. S&P and Nasdaq, you can see it on your screen, holding on to gains, and Nasdaq was a big outperformer of the three major averages, closing up just around 2% flat. The S&P adding just around 0.8%. That outperformance there in both of those averages having a lot to do with what we saw from some of those big tech names. Amazon leading the way, Apple, another big outperformer, Google and Facebook not too far behind as we see investors rotate back into some of those names that have been out of favor over the last couple of trading days. You see, though, the Dow still ending the day in the red. American Express, the worst performer in the Dow today, off just over 4%. Boeing also is one of the worst performers, down nearly 3%. Dory, let me just bring you back in here, just in terms of where we end today, looking forward into next year. I know you're bullish at this point. How are you, though, allocating your portfolio? Because I think there's a lot of questions, and we've been talking about this over the last couple of days, as to whether or not now is the time to buy into that cyclical trade and rotate into some of those names that have been beaten down over the last several months.
Well, that's the real question. Are we finally getting some normalcy in the market, moving from some of this technology growth back into cyclical value? And we can't tell if that's a trade or a trend, a long-term trend, and everyone wants it to be a long-term trend. It's hard to tell. And I would caution against jumping to any conclusions before year end, to be honest with you, because the election haven't been certified and done yet. So we need some certainty there to lock it down. In addition to, we've still got a valuation problem in the whole market. I mean, we've got a S&P PE ratio that's higher than it was in 2007. So while I think the market wants to be bullish because it wants to get 2020 behind us, I still think we've got a caution yellow light out there, and I would be very careful about what you get into and rotate into before year end, because you could have it's been a pretty good year, especially considering what happened. So you could see quite a bit of profit taking over the next 30 days to lock in those year end returns. I'd be very cautious.
Well, Jason, aren't we going? I mean, what Dory just said, we should be expecting the profit taking, but then you get, as I had mentioned in my early start on the closing bell, Apple, which was by volume, one of the most active stocks today. They had been essentially flat this morning, and then poof, boom, here they go.
Yeah, you can't keep a good growth story down for long. And why would you want to? I mean, at the end of the day, we're still looking at probably, below long-term trend growth for this economy. Post-World War II, it's been north of 3%. Over the past decade or so, it's been a little over 2%. And, we're not going to get any kind of major new stimulus bill from a mixed Congress. It's probably going to be less rather than more, something closer to $1 trillion as opposed to $2 to $3 trillion. So I don't think the economy is going to see any kind of major uptick in that growth. And if we're not going to see heady growth from the economy, then investors are going to look for companies that are growing faster than what the cyclical space can provide. And that's going to be the Apples, Microsofts, Amazons of the world. But there's also companies out there, and I think, it's important for your viewers to understand that, picking individual companies is the way to approach this as opposed to styles, value versus growth. Look for good companies, own good companies for the long term. And there are companies that sit at that intersection between secular growth, but also having more of a cyclical tilt. A company like Starbucks, Intuitive Surgical, Visa. These are really great companies that are dominating their categories, that have high returns on invested capital, but also have a pro-cyclical tilt if we do get a pickup in the economy post-pandemic. So, looking at those kind of areas to complement the secular growth, I think is a great strategy for investors.
Jason, what do you make of what we're seeing going on in the 10-year yield? We have the yield not too far from 1%. We were asking some of our market guests yesterday, just when is that level that they get a little bit concerned just in terms of what that could mean for U.S. equities? How do you read that?
Yeah, it's a great question. And, for so long, with interest rates being so low, that's been a big question on Wall Street, is at what level does the 10-year yield start to compete against the returns you get in stocks, at least to some degree on a risk-adjusted basis? And again, what level does that start to slow the economy when rates move higher? And we're still around 1%, as you noted. And if you look at it on a real basis, that's still a negative yield. So there's not much competition there. And I don't think we're going to get there anytime soon. I think if you talk to people that know more about this than I do, some of the folks in the bond market, they would say that, north of 2.5%, we might start to see a bit of a change in how people allocate assets. I think there's some truth to that, but we're still a long way from that point. And it would take a big push from inflation, a big change in Fed policy, or a big move in the economy into more of a growth-oriented posture for us to see that. We just don't see that happening anytime soon.
Dory, I'm curious. We've heard people talking about once there's a vaccine. We saw Pfizer pop on Monday. They've closed down from where they were after that news broke. But then Moderna today, it popped. It's up about 8.5% at the closing bell. And they're going to be releasing at some point this month their vaccine trial results. So as we start getting all of these different companies with their results, do you expect that to have a long-term positive on the market, or is it going to be people moving in very quickly to take a profit and then get out?
No, I think it'll be a long-term positive. I still think there's I'm surprised at the amount of confidence we do have in the market, but at the same time, I still think there's an over-allocation to cash, and consumers holding up pretty well. One of the areas that we follow very heavily here at Commerce Street is the banking sector. And of course, it's been oversold all year, down 30%. We've had a nice rally lately, but the banks are at the strongest capital levels they've had in 100 years. They've underwritten capital very well. They adjust rate changes very well, so particularly the smaller banks. So that's always overblown in the market. The real question is credit and how will it hold up, particularly with office space rolling into NPAs and the consumer. And the big banks have showed us, they came out 92% of the consumers that deferred payments earlier in the year for JP Morgan are now on track. That is an amazing sign. So I think people have some money, which is amazing. Those that are employed anyway, and they're looking for reasons to be bullish in the market. And as Jason was talking about earlier with bonds, I just don't see people moving to the bond market while you've got such strong yields going on in the stock market.
Jason, what do you make of what we saw from third quarter earnings? Because relative to expectations, we saw a pretty wide gap in terms of outperformance, but historically speaking, they're still pretty weak when you compare them to what we were seeing just around a year ago. When are you expecting to see any meaningful recovery in earnings?
Yeah, so it's always important to remember that whether we're looking at earnings or economic data or progress on the scientific front, that the market is less interested in the absolutes of good and bad and more interested in whether things are getting better or worse. And what we're seeing in the trajectory in the economy and in earnings by extension is that things are getting better. So while we're still lower on a year-over-year basis relative to where we were because of the pandemic, relative to where we were in third quarter of 2019, things have sequentially gotten better from the low point in the second quarter of this year. So we continue to see progress toward getting earnings back toward record highs. If you look at the analysts on Wall Street, they expect that next year in 2021, we're going to see record level or near record level earnings again, something on the order of $165 per share in S&P 500 operating earnings. If we get there, then I think that's, without a question, a positive trend for earnings to be pursuing. So that's good. Investors celebrate that. As you noted, we beat on expectations, broadly speaking, both in the second quarter when folks were expecting a 40% down tick in earnings. It was actually more like 30. And in this quarter, it was going into it, it was around 20%. We're getting closer to 10. So we continue to best those low expectations. And I think that's good for the stock market.
And Jared, we were talking just a second ago about Moderna, and then there's some news out that they may be ready to give us the data on their late stage trial of their vaccine. Is that going to have some kind of positive ripple effect, do you think, on the market?
Oh, absolutely. I mean, we had such a great effect on the market from Pfizer and their announcement. And, the numbers were astounding, that 90% rate. So anytime we get anything positive about COVID, I think the market wants that. If you look at what happened in the last year, the most sensitive subject that we've had on the market is not earnings, it's not credit, it's not deficit spending, it's COVID. Everyone is afraid of COVID. So anything positive on COVID, the market's going to respond positive to.
Jared, what do you think? I mean, because this Moderna news, it's literally breaking, but they're saying that they have completed the case accrual for the first interim analysis of the phase 3 study of their vaccine candidate. We don't have the results yet, though.
That's correct. And we're seeing the stock up considerably, including the day's gains. Looks like it's up 7.5%. Actually, so it could have actually sold off a little bit. Hard to make sense of the current situation without just digesting a little bit more. But they had seen, and this is also reading off the report here, they had seen a significant increase in the rate of case identification across sites in the past week. And they're saying as a result, they expect the first interim analysis that will include substantially more than 53 cases, the targeted trigger point for the analysis. And it looks like shares initially rose just a little bit, but not maybe the game changer that it would appear to be at first blush. I'm still trying to get a quote here, and here we go. So it looks like shares are just trading steady, not too far off from where they settled just moments ago.
Jason, what do you make just in terms of, is it COVID that's the biggest risk to the market here in the short term? We try to wrap our heads around just what could maybe break this rally, what could trigger a pullback or maybe something even worse. Is it something that's to do with one of these vaccines? If we get anything negative about that, I mean, how are you reading that possibility?
Yeah, it's a good question. And we've long said that the biggest risk to the market over the near term is failure in these vaccine trials. And seeing, Pfizer's news earlier in the week was obviously a positive. I think the fact that Pfizer's on an mRNA platform that's very similar to Moderna speaks well for Moderna's coming results that I think we're going to get here sometime probably in December, early December. So I think failure on any one of those platforms would certainly be a setback for stocks. That doesn't mean you can't own the market if you're a long-term investor, but I think that would create some volatility. I think another potential risk over the near term is if we see some major changes in the election outcome. Now, I think that's a low probability risk, but it is a possibility. And if we were to see this extend out beyond what we're already getting in terms of, filing these lawsuits and calling into question the validity of the results, that could create a bit of short-term noise to the market. But I don't think that's a high probability risk. And I don't think seeing failure on the vaccine front is a high probability risk either. So the good news is I think the two things overhanging the market are working in the direction of stocks going higher, not lower. And we'll see how they flesh out over the next couple of months. I do expect some good news on both fronts coming for investors.
Dory, with that in mind, could we see perhaps more of a rush towards the end of the year with the fear of missing out and people trying to get in regardless of what you had warned about at the beginning of this discussion? Be careful, people will be taking profit.
Yeah, I'm not sure I caught all the question, but could we see a dip before year end? Was that your question?
Yes, but there's also going to be the fear. There are going to be a lot of people who worry about missing out if this market is going higher to the end of 2020.
Yeah, I actually expect to. In fact, amongst a lot of traders, I went to our trading desk when the market went nuts. I guess it was on Monday, and it's been a pretty good week. And our first reaction was kind of like the movie Trading Places: sell, 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 because it was just such a a topper move, and then there was nothing but downside risk from there. You know, the old adage, sell on good news and buy on bad news. So I think there could be a little bit of that. There's a lot of good news here. You know, get the election behind us, get a vaccine. I mean, those are two of the best things we've been hoping for the last 3 months, right? So I actually do expect, no matter who's president, no matter what's going on, the market to fall off a little bit because it needs a little realism. It's still a stock picker's market, and we still have some overvaluation in some areas.
Dory Wiley is Commerce Street Capital President and CEO. Jason Ware is Albion Financial Group Partner and CIO. Good to have both of you here for the closing bell. Coming up, vaccine hopes and rising COVID cases creating a real headache for airline investors. Cowen's Helene Becker on what's next for the nation's biggest airlines as they try to get everyone back on board. We're back in just 2 minutes.
We've got some breaking news here. Vroom is out with earnings. Shares under a decent amount of pressure here after hours. Jared Blickery has those numbers for us. Jared, you're muted.
Well, there's my November one right there. All right, we got shares down about 10, 12% in after hours. And I'm looking through the numbers right now. Not all bad, but I want to go over them right now. So we got third quarter revenue at $323 million. The estimate was for lower at $310 million. The adjusted loss per share was 29 cents. The estimated loss was for greater at 37 cents. And then they're seeing fourth quarter revenue at 372 to 414 million. Estimate was for somewhere in the middle, maybe a little bit higher to 403.5 million. It seems like that estimate was for above the midpoint here. So that could be a source of discontent among the current investors. Let's look at some of their statements here. So they are expecting another quarter of significant year-over-year growth in e-commerce unit sales, and then revenue for the fourth quarter and continued strength. They're looking for all of that in the fourth quarter. They expect average e-commerce selling price per unit of $24,500 to $25,500, and average e-commerce gross profit per unit of $2,050. And then also seeing fourth quarter e-commerce unit sales of $10,500 to $11,500, and that implies 25% sequential growth and fourth quarter year-over-year growth of 74%. So looks like the guidance was just a little bit weak. This is one of those COVID high flyers here. So unless these companies, and this is historically in this earnings season, unless companies have really been really been beating expectations. If their stock price is up substantially, then we've seen the stock price knocked down, and that seems to be the case here.
We certainly have, Jerry. We've seen that many times this earnings season. Again, shares of room off just around 12% in the after hours. All right, let's talk about airline stocks. They surged earlier this week on Pfizer's positive vaccine news. But for the year, though, the sector has been a massive underperformer. So let's figure out where the airliners stand 7 months into the pandemic. And for that, we want to bring in Helene Becker. She's an analyst with Cowen and joins us now on the phone. Helene, it's great to have you back on the program. When we take a look at what's going on with the airline sector right now, we've seen tens of thousands of airline workers that have been furloughed. Congress still has not given the sector the additional aid that it has asked for many, many times. How are the airlines faring at this point?
Yeah, thanks for having me again. So they've done everything they could on the cost side at this point in time, and it's a revenue issue. They're hanging in there. Nobody's going to go, nobody's in danger of failing, at least not this year. I think most airlines have at least 1 year of cash available to them. And as long as Southwest, for example, has up to 4 years of cash, assuming nothing changes between now and that time. And obviously that won't be the case, what with, the vaccine and whether it's the Pfizer one or another one that comes along. Or a treatment option. All of this is positive news, obviously, for the industry. But I think they need revenue, and in order to generate revenue, things have to open. They have to be able to, people, we in general have to be able to do something when we go where we're going. I think most people want to travel. We think Thanksgiving is going to be a good weekend, but. But that said, it's a revenue issue now, not really a cost issue anymore. And obviously the stocks react. It's very binary. The stocks react to good news.
Hey, Helene, it's Adam. Good to have you here. It's not the most up-to-date, but it's close. November fares, I think at the end of November 2nd, you had pointed out in a recent note, we're up to about $303 on average for like Delta, United. It was part of your tracker, and American. And it's American I wanted to focus in on when you were talking about liquidity, because they're coming to market with 38 million plus new shares of common stock in this effort to increase their liquidity. Is that a danger sign, do you think?
No, not at all. In fact, we said this. We expected exactly this to occur. We think that, I think American was ready for this when there was a vaccine announcement. I think they thought the stock would go up, and it did. And I think they were ready to, pull the trigger, so to speak, on an equity offering. A, and B, there's only so much debt these guys can add. I mean, at this point, the airlines have to think about the other side of this. We are going to come out of this at some point, whether it's 2021 or 2022. They need to have that cash available, and they can't continue to pile on debt, or they'll never get out from under this hole that they've dug, especially without further stimulus. So we expect equity offerings throughout 2021 as airlines, continue to add liquidity. And as you know, in the airline business, you can never have enough liquidity. Yeah. And if it ends sooner rather than later, I think the way to think about it is they'll pay back that, whatever they've borrowed sooner rather than later.
So let me ask you about this, because we love to talk about the Deltas, the Southwests, Americans, and Uniteds, but then you cover all of them. And there's the cargo, the freight haulers like Atlas Air, which I believe Cowen has market performed for them. They've got the largest fleet of 747 cargo jets in the world, and they've done well during the pandemic. But what's the outlook for a company like that?
Yeah, so look, they're going to participate in the vaccine distribution worldwide. We know that to be the case. American, just for a second to be off topic, American and United also have cold storage facilities, American in Philadelphia and United in Newark, so they'll be able to participate. We know Ethiopian Airlines will participate in Africa. This is sort of an all hands on deck, a distribution. And I think the airlines and Atlas Air will participate for sure, as will FedEx and UPS. UPS has the largest freezer farms in the world. They've got one big one at Louisville, Kentucky, which is their U.S. air hub, and they have one in the Netherlands. And they will participate in distribution. One of the things I learned earlier today, actually, we had the CEO of Air Transport Services Group do a fireside chat with us, and we were talking about whether they'll be able to do vaccine distribution. And as you know, as you've been talking about for the past couple of days, the Pfizer vaccine has to be distributed at a temperature of minus 70 degrees Celsius, which is very cold, and it has to be kept in dry ice. And on a 767, which holds 125,000 pounds of cargo, since that's a hazardous material, you can't carry more than 10,000 pounds on a 125,000 pound aircraft. So it's going to be limited, and you're going to need all hands on deck in order to distribute vaccine, worldwide. And that's why we think the whole thing has legs. So yeah, we think Atlas has legs. The stock's really performed well. We were just looking at it today. It's up, even after it's corrected a little bit, still up, more than 100% year to date. Or I guess not year to date, but in the past year, I should say.
All right, Helene Becker, always great to have you on the program, and analyst with Cowen. We really appreciate you taking the time.
Thank you. Thanks for your time.
Alibaba sets a new Singles Day record with more than $74 billion in sales, becoming the largest shopping event in the world. Yahoo Finance editor-in-chief Andy Serwer spoke with Alibaba President Michael Evans earlier today about the big event. He'll join us with all those details right after the break.
Take a listen.
Okay, there's 74 billion reasons to be happy if you're invested in Alibaba. Our editor-in-chief, Andy Serwer, actually spoke with Alibaba's president about what has been a phenomenal record-setting Singles Day. Andy, take it away.
Yeah, Adam, I spoke to Mike Evans, and indeed a big day for Alibaba. I talked about the difference between the Chinese economy and the U.S. economy. Take a listen.
I think the most important message that comes out of it is that we are in a post-pandemic market in China where consumption levels are phenomenally strong and where almost every category has returned to pre-COVID levels of activity. So this is a demonstrated example of the huge power of the Chinese consumer to buy brands in China and from all over the world.
Wow, it's so amazing to hear that phrase post-COVID economy. And the number of packages is pretty amazing too. I guess it's time to release the drones, Michael. I want to ask you about the U.S. and how this figures into what's going on here, because it's historically been the U.S. has accounted for the top 5 in terms of merchants on Singles Day. Where does the U.S. rank this year?
Well, the U.S. this year is the single largest contributor to the shopping festival of all countries outside of China. So the number as of about an hour ago, we're not quite finished tabulating the final number, was north of $5 billion US. So those are products sold by US brands, small businesses, retailers, and even farmers to consumers directly on our platform. So this is an extraordinary result for the US. And I think it reflects 2 things. First of all, most of these brands, and there were thousands of them in the US, understand that a part of the future growth of their companies is going to be the China consumer. And the second thing that they've all experienced is that while last year 135 million or 140 million Chinese people may have left China to travel the world, they're not traveling the world this year. So they're sitting at home and they're buying the products that they would have bought from American companies in China. So this is one of the reasons why we've seen such a big boost in the.
Isn't that amazing? So hearing, number one, that it is a post-COVID economy. Wow. Kind of the opposite of where we're headed right now in the US. And then 2, instead of traveling, Chinese consumers use that money to spend on shopping, most recently here on Singles Day, buying American products. So a little bit of a boost for the US economy, at least according to Mike Evans of Alibaba, Shauna.
Certainly is, Andy. I mean, it's so interesting, especially it's hard to wrap your head around those numbers that Alibaba has been able to put up for their Singles Day. But that was nearly overshadowed because we also have to talk about China's proposed antitrust rules and what it means for a big company like Alibaba. What did he have to say just about the regulatory environment there, and especially on the heels of what just happened with Ant?
Yeah, I pressed him on that a little bit, and his answer was, well, this is what happens. This could happen in any country. In other words, it would be like, well, there's regulatory oversight and there's a change in perception of the market power of these companies, to which I kind of responded, well, yes and no. I mean, yeah, truth be told, I mean, sure, sometimes the U.S. does investigate and take action against the countries here. And maybe our perception of what goes on there shouldn't be that different as to what, say, U.S. lawmakers are doing about tech companies in Silicon Valley.
All right. Andy Serwer, our editor-in-chief, good to have you here. And again, you can see Andy's interview with Alibaba's president on our website at yahoofinance.com. Andy, all the best to you. See you in the newsroom, or at least the digital newsroom. When we come back, want to let you know that the divided states of America, Rick Newman, on why one big factor is driving a split amongst the electorate. We'll be back right after this.
President-elect Joe Biden winning the 2020 election. The latest numbers from the Associated Press, with two states yet to be called, show that Biden has won 290 electoral votes and more than 77 million of the popular votes. Comparing that, though, to President Trump's vote tally, he's not that far behind when it comes to the popular votes. He's actually at more than 72 million. That's a record number for a losing candidate. We want to bring in Rick Newman to discuss a little bit more about this and what we've seen play out across the country over the last week or so. Rick, Biden won, but you can see, though, by the numbers that this is an electorate that is extremely divided. What do you think is behind this?
Yeah, Biden won by not huge margins in both the electoral and the popular vote. Trump still got more than 72 million votes. 47% of people who voted went for Trump. And I mean, we all know Biden backers who are saying to themselves, how can so many people support Trump after, this chaotic presidency with so much divisiveness? And I think that we have to keep in mind there are really some important economic factors behind this. We still have a deeply divided economy. More than ever, the economy has sorted itself into people who are connected to the global economy and to the digital world and are doing fine. And they increasingly are in urban environments around big cities. And more, those are Democrats. And that's where Biden got a lot of his votes. We see the Trump vote coming from economies where median income has actually been declining rather than rising. These are parts of the country where, that do not represent a big portion of overall economic activity. And to some extent, these are people who feel like they're falling behind. Now, it's hard, you can overgeneralize here. It doesn't break down evenly along all these lines. But Trump voters, in a way, continue to express frustration that they just feel the modern economy is leaving them behind. And this is not going to change. This has been a problem in terms of worsening income and wealth inequality for at least 20 years. And it's getting worse now with the coronavirus recession, not better.
So Rick, I'm curious, this income inequality question, though, if Democrats want to win future elections, they've got to win those counties in the middle part of the country where those issues you just mentioned are playing out big time. How does a Democrat, AOC is not going to resonate in those counties. So how do the Democrats sell what they have to offer?
Adam, I think this is a huge problem, and it explains part of the divisiveness we're talking about here. So, with Democrats now more focused on what's going on in urban areas, it's no wonder that, their policies are now lots of diversity, affordable housing, things that typically benefit people in urban areas. And did you hear Joe Biden saying anything at all about, agricultural reform or things like that matter in more rural areas? You did not. Democrats used to be able to get at least 50% of the rural vote, only 20 years or so. And now that has gone about 75% or more to Republicans. And it's just because of all these disagreements, and you sort of can't prioritize everybody at once. So that's why Democrats tend to come to the side of these progressive priorities that mainly help people in big cities. And Trump is talking about factories. And even though he didn't really do much to improve the manufacturing sector, he did talk to those people, and many of those people still support him. So we've got two very different sets of solutions for what remains a vexing problem. And that is one of the reasons I think we're going to stay very divided.
Rick, does this have any implications just in terms of Biden's policy and what he's going to be able to get through Congress, just in terms of some of these lawmakers trying to play to their base and make sure that they are reelected whenever they are up for reelection?
Yeah, it affects directly what happens in the Senate, of course, where rural states are overrepresented, and of course, urban states are overrepresented in the House. But it looks pretty likely that Republicans will retain an advantage in the Senate. They thought they might be able to flip a seat in Montana, for example, a rural state. They were unable to do that. They were hoping they could flip a Republican seat in Iowa. Nope, not able to do that. So unless they get really lucky Democrats and they're able to win those two runoffs in Georgia, which is pretty unlikely, Republicans are going to have a narrow edge in the Senate, and that will really just block probably 2/3 of what Biden wants to do or more.
All right, Rick Newman, as always, thanks so much for breaking that down for us.
Guys.
Well, let's get to our small business segment as part of our Road to Recovery. This is brought to you by MasterCard. And for that, we want to bring in our next guest. We have Adam McDermott. He's a co-CEO of Linus Bike. And Adam, it's great to have you on the program. We've talked about this a couple of times over the past months, where bikes have been the must-have item, it seems like, during the pandemic. I was on your site earlier today, and right at the top of the website, you have a pop-up that says, due to high demand, you have to pre-order your bike now. How has the pandemic, do you think, just changed the energy and the conversation around the bike industry?
Drastically. Like coming into 2019 was one of our worst years as an industry, the bicycle industry as a whole. So it was completely unexpected. We plan our inventory, our projections about 6 months out. So rolling into 2020, the expectation was quite low. And then all of a sudden with COVID and how people are kind of changing how they spend their time, how they get around, we've seen, we're like 80% up over the previous year. So there's absolutely no way to accommodate for that increase in demand to ramp up inventory. As I said, normally we're ordering inventory about 6 months prior to when we receive it. Now we're planning 12, 18 months ahead. So we're already ordering for 2022.
I ask you this question with fond memories of my 1970s era Schwinn Huffy with a banana seat. But I got to ask you, where are you seeing the greatest demand for the bikes? Is it the urban centers like New York? Or are you seeing it nationwide in rural areas as well?
It's mostly urban areas for us. I mean, that's primarily where our customer is in sort of denser urban areas, kind of towns and cities over 200,000 people. But it's pretty much, and it's nationwide. I mean, we're seeing it northeast, south, in the middle, everywhere.
Adam, has the preferences of your consumers changed at all, just in terms of what they're looking for because of the pandemic?
I think the sweet spot is between that like $400 to $1,000 bike. It is kind of what in the industry is middle to lower in terms of in price range. I think it's a lot of people that I think the interest is recreational. There's just a limit in what's available to them. You know, you can't go to a gym, you can't take your kid to soccer practice. Even like your work schedule and meetings and social life is all reduced. Biking is one of the few things you can do that doesn't require an outside business, an outside service, something that is limited. You can just get on your bike and go and experience it. So I think a lot of the demand is coming from that, and as well as people just changing the way they commute, that are avoiding their traditional public transportation or buses or subways.
What about the electric bike? You know, that whole market in a place like New York, which has a license for everything, you've actually got to get a license for one of these things. But what kind of growth do you see in that side of all of this?
We've just launched electric bikes ourselves. The demand parallels what we're seeing in our conventional bikes. We had one container just arrive, and it was halfway sold before it arrived, which for us is a kind of a big deal because it's a much more expensive item. It's, you know, these bikes average between $2,000 and $3,000 compared to our regular bike, which is about $500.
All right, Adam McDermott, co-CEO of Linus Bike. Great to talk to you. Thanks so much for taking the time.
Thanks for having me.
All right, coming up here on Yahoo Finance Live, Game On, FanDuel CEO tells us how they're weathering the COVID storm and whether or not new bettors are making up for the months that we saw of canceled sporting events. We'll discuss all that right after the break.
Okay, we're going to talk about sports betting. Flutter Entertainment reported, and they had revenue soar 30% in the third quarter. A lot of that with the return of live sports worldwide. Here in the United States, it's FanDuel. They own FanDuel. And FanDuel itself added 450,000 U.S. customers. Let's talk about that with Matt King. He's the CEO of FanDuel. Good to have you here, Matt. I feel like we should be playing that song, the Queen song, Don't Stop Me Now. Yeah, I mean, you guys are just roaring, aren't you?
Yeah, the consumer demand has been off the charts. Obviously, the return of sports has been a huge home run for us. We're currently tracking to be the first online operator to ever pass $1 billion in gross gaming revenue for the year, and just really proud of everything the team's doing.
Matt, Dan Roberts here. Let's talk about some of the deals you guys have cut recently. You announced a deal with the Grizzlies, a deal with the Broncos. It seems like this is the area now where the competition is really heating up. You guys cutting individual betting partnerships directly with pro franchises. But of course, I also know that you're moving quickly to open up physical sportsbook locations, or at least before the pandemic you were. Is that the main growth engine for you guys right now? And what's happening kind of faster?
No, we're seeing growth across the board. So the team partnerships and the league partnerships are a big part of the strategy, particularly in core markets where the teams typically kind of touch 70, 80, 90% of sports fans. So the Denver Broncos is a great example of that. But we complement that with deals like the one we did with Entercom or Turner Sports, where we can really kind of reach the mass market and, more importantly, be integrated into the sports content. Radio has been a huge avenue for us. And so Entercom was a great partner to bring on board. And so you'll see a wide range of partnerships that we're doing out there.
Matt, we're seeing more and more states legalize sports betting. We saw that in the recent election. How big of a growth driver do you see this potentially being for your company and then also just for the industry at large?
We think we're in the first or second inning of this. So if you look at the states that were legalizing, you got Maryland passed their referendum, Louisiana did as well. But you look past that, you got big states like Ohio and Massachusetts that are seriously considering it. And one of the things that has been a positive outgrowth of the numbers you're seeing out of places like New Jersey and Pennsylvania is almost all states realize that this is kind of common sense legislation. And when you take the economic opportunity and combine it with the resounding voter support for it that you saw in Maryland and Louisiana, kind of legislators look at this as a kind of no regrets piece of legislation to push for.
Matt, we just got news of when the next NBA season will start, December 22, which is great. It's also kind of crazy since we just wrapped the last one, but that's how things are going right now. While we have you, it was very interesting. In the summer and in the fall, we saw a big dip across the board in live sports TV ratings. Everyone had their theory as to why that was happening, but the NBA finals were way down. The NFL ratings were down through the first 5 weeks. Some of the tennis tournaments were way down. Kentucky Derby was down 60%. What did you make of that? And did that affect your business? Did that affect how many people were engaging with fantasy and betting?
We didn't really see it affect our business. I mean, as you noted when we got on the call, we had over 450,000 new customers. We grew 80% year over year. So it's hard to see it in our business. I think, and this is more art than science response, people just aren't used to watching NBA basketball in August. And they aren't used to the Kentucky Derby being in the fall. And I think as you see sports return to their more normal calendar, you'll see the ratings swing back. And because also the other reality is when the NFL kicked off, you just had a lot of sports going on. And so you didn't have as much kind of individual attention on any given sport. You didn't have as much run up in each of the individual events as you typically do. And so I think you'll see the ratings come back.
You don't think there's going to be any kind of like demand destruction, though, that in the lulls that we're witnessing, that people may ditch some of what had been really popular live sports for perhaps some of the things they're now enjoying online? I mean, for you, it's always good because you can bet on almost anything.
Yeah, no, it's a great question. I do think viewer patterns are going to change, right? I think you are seeing, and when we do our research, you're seeing more people that are following sports through highlights on Twitter than maybe tuning into the big game. And so I think you will see continued pressure on ratings from cord cutting, if nothing else. But that's honestly why we're having a lot of really healthy conversations with leagues and other partners about how do we leverage the scale of our digital audience to help them find sports fans that are out there that may just not subscribe to cable anymore. And so I think you'll see some really interesting opportunities unfold as you see the disruption in the sports media landscape over the next couple of years.
Matt, going off of that and some of the disruption that we could expect to see, I mean, sports betting market is soaring right now, but so too is a lot of your competition. You're clearly not the only team in this space. Some of the smaller players here are becoming, I guess you can say, more and more popular. What are you doing just to maintain that edge that you have? Because as of right now, you are pretty by far one of the market leaders.
Yeah, no, we've been really pleased with how customers have responded, not just to our brand in sports betting, but also to our product. And so we'll look to continue to have product leadership. If you look at what you can bet on FanDuel relative to anybody else on the average NFL Sunday, we typically have 2 to 3 times the number of things you can bet on. We have some really creative products like Same Game Parlay that are out there, where again, we're one of the few people that has them, if not the only person. We have more live bets than anybody else. And so we have been leading on product. That's part of the reason why we have the market share we do, and we're going to continue to lead on product.
Do you think your future, your company's future, at some point includes a merger with and I don't know what the distribution model is going to be after cord cutting is done, but a merger with like a Twitter, or somebody's going to have the contract for the delivery of different sports venues?
I think anything's on the table this early in the cycle. I would say the one thing that a lot of people have been really surprised at as they get into sports betting is the operational and the regulatory complexity. We are a heavily regulated business, and that makes what we do very hard to replicate, particularly when you're doing it at scale with the quality of execution and product delivery that we have. So who knows? But I would also say if you're a traditional technology company, a lot of times you look at the level of regulation we have and say, that's more than I want. And so it'll be interesting to see how it unfolds.
Matt, we have the Masters this weekend. I know you were saying that a lot of times that we've seen sporting events when they're outside their traditional time, when we're used to seeing them, they're not as popular, at least in the sports ratings department. What are you expecting to see just in terms of some of the excitement and some of the interest that you're hoping to generate this weekend?
Golf's a funny thing. It's I would say interest in golf is 80% correlated to how Tiger Woods does still. Obviously, what some of the younger golfers are doing is interesting, but nobody commands the kind of name recognition in golf that Tiger does. He's still our biggest liability on Masters weekend. And so I think if he does well, you'll see ratings, really, really strong. If Tiger doesn't make the cut, I think it'll be, weaker ratings.
All right. We appreciate your being here, Matt King, FanDuel CEO. We wish you all the best going forward.
Thanks, guys.
When we come back, we're going to take a look at some of the things on the calendar for tomorrow.
Welcome back. As we turn our focus to tomorrow, of course, we're going to be closely watching the market as we ended today mixed with the Dow in negative territory, off just 23 points, so not too far from the flat line. S&P and the Nasdaq, though, able to hold on to gains. The Nasdaq, the real outperformer in the market today, closing up just around 2%. A lot of that has to do with what we've been talking about over the last couple hours, and that is, of course, the rotation back into tech. Investors finding reason now to buy some of those beaten down tech names and names that had fallen out of favor over the last couple of days. So that was enough to propel the S&P and the Nasdaq into positive territory. As we shift our focus then to tomorrow, a couple of other things that we are watching. What's on my radar is the jobless claims. We saw that number fall to its lowest level since the pandemic began at the end of October. This week's number is really going to help us, I guess, gauge the labor market's recovery and where we are. I think there's some confusion as to whether or not we can maintain some of the growth that we have seen over the last couple of weeks, or whether or not we're headed for a rough period because of the rise that we've seen in the COVID cases nationwide. Of course, that is a big concern here as we head into tomorrow. And then, of course, over the next several months, tomorrow's number is going to give us a better idea of this. So, Adam, that is one of the things that I will be closely watching tomorrow morning. It's out at 8:30 a.m. Eastern time.
One of the things I'm going to be watching, in fact, I'm going to attend it, is a 10:30 briefing from Airlines for America. Now, we heard from Helene Becker that from Cowen, and she's the analyst. She said, look, the airlines have enough liquidity to go another year to get through this pandemic. But what we hear from the airlines is that the cash burn is still a problem. Look, they're not generating revenue. When you got empty seats, you're not raising money. And so even Delta, in their best case scenario, they don't eliminate the cash burn and go neutral until the spring of next year. So what's that doing to the airlines? That's what this this press update is going to be with Airlines for America, because to put it in perspective, you had 2.5 million passengers flying every day in the United States before the pandemic. The airlines were shipping something like 58,000 tons of cargo every day. That's been cut dramatically. You know, the numbers have been lost more than 50%. So Helene was telling us, going to be a good holiday, perhaps Thanksgiving, but that's not enough to get these airlines over the hump. I mean, I'm looking at American Airlines today. They closed down. All the airlines closed down, but American was off about 2.75%. So the key for the airlines, liquidity, and then of course A4A is going to be lobbying Congress for more stimulus.
Certainly is. There's a lot of uncertainty, at least we can say, when it comes to that sector. And of course, the number of cases rising nationwide. It's hard to kind of picture or really predict when we're going to see people willingly returning to the skies and returning, I guess I should say, and the numbers that we saw back in January or in February. I also want to mention what we're seeing in Vroom, because that stock is under a decent amount of pressure right now, with shares off just around 10% after hours. We brought you those earnings after the bell a little bit earlier in the show, and we saw it was actually for the quarter, it was better than what the street was expecting, even though their sales did fall 5% to 323 million. It's really, though, their guidance as to why we're seeing so much pressure on the stock here after hours. That coming up a bit short. So that, of course, is one of the names to keep on your radar. And it kind of goes to the theme of what we've seen for much of this earnings season. If there's anything in that report that disappoints, investors find a reason to sell. All right, well, that does it for us today on Yahoo Finance Live. Thanks so much for joining us. We'll see you back here again tomorrow.